Hello and welcome to the RedChip Fintech and Digital Asset Treasury Conference. My name is Craig Brailsford and I'll be your host today. Our first speaker today is RedChip CEO, Dave Gentry.
Hello everyone, I'm Dave Gentry, the CEO of RedChip Companies. Thanks for joining us today for our Fintech and DATS Conference. I want to start today with giving you a brief overview of RedChip, and then we'll talk about the conference itself. RedChip was founded in 1992 as an independent research firm. We were one of the first to put coverage on, believe it or not, Starbucks, Apple, Winnebago, Daktronics, many other companies that became household names. Today, we are an investor relations, media, and research firm focused on companies $5 billion and under market cap. We have 6 verticals. At the top of our platform today is our national 30-second TV ad platform in which we write and produce 30-second ads and then run them on national Fox Business, Bloomberg, and CNBC. Behind that, we have an outbound marketing team that talks to stockbrokers, RIAs, and fund managers every day, analysts, setting up meetings and calls for our client companies. We also have a newsletter that goes out weekly. And we have our own show called Small Stocks, Big Money, titled after my book, that airs on Bloomberg National TV every Saturday at 7 p.m. We also have a very robust email platform and social media platform in which we create multiple videos for our clients and then target smaller cap investors online. We also create research profiles for our clients as well as landing pages and websites. Today we represent about 80 companies, again, $5 billion under market caps. We also do all the blocking and tackling, writing press releases, investor decks, conference call scripts. So thank you for joining RedChip Nation today. Today's conference focuses on one of the most significant financial transformations unfolding in real time, the rapid evolution of financial technology and the emergence of digital asset treasury strategies. For much of the past decade, traditional finance and digital assets were treated as two separate worlds, Wall Street on one side, cryptocurrency on the other. But that distinction is disappearing quickly. At its core, this shift is about infrastructure, how money moves, how value is recorded, how assets are issued, settled, and stored, and how corporations manage liquidity in a global, always-on economy. Payment settlement layers, treasury management, and capital markets are all being re-architected simultaneously. And this transformation is no longer theoretical, it is measurable. Last year, new data from the International Monetary Fund showed that stablecoin transactions volume grew by roughly 90% in 2024, with the combined market capitalization of leading stablecoins now exceeding $250 billion. At the same time, total global digital asset market capitalization has grown to more than $2.5 trillion, underscoring the scale of liquidity and institutional participation now embedded in this ecosystem. Adoption has been particularly strong across emerging markets in Asia, with rapid growth also occurring in Africa, the Middle East, and Latin America, where digital assets are increasingly used for cross-border payments and dollar-based settlement. Notably, some of the largest outbound transaction flows are originating from North America, as blockchain-based rails become a preferred alternative for international transfers. These systems are beginning to replace legacy infrastructures like SWIFT, where speed, cost, efficiency, and 24/7 availability have become competitive advantages rather than luxuries. In fact, Visa has publicly stated to its banking partners that every bank should have a stablecoin strategy. Central banks are moving just as quickly. According to a recent survey from the Bank for International Settlements, more than 90% of central banks worldwide are actively exploring central bank digital currencies for retail use, wholesale settlement, or both. At the same time, capital markets are undergoing their own transformation through tokenization. Traditional assets, corporate bonds, equities, private credit, in real estate are being brought into digital rails, enabling fractional ownership, continuous trading, enhanced transparency, and improved compliance frameworks. Forecasts vary, but the direction is clear. McKinsey estimates tokenized asset markets could approach $2 trillion by the end of this decade. Other industry research suggests that figures could grow substantially larger under broader adoption scenarios. The regulatory environment has also begun to mature. New accounting standards now allow certain digital assets to be reported at fair value, improving transparency and influencing how public companies approach digital asset exposure within their balance sheets. As a result, we're seeing the rise of a new category, digital asset treasury companies. Recent industry data shows that these companies collectively hold more than $130 billion in digital assets, more than double their holdings from early 2025. The majority of this exposure remains concentrated in Bitcoin, but we're also beginning to see diversification into other digital assets used for liquidity management, yield generation, and strategic reserves. According to corporate treasury trackers, more than 135 publicly traded companies now hold over 650,000 Bitcoin, representing more than 3% of all Bitcoin that will ever exist. Historically, increased institutional adoption of Bitcoin has tended to precede broader engagement across additional blockchain networks, including assets supporting smart contracts, settlement, and decentralized financial infrastructure. That's why we're all here today. We're watching a new corporate treasury and financial infrastructure playbook emerge in real time. And the companies presenting today are positioned at the center of that shift. I want to thank all of our presenting companies, analysts, fund managers, brokers, RIAs, family offices. We're all excited to share a full day of insights into how fintech and digital asset strategies are reshaping the global financial system. Let's begin.
Thank you, Dave, and thank you for that perspective on where capital markets, financial infrastructure, and digital assets are converging. And thank you to everyone joining us today for RedChip's Fintech and DATS Investor Conference, from modern payments to strategic digital asset management. Whether you're a retail or institutional investor, an active trader, a corporate executive, or simply someone focused on where financial innovation is headed next, we appreciate you being part of this conversation. What makes today's conference particularly compelling is that it's not about speculation, it's about implementation. As Dave outlined, the financial system is being rebuilt layer by layer. Payments are becoming programmable. Settlement is moving closer to real time. Treasury strategies are expanding beyond cash and short-term securities, and digital assets, once viewed as peripheral, are increasingly being treated as infrastructure, balance sheet tools, and strategic reserves. That's the lens through which today's agenda was designed. Across the next several hours, you'll hear from analysts and management teams operating at different points along this transformation: payments, compliance, broker-dealer platforms, tokenized assets, staking, digital commodities, gaming economies, stable coins, and intellectual property monetization. Together, these companies represent a cross-section of how fintech and digital asset treasury strategies are showing up in real businesses today. We'll begin the morning with analyst perspectives to frame the opportunity set, followed by a series of company presentations. Let me briefly walk you through the presentation lineup. Our first company presentation will be OwltingGroup, a NASDAQ-listed company building compliance-first global payments and settlement infrastructure for enterprises operating across fiat and regulated stablecoins. Through its core platform, OwlPay, OwltingGroup enables cross-border settlement, on and off ramps, merchant checkout, and digital asset management across multiple blockchains, while meeting bank-grade regulatory and compliance standards. Owlting represents a real-world example of how stablecoin infrastructure is moving from experimentation to scaled revenue-generating deployment. We'll then hear from Enlivex, the first publicly listed company to build a corporate treasury centered on the RAIN protocol, implementing an active treasury model focused on long-term accumulation and staking. This structure provides public market investors direct exposure to the rapidly expanding prediction market economy through a transparent SEC reporting corporate framework. We'll then hear from BNB Plus, a NASDAQ-listed company executing a yield-focused digital asset treasury strategy centered on the BNB token and the broader Binance ecosystem. BNB Plus combines long-term BNB accumulation with non-directional DeFi-based yield generation, supported by real-time public disclosure through its recently launched BNBX.io Treasury dashboard. We'll also hear from Blue Gold, a vertically integrated fintech company building a digital-backed treasury ecosystem designed to merge the stability of physical gold with the speed and programmability of blockchain-based payments. The company recently completed the initial minting of its standard gold coin, a digital token backed one-to-one by vaulted physical gold. By integrating gold sourcing, custody, tokenization, and payments, Blue Gold is positioning itself as a differentiated alternative to fiat-backed stablecoins within the evolving digital asset treasury landscape. We'll then turn to Webull, a name many investors already recognize. As a broker-dealer operating across stocks, crypto, and futures, Webull sits directly at the intersection of traditional capital markets and digital assets. Their platform perspective offers insight into how investor behavior, product design, and regulatory frameworks are converging. This afternoon, we'll hear from Oxbridge, which will present its work in digitizing reinsurance securities. This is a compelling example of how blockchain-based structures can be applied to complex, historically illiquid financial instruments, unlocking new forms of access, transparency, and capital efficiency. We'll also hear from Bit Digital, a NASDAQ-listed company that has evolved into one of the largest public market Ethereum treasury platforms, combining long-term ETH accumulation with institutional-grade staking and infrastructure. Then we'll hear from Bragg House. Through its definitive merger agreement with House of Doge, the official corporate and commercial partner of the Dogecoin ecosystem, Bragg House is building a platform focused on Dogecoin-enabled payments infrastructure, treasury management, and real-world asset tokenization. We will then go to BTS, following with its focused Ethereum strategy, emphasizing how public companies can build treasury and operational exposure around proof-of-stake networks. Then we'll hear from IP Strategy, a NASDAQ-listed company providing public market investors with equity-based exposure. And then, to close out, we'll hear from MMA Incorporated, a technology-driven combat sports platform building a real utility on-chain economy for fighters, gyms, coaches, and fans. Taken together, today's presenters illustrate a broader truth. Digital asset strategy is no longer a single decision. It's a spectrum of decision. And that is why we're going to be starting today with thoughtful analyst insight. And our first guest today is Brian Dobson. Brian is a managing director and senior research analyst at Clear Street, where he covers disruptive technology as part of the firm's newly launched equity research group. He brings more than 20 years of capital markets experience, having held senior equity research roles at Jefferies, Nomura, Lazard Capital Markets, and Susquehanna. Most recently, Brian has served as head of disruptive technology and SPAC equity research at Chardan Capital Markets. His work focuses on identifying investment opportunities driven by innovation across emerging technology sectors. Brian, welcome.
Great. Thanks so much. It's wonderful to be here, and thanks to the RedChip team for putting this together. As you mentioned, I lead the disruptive technology equity research platform at Clear Street, where we specialize in blockchain assets, cryptocurrencies, DATS, Bitcoin mining, and soon space robotics, and various other companies at the vanguard of technology within the public markets. I believe that this conference matters right now more than ever because fintech and digital assets have entered a much more mature phase. However, recent market volatility is testing these new business models and creating areas of substantial potential opportunity, at least in my view. A year ago, most of the conversation about digital assets focused on their potential and what these technologies could become. But today, investors that we speak with are far more focused on a path to revenue, sustainable margins, cash flow, and disciplined capital allocation. In our research at Clear Street, we've seen a shift in how the public market behaves. Investors are moving away from rewarding optionality and moving toward rewarding execution with stronger multiples. And that shift is really the backdrop for today. One of the biggest changes that we've seen is that payments, fintech, infrastructure, and digital assets are no longer separate conversations, right? Rather, they're intermingled among the investors that we chat with. And as payments are getting faster and more programmable, infrastructure, custody, compliance, APIs, that's all becoming more standardized and scalable. And digital assets are increasingly showing up inside traditional operating models. From an investor perspective, what we believe matters now isn't whether the company has fintech exposure, but rather where it sits in the stack and how directly that position turns into revenue and operating leverage over the next several years. Across our coverage universe, companies that tend to hold up the best in market conditions such as these are ones where the business model is doing more of the work than the balance sheet, right? Which brings me to what we're seeing in digital asset treasury companies right now. I mean, certainly it's no secret that the sector has been under pressure. Many DAT-focused companies today are trading at meaningful discounts to their reported MNAVs, and that's been painful for investors and those management teams. But what we actually think is that it's creating an important reset and potential opportunity. What we're seeing is not these companies really abandoning their digital assets, but rather the management teams are getting more practical about capital allocation. And in some cases, that means trimming their crypto positions and redeploying capital into operating businesses. This is something that I think we're going to see more of over the next 9 months. And it's not because they're bearish on digital assets, but rather because the returns are clearer and the earnings are more visible within operating businesses associated with digital assets. And the equity story becomes easier for the market to digest and reward a multiple for. One thing that the market's been very consistent about in our research is that investors reward companies that can clearly show a path from assets to earnings, right? And what's especially interesting is where the capital is being redeployed. In many cases, it's moving into payments, financial services, or tokenization strategies, areas where digital assets support the business rather than totally define it. For some DAT companies, this seems more like an evolution into tangential businesses, from just holding assets on the balance sheet into building financial services platforms that can generate recurring revenue. As you listen to company presentations today, I'd encourage you to keep a few simple questions in mind. Are the revenues recurring or largely transactional? Do unit economics improve with the scale of the company? Is capital being deployed with a clear return hurdle? Is the company's regulatory posture proactive rather than reactive? And are execution timelines specific? In our experience, companies that can answer those questions clearly are the ones that tend to earn investor confidence more quickly. Now, stepping back, we think that the next phase of fintech and digital assets is less about headlines and more about their business models. The opportunities that stand out today are the ones that convert payments and data and digital assets into durable earnings and strong balance sheets over time with sustainable margins and growth. As capital reallocates across the sector, we believe 2026 will favor companies that treat digital assets not as an endpoint, but rather as a tool in building real scalable operating businesses. And with that, I'd like to thank you very much for having me. I'm looking forward to hearing from all of these companies throughout the day and excited to see what the conference brings. Appreciate your time.
Thanks, Brian. Our next speaker is Jim McIlree. Jim is a senior research analyst at Chardan, covering the technology sector with a focus on crypto, artificial intelligence, and electric vehicles. He brings more than 20 years of sell-side equity research experience with prior roles at Dawson James, Bradley Woods, and Unterberg Taubman. Jim holds a BA in economics from the University of Chicago, an MBA in finance from the University of Colorado, and he is a CFA charter holder. Jim, please go ahead.
Good morning, Craig. How's our connection today?
Excellent. Thank you, Jim.
Great. Thank you. Well, thank you very much for inviting me to speak today. It's a great pleasure to discuss the digital asset treasury, or the DATS sector, and our work in this area. Let me see if I can pull up a slide here. There we go. I am a senior research analyst, managing director at Chardan Capital Markets. Chardan is an independent, full-service global investment bank. We're focused on tech and biotech. On the banking side, the bank has participated in more than 700 transactions with an aggregate transaction value of over $120 billion. The research department is comprised of 6 senior analysts targeting digital assets, AI, and biotech. As Craig mentioned, I'm a managing director and senior research analyst. I've been a sell-side equity research analyst for the past 20 years, focusing on emerging growth opportunities in the tech sector. Over the course of my career, I've covered telecom, defense tech, industrial tech, AI, and digital assets. And the goal has always been to discover industries and companies that have a profound impact on the economy, that can post superior growth rates for extended periods of time, and result in significant capital appreciation for investors. I joined Chardan a little less than a year ago, and I've been tasked to build out the digital assets and AI autonomy sectors. The AI and digital assets sectors fit well into our investment philosophy, as both are relatively new and have the potential to grow at rates well in excess of the economy's growth rate. We also expect them to drive fundamental changes in how businesses operate, how consumers purchase goods and services, and how transportation and logistical needs are fulfilled. We believe that the adoption of the adoption of the internet, which drove a investment cycle that resulted in higher productivity growth, so too will the adoption of digital assets and AI. This has very positive implications for economic growth, per capita GDP, inflation, and the government fiscal outlook. My current research coverage comprises 8 companies in the digital asset and AI autonomy sectors. In the digital asset space, we follow digital asset treasury companies, or DATS, that include Hyperion DeFi and Hyperliquid Strategies. Both are involved in the Hyperliquid blockchain, and we also cover Metaplanet and Zeus, both involved in Bitcoin. CleanSpark is a Bitcoin miner moving into power management for AI. And on the AI and autonomy side, we follow Kodiak AI, Urgently, and VinFast. But today I'm going to focus on the digital asset treasury, or DATS space. Let me show disclosures that are required that share with you potential conflicts of interest that Chardan has with my coverage universe, any banking relationships we have, as well as potential conflicts that I might have with my coverage universe. So I just do want to make everyone aware that we have provided investment banking services for the coverage universe that I laid out in the prior slide, and some additional general disclosures that are necessary for me to provide. As far as my research coverage publication goes, we are very active publishers of research in this space. We publish and distribute research reports that includes a weekly DAT report that looks at the 60 companies in the DAT space and the 27 coins they own. We examine price performance of the coins, price performance of the DATs, significant news in the space and specific topics such as buybacks, share registrations, and their impact on the price of the DATs. We have a comprehensive look at the movement in the holdings of the cryptocurrencies held by the DATs, as well as the valuation comparison of the DATs utilizing a metric called MNAV that I will address later in this presentation. We also publish a weekly report on the Hyperliquid, or HYPE, blockchain and the DATs involved in this asset. Hyperliquid is a decentralized exchange that allows traders to purchase crypto assets in the spot market and derivatives called perpetuals, or perps. And this exchange has begun to offer markets in derivatives on commodities like gold and silver, as well as derivatives on public and private equities. And this week, they announced they will support prediction markets, similar to the prediction markets offered by Polymarket and Kalshi. The digital asset treasury market is a relatively new invention. It was pioneered by MicroStrategy or Strategy in 2020 when it first began purchasing Bitcoin to hold on its balance sheet. At the time, Bitcoin was trading at $11,000, and the expectation was there would be a significant increase in the price of Bitcoin, and Strategy would benefit from the price appreciation in that asset. It was completely correct, and Bitcoin is now trading at $75,000, and Strategy has increased its holdings of Bitcoin from 0 in 2020 to over 713,000 coins, valued at $53 billion today. Beginning in the spring of 2025, with the strength in the crypto markets and the equity markets, many companies followed the lead of strategy and adopted digital asset treasury strategies. By September, as you can see in the chart, the amount invested in cryptocurrencies by DATS had increased 70%, reaching $110 billion. And the variety of coins purchased and the treasury strategy expanded from the major cryptocurrencies, Bitcoin, Ethereum, Solana, and it included Dogecoin, BNB, Hyperliquid, Toncoin, Canton Coin, Bitensor, and many, many other coins. By our count, there are over 26 coins that are owned by the digital asset treasury companies. Bitcoin still dominates this space. About 70 billion of the 90 billion or so owned by DATS is Bitcoin, and Strategy is by far the largest holder of Bitcoin and the largest DAT, which again holds about $53 billion of Bitcoin currently. The investment thesis for the DATS has evolved over the past few years, and it will continue to evolve over time. Before the reversal of the regulatory policy toward digital assets that was brought about by the Trump administration, personal ownership of digital assets was burdensome and costly, and DATS, like Strategy, offered a convenient way to participate in the digital asset market. However, as ETFs have become more available and the ability to purchase digital assets have become easier with centralized exchanges like Coinbase and decentralized exchanges like Hyperliquid, DATS have begun to develop a more sophisticated operating and financial strategy that expands beyond the simple buy and hold strategy that they have pursued to date. The most common question I receive regarding this space is, what is the use case of these coins? The chart here shows the 26 coins owned by our sample of DATS and the various applications of these coins. Most investors are comfortable with the use case for Bitcoin or Ethereum and Solana, but after that, there's a significant gap in understanding what the use case for a specific digital asset is. The economics of the coin, the production and distribution of the coin, competition in the coin space, and the outlook for the price of the coin. So the DAT market then has a unique forecasting challenge of analyzing the fundamentals of the digital asset and then analyzing the fundamentals of the digital asset treasury company owning that coin. And the focus of our research going forward, I think, is going to try to look at the intersection of those two valuation challenges. The most common and the easiest valuation tool used in this space is something called MNAV. It's a market value or enterprise value of the company divided by the net asset value of the digital assets that they own. For instance, the MNAV for Strategy is currently on their website listed as 1.09 times, which means that the market value plus the preferred and debt owned by or issued by the company is trading at about a 10% premium to the underlying Bitcoin that the company owns. The MNAV gives, an MNAV above 1 gives these companies a unique arbitrage opportunity. They can issue stock or preferred shares or debt and use the proceeds to purchase the digital assets. The way I look at it is that this is similar to a company that can issue stock at, let's say, 10 times cash flow, and then purchase assets in the private market or in the public market at 5 times cash flow. And we've seen that often in the public markets, companies pursuing roll-up strategies that will issue stock at a high multiple of earnings or cash flow and then take that cash and roll up individual assets that are trading at a much lower price to cash flow or PE. This arbitrage opportunity was exploited aggressively through September and October of last year. And there was a significant increase in the number of DATs and the capital supply to pursue a digital asset treasury strategy. And again, it was based on this arbitrage of an MNAV greater than 1 times. But over the past few months, with the increased availability of ETFs, the increase in the number of DATs, the decline in the crypto markets, the MNAV for the market has compressed, and many DATs are now trading at an MNAV less than 1 times. Now, in theory, the company with an MNAV of less than 1 times still has an arbitrage opportunity, but instead of selling stock and buying Bitcoin or other digital assets, it can sell the digital asset and buy the stock. This would be similar to a company selling an asset at, let's say, 10 times cash flow and then buying its stock, trading at 5 times cash flow. And we see this often in the equity markets as well. However, most of the DATs have been reluctant to reverse their initial trade and instead are exploring using preferred and debt to fund purchase of digital assets. And they're looking at expanding their operational window. Many others seem to be attempting to ride out the current volatility in crypto and expect a recovery in crypto prices to drive a recovery in their stock price and in their MNAV. And in our work, our observation is the number one driver of the stock price in the digital asset treasury space is the price of the crypto coin. That is, when the crypto coin increases, so too do the digital asset treasury companies and vice versa. It's not a one-for-one relationship, but it is, again, in our opinion, the key driver of the price performance in this space. So what's next for this space? We think there are 3 things that the industry needs to address over the, let's call it, next 12 to 18 months. The first is the coin case, which I mentioned earlier. Most people are comfortable with what you can do with Bitcoin or Ethereum or Solana, but many of these treasury companies are not holding those 3 major coins, and instead they're holding coins that have use cases that are just not understood by investors. And I think it's going to be important for the companies as well as the analytical community to understand the coin case. What is it you do with these coins? What problems are they solving? What is the supply profile of the coins? How does that impact the price of the coin? And I think it will require analysts and companies to present forecasts of what is going to happen to the price of the coin based on the fundamentals of the coin. Now, in our DAT sample, there are over 26 coins, so it's a large project to look at all 26 of them. So I think that what will happen is that the industry will focus on, at least on the analytical side, will focus on a few coins, so 5 or 6 coins, and understand those well, and then build out into other coin cases. And then on the DAT side, I think as more investors become comfortable with specific coins, that will attract capital to those coins and more DATs to those coins. So I think we're going to see, as this industry develops, the coin cases being articulated, investors choosing which coins they want to invest in, and more of the DATs then putting their capital into those coins. Bitcoin is an obvious recipient of these investment dollars. To date, Solana has been a significant recipient, Ethereum, Hyperliquid. There have been some, I would say, reasonable investments in BNB and Bitensor, and we'll see. We'll see what others are going to develop over time. A second major industry issue is going to be the operating model of the DATS. So what is it that the DATS are going to do? Are they going to buy the coin and hold it? Many of these DATS are taking the coins and they're investing in the ecosystem of the coin that they have purchased. For instance, staking has become a significant revenue generation tool for many of the DATS. Many DATS are engaging in derivatives strategies in order to generate cash flow. And we think over time, additional models will be developed in order for these companies to demonstrate a unique skill in operating the DAT other than a buy and hold strategy. So this is going to be, again, something that develops over the next 12 to 18 months. And we think it will be a significant focus for the DAT market, and it will be a significant focus on for the analytical community as we evaluate the operating models of the DATs. And then another issue that I think is going to be very important going forward is valuation. We discussed how MNAV currently is the primary valuation tool used by the DATs. And I think over time, as the coin case is developed and the operating models are expanded, that additional valuation tools will become necessary to value the DATs. Probably focusing on traditional valuation tools that we use in the equity markets today, that is revenue generation, cash flow, margins, return on invested capital. The traditional valuation tools that we use, I think increasingly will be applied to the DAT space as the coin case and the operating models develop over the coming years. But we are very excited about this space. We are committed to building out our presence in the digital asset treasury space, and we're very fortunate to be here at this time to present to you, and want to thank Craig and the team for inviting us to speak. Thank you.
Thank you very much, Jim. Great presentation. Once again, everyone, that was Jim McIlree, Senior Research Analyst at Chardan. Now we're going to introduce you to RedChat, a revolutionary AI chatbot for small cap stock analysis.
Hi, it's Michael with RedChip. RedChat, it's an AI platform built to bring clarity and speed to capital market analysis. In fast-moving sectors like fintech and digital assets, investors and analysts are constantly evaluating strategy, risk, and positioning across multiple public companies, often in compressed timelines like today's conference. RedChat delivers content-rich answers sourced directly from SEC filings, press releases, and official company disclosures. That means no speculation, no hallucinations, only verifiable content. Instead of manually searching through filings or building one-off response packets, you can rely on RedChat to surface disclosure-backed answers instantly. That's time that you can get back for everything else in your portfolio analysis. What makes RedChat unique is that it's not just a wrapper on top of ChatGPT. We built a pipeline in-house, optimized for financial disclosures. Our proprietary retrieval augmented generation system ingests the SEC filings, our curated financial news networks, press releases, and more, and then, using a multi-stage processing pipeline, returns verifiable answers with citations. For investors and analysts, that means confidence. When you ask about corporate structure, governance, capital markets history, or the business model, that answer is coming directly from SEC file disclosures and not a large language model's best guesstimate. Let's put this into context and get hands-on with RedChat. We're attending today's Fintech and Digital Asset Treasury Strategies Conference. We're hearing from multiple presentations, and we want to quickly validate how these companies define themselves in their own SEC filings. Take a look at Obook Holdings, trading on the NASDAQ with the symbol OWLS. I just heard from the C-suite management, and I want to understand its public market history. So I can ask RedChat, when did Obook Holdings become a publicly traded company? And through what type of transaction? RedChat surfaces registration disclosures from Obook Holdings, detailing the IPO and the transaction structure. Within seconds, I now have when and how the company entered the public markets. Again, sourced directly from trusting documents. In another scenario, let's say I want to have a quick capitalization reference. I can ask RedChat, how many shares were outstanding as of Obook Holdings' most recent filing? RedChat highlights the most recently disclosed share count from those filings. This provides a structural and current snapshot without manually scanning through financial statements. Now let's take a look at Blue Gold. I can ask Blue Gold, how does Blue Gold describe its business model? And on screen, we see that RedChat pulls up business language from Blue Gold's official filings. This shows exactly how management defines the company's model in a formal disclosure, not just how it's framed in a presentation. In another scenario, we could ask, what do they actually do? What does Blue Gold state is its primary business activity? What's its model? RedChat highlights the company's overview section from Blue Gold filings. This allows investors to quickly anchor to what the company actually does according to its filings. In a governance structure question, we can ask, what is the structure of Blue Gold's board and who serves on it? Instead of sifting through web pages or trying to search in a document, RedChat surfaces governance disclosures from Blue Gold's annual report or a proxy filing, listing the board members and the structure. In seconds, we can review the board composition and the governance structure, again, directly from those filings. Before we move on to our presentations, let me show you how to access RedChat at redchip.com. It's quick, easy, and it's free for investors. For the best access, you can find RedChat on the Apple Store, or by visiting red.chat, or selecting any stock from our portal at redchip.com. You can register for free and get an account that gains early access to premium features. For institutional investors that are seeking expanded capabilities, our team is available and can provide additional access options. Simply email info@redchip.com. Thank you again for joining this demonstration of RedChat for the Fintech and Digital Asset Treasury Strategies Investor Conference. We'll begin in just a moment.
A new era of small cap research has arrived with RedChip's RedChat, the fastest, most accurate AI assistant for small caps. The days of spending hours sifting through press releases, 10Ks, 10Qs, 8Ks, 13Fs, 13Gs, and other filings is over. Now, get answers in seconds on 4,000 small cap stocks in one portal. Simple, fast, accurate, detailed answers. Meet small caps with RedChat.
The gaming industry is booming, driven by Gen Z's $360 billion in spending power. Meet Braghouse, NASDAQ symbol TBH, a pioneering media tech company transforming how brands connect with Gen Z through college sports, gaming, and social interaction. Braghouse has secured multi-year deals with Coca-Cola, McDonald's, Learfield, and more. Tap into a $1.3 trillion opportunity across gaming, advertising, and data insights built for scale. Braghouse, NASDAQ symbol TBH.
RedChip. We build investor audiences for small cap companies, retail and institutional. 33 years, thousands of clients. We are experts in messaging. National TV ad campaigns, investor webinars, digital media, reaching hundreds of thousands of investors. RedChip. We do it well, we do it right, we do it big. RedChip. Call us or email us today.
According to the 2025 McKinsey Global Payments Report, the global payments market will exceed $3 trillion by 2028. Meet Obook Holdings, a NASDAQ company symbol OWLS. A global fintech company collaborated with Visa, leveraging their proprietary e-commerce platform, which is ranked among the top 2 global players in the enterprise and B2B category in the digital currency sector, projecting triple-digit revenue growth in 2026. Obook Holdings on the NASDAQ, OWLS.
Now, let us hear from leaders of companies in the fintech and digital asset treasury space. Our first company today will be Owlting, Obook Holdings, ticker OWLS on the NASDAQ. Presenting today will be founder and CEO Darren Wang. We will begin with a brief presentation in a moment, and then we'll open up this event to your questions. I will keep everyone's lines muted throughout the presentation. To submit your question, just press the Q&A button at the bottom of your Zoom window and type in your question. Before we begin, please allow me to read the Safe Harbor Statement. This segment may contain forward-looking statements within the meaning of the Private Securities Litigation Reform Act of 1995. All statements pertaining to future financial and/or operating results, along with other statements about the future expectations, beliefs, goals, plans, or prospects expressed by management, constitute forward-looking statements. Any statements that are not historical fact should also be viewed as forward-looking statements. Of course, forward-looking statements involve risks and uncertainties. Thank you very much. Darren, please go ahead.
Thank you, Craig. Can you hear me? Perfect. Yeah. Let me share my presentation. So, good morning, everyone. I am Darren, the founder and CEO for Outing. I have been investing in the crypto and digital currency for over 13 years. So I've witnessed the rise for Ethereum, USDT, Tether, Circle, and a lot of new different blockchain technology. But for our company, we actually want to solve the most difficult problem for the industry, which is how to really move the money regulated in different regions. Yeah, so in the next 20 minutes, I'm going to explain how I build a company, what is our product, and what's our vision for the future for the company. So let me start by presenting our vision. So this slide explains how the money moves in globally. Yeah, so our goal is very simple: to rebuild how money move globally using the latest modern infrastructure, which is stablecoin plus blockchain. It's not a faster app. It's not a prettier wallet. It's the infrastructure that actually works under regulations. So our value proposition for the company is the problem we are solving. Imagine if you have children, they study in Italy or different countries. When you want to send tuition to your children, when you open up your banking app, open the SWIFT address, you still need to pay $30 for the international wiring. So what is the real fintech innovation in the last 20 years? Basically, it has been pretty much the same. But blockchain and stablecoin has been a new hope for the industry. Cross-border payment today is still very slow, taking about 1 to 3 days to be settled. Sending the money is very inconvenient. You need to go to the bank and enter a lot of information. What's changed is not the pain. It's the stablecoin are now ready to become the new settlement tools in the next coming years. And Outing has been one of the most earliest pioneers in the industry. And how does the stablecoin evolve in the last couple of years? So this is one of the most important slides of today. So stablecoin has graduated from trading instrument to the real settlement instrument. Institution right now, they are moving from pilot to production. Like you can heard about Visa, heard about the banks, they are trying to issue the new stablecoin for their own. And regulation is becoming clearer and clearer. Cross-border settlement is the first real-scale use cases in the stablecoin industry. But there's a gap. What's missing is a global connected, locally licensed infrastructure. So this is exactly Outing is building in the next couple years. For this slide, you can see infrastructure is live and operating. We have spent over $20 million to build a global licensing technology, anti-money laundering, and then know your customer. And this is not the product roadmap. It's actually the live production code handling live flows. So let me be very clear here. We operate across 4 layers from enterprise payment to regulated on-off-ramp. So on-off-ramp means you are pulling the real money to stablecoin and switching from the stablecoin to the local currencies. So different stablecoin will be live on different blockchain, like Solana, Ethereum, all different blockchains, Stellar. And we provide API access and the web interface for financial institution. They can quickly embed it to the stablecoin infrastructure. So everything you see here is already running for the live flow. And what is the next question and change for the industry? I believe everyone has the question. We heard about stablecoin, but how do we get the stablecoin from banks? Obviously, if you go to Bank of America, you cannot buy stablecoin, right? So we thought about the problems in the last couple years, and that's why we decided to partner with the traditional financial giant Visa, and we are trying to gradually to bring the current financial tool everyone has, which is the credit card or debit card with Visa. So imagine you can just grab any of your debit card with Bank of America. You can just enter your card number, and then instantly the fiat money from your bank account will become USDC instantly into your wallet. And once you receive the stable coin in your wallet, you can actually enter the address, just like open up your WhatsApp contact and put in your friend's phone number, and then the money will go to their wallet, digital wallet instantly, and can be settled either in the local currencies or stay in stable coin. So this is the critical element we are putting together. One is to bridge in the traditional financial tool like Visa, and the other one is we partner with Circle to build one of the latest and largest Circle payment network globally. So imagine the money becomes stablecoin. Right now, they need to travel through the blockchain instead of the SWIFT. So Circle Payment Network actually reach over 2 billion population and over 100 countries, and it's going to be instant settlement. Everything can be settled with USDC and then going to the local currencies. So this is how we build the product by working with the traditional financial giant plus the Circle Payment Network to make it happen. So we are not reinventing the global network. We connect to it. And there's over 500 million debit cards in the state. And once they are connected to our infrastructure, the money travels through blockchain with the stablecoin format, and then they can be settled in the local currencies. And this is also one of the most important slides for the company. So in the last 4 years, we have been trying really hard to apply for the US money transmitter license. So right now we have over 40 money transmitter license that cover the movement for fiat and stablecoin. Not just US, we are also applying for the most difficult countries to enter, which is Japan. So Japan, we are applying for 3 licenses. We got one already and expecting to get the rest of two in the coming months. So we will be the only tech company globally in Japan that's holding 3 licenses. They can settle the money with stablecoin and switch the stablecoin to yen. Besides US, Japan, we are also working with regulated partners in Asia. So we actually cover more than 30 currencies, and then pretty much every country can use a stablecoin to be settled in Asia, and Europe and Latin American and Singapore in progress. So this is the competitive mode that we have been spending in the last 4 years that build a very high entry barrier to compete with the company. And this is how we make money. So our business model is actually very simple. First, the enterprise settlement is usually very large, from millions of dollars to tens of millions of dollars per month. So this is actually going to be the repeated money flow in the future. And second, we move all the transaction value chain when the volume grows. And the cost is literally the same. So we don't really invest too much about the licensing infrastructure or technology. The cost had been already invested in the last couple of years. And you can see this slide. So the average take rate for the company is about 50 to 60 BPS. And when the month, so right now the company has about 200 employees, and the annually transaction volume reaches $4 to $6 billion, which is about $300 million per month. The company will be profitable. So we are getting to a point that the company is going to be scaled and pretty profitable in the coming years. So we are very proud that we have been spending the last 4 to 5 years to get to this level. And this is our closing presentation for today. Yeah. So you can see a lot of companies, they are building the fintech app, the DeFi, everything. I think that's all very wonderful. But stablecoin infrastructure is every fintech company that will be needed in the next couple of years, including the prediction market. So we are different. We function as a regulated payment infrastructure globally with stablecoin. So if you are building the prediction market, you want to get a customer from Japan, we can open up the Japanese corridor for you. You can use our Japanese license, partner with mega banks, and get the money from Japanese market, and vice versa. Any countries we are licensed and operated with partners, you can actually use our infrastructure. So you can imagine our company is actually like an app store. We're providing our global licensing technology, anti-money laundering tools for everyone who needs stablecoin. And then they can build upon our infrastructure. Yeah. So this is the investment highlight for the company. So ARK investment talk about where the world is going, and we focus on making sure the value chain can actually move in the world legally, reliably, and at scale. So we are not building the future just as a concept. We have spent the last 13 years, and the last 5 years we're starting to get the license, getting the regulations, in different countries, try to make it really move. So right now we are the only infrastructure for stablecoin that can really settle the money from US to all the most of the corridors globally, and the money movement will be settled within seconds, not just like traditionally you need to spend 1 to 3 days. You pay the traditional money movers like 6% to 10%. We always charge the less percentage for our consumer. We want to make the money movement like you are sending the WhatsApp message, and we have bigger vision that in the future, if possible, we want to embed the solution into, for example, WhatsApp, and any messenger or Twitter, X. So I think this is the future we are building for the global finance using the stablecoin and blockchain. So thank you today for sharing, to give me the pleasure opportunity to share how I build the company's vision and the future.
Darren, thank you very much for that excellent presentation. We are now going to take your questions. Press the Q&A button and type in your question. And as we can only take your written in questions today, we ask that you not use the raise hand button, but certainly, by all means, use the Q&A button to type in your question. Darren, we've already received several questions.
Sure.
First one, yeah, we printed them out here. First one, many fintechs prioritize speed to market first and compliance later. Owlting took the opposite approach. How has building a compliance first bank grade platform shaped your competitive positioning?
Yeah, so we actually thought about the question a couple years ago. Yeah, so we are actually supported by one of the largest bank from Japan, SBA Holdings. So they used to be known as SoftBank Investment, but the chairman and I have shared some vision that building any fintech or new technology, license and regulation is very important. So I always keep that in mind that uh, moving money for other people is actually a great mission. So we don't want to, uh, bypassing the regulation part. Also, we know if you are using any kinds of the stablecoin or crypto, will be much easier. You don't need to spend 10, $20 million for the license. So we actually have a bigger vision, want to become the regulated partner with the traditional fintech company like Visa, banks. So they all want to be partner with the regulated player globally.
Thanks, Darren. Second question. There's a lot of discussion about stable coins, less clarity on real world adoption. Where are you seeing the most tangible enterprise use cases today? And how is OwlPay enabling those flows?
Yeah, we actually see a lot of customer onboarding our platform trying to move the money to stablecoin. So traditionally, they are moving the money in a traditional way. For example, the credit card network or others. Yeah, but right now, if they are moving with stablecoin, the biggest benefit for that is it's very cheap. It's also very fast, and you can handle robust transaction like a couple $100 million in one batch. Yeah, and I also imagine traditional companies like e-commerce, for example, online travel agencies or like Airbnb, they are sending billions of dollars right now to their global BNB owners. So I think in the future, is going to be change. They'll be moving the money with stablecoin, and I think that would be fantastic. And most important, just I mentioned that people can actually send the money like you're sending WhatsApp message in the future. So this is the bigger picture that we want to make it happen.
Thanks, Darren. You've clearly invested heavily in licenses, compliance, and multi-chain infrastructure. At this point, what tells you that the platform is ready to move from build out into higher utilization and monetization?
Yeah, so let me give you an example. When we are finding the banking partner in the state, we actually spend more than 24 months to open a bank account. It's really, really lengthy. And when we are trying to partner with Visa to be their regulated partners, the process also takes 24 months. So I actually had a vision that we want to save everyone's time by open up our tech and license infrastructure to everyone. So you're not competing with other company. You are actually helping the whole industry to grow. Yeah, so imagine we spend 24 months, but right now, if there's a platform for like us, open up the infrastructure, you can onboarding your tech, bank, everything within 3 days. That'd be amazing. Yeah. So this is a mission and vision that how I want to build a company by open out our infra for everyone, not competing with others.
Darren, GPV grew over 60% year over year, which is impressive, this person writes. For investors trying to model the business, how should we think about the relationship between GPV growth and revenue growth over time?
Yeah, so typically our business model is very simple. When you process more volume, and then you can charge certain BPS. And BPS is actually very complicated. Every country, every corridor has different BPS. So we are using average 50 BPS, as the take rate for the company. For example, if you are, transacting $1 billion, then you can make about $5 million, from the average. Yeah, so this is how we actually, come up with the mass transaction volume and then the business model together. Yeah, so it's actually very simple.
You highlighted integrations with the Circle Payments Network and Stellar. From a strategic standpoint, what do those relationships unlock that wouldn't be possible building alone?
Uh, so I think Circle they also have a bigger vision, want to become the new blockchain settlement layer for the regulated finance. Yes. Also, Stellar they are building their blockchain as the regulated players. Yeah, so I think we share the same vision, and then we hope by working together, because we got the merchant, we got the API for business to onboarding with our platform. And then using Circle's payment network when the USDC is traveling to different countries, they can be quickly and easily settled. And there's basically no gas fee. It's just USDC will be using as the gas fee. So I think this is one of the potential global settlement in the future they'll be looking like. And then the most important thing is when the money moves on blockchain, it's much cheaper and faster.
Hospitality and e-commerce are smaller parts of your revenue today, but they seem strategically important. How do these businesses strengthen OwlPay rather than distract from it?
Yeah, so we actually spent the last 6 years working with those online travel agencies. Yeah, so we think it's very critical to talk to those online travel agencies. So we are in the conversation trying to give them the concept how to use the stablecoin to save the cost from the banking part. Traditionally, one of the transaction will cost couple dollars. So imagine you are sending 2 million transaction per month. You're spending couple $1 million per month for those transaction fees from the bank. Yeah, so using stablecoin, we are actually helping those travel platform to save a lot of costs comparing to the traditional banking.
Darren, when enterprises evaluate OwlPay against both legacy banking rails and newer fintech platforms, where do you consistently see them choose Owlting and why?
Yeah, so I'll give a very good example for the US market. So right now, a lot of people, they are sending money with Zelle, right? But if you are using Zelle to send the money, you are actually not able to send the international payment, right? So we had a vision that we want to become the bottom layer for those existing app helping them to settle the money in different countries, not just in the US market. So this is the bigger picture that we want to working with those different other fintech companies, not competing with them.
As payment volumes scale, this person wants to know, Darren, what should investors expect in terms of operating leverage? Where do margins improve first as the business grows?
Yeah, so I think the company actually divided by two stages. So the financial report before 2025, end of 2025, was actually coming from the legacy business from Taiwan. Yeah, but we had actually invest heavily in the last 4 to 5 years. So we think in the future, the majority of the revenue and margin, there will be over 60%, even 70% for the company. And when the money move, we take partial of the transaction for every transaction. So imagine we got all the license in different regions, for example, Japan, US. Whenever there's a dollar moving into Japan, we got partial of the transaction fee. And when there's a Japanese yen moving out of Japanese market, we actually, take partial of the fee. And so imagine we have not just Japanese market, we actually have the global corridors. So this is how we build a business. And the beauty of the business model is we are also open up our infrastructure for everyone. So if you, let's say if you are a company or future prediction market want to enter different market, you can use our infrastructure to get a customer from different countries. Yeah, so I think that that's the business model, how we ramp up, and we also keep the company at a very small team. We have about 200 people, and we're also trying to monetize the usage for AI, trying to improve how we become a more profitable company in the next couple of years.
Final question, Darren. What is the essential value proposition? Why should an investor take an interest in your company today?
Yeah, so I'll give a very simple idea. So in the traditional finance history, originally we became from, we have a check, right? And then after check, it's become credit card. After credit card, it's become mobile payment. And this is actually the new era. And we are one of the earliest movers that using stablecoin and blockchain to help the future of money movement. Yeah, and then we build the largest settlement network globally. So we are not another PayPal, we are not another Stripe. We are actually building the settlement layer for global stablecoin companies. We want them to use our infrastructure for the company. So I think the company will be very similar to, I would say, Visa or MasterCard, but it's going to be the new era of stablecoin.
Thank you very much for that, Darren. For more information on OBOOK Holdings, reach us at 1-800-REDCHIP or email us at ows@redchip.com. Now, our next presenter will be Oren Hershkovitz of Enlivex. He's going to be joining us at the top of the hour, but in the meantime, we're going to show you an interview that RedChip recently recorded with Darren Wang of Owlting. Hello, today we have Darren Wang, the founder, chairman, and chief executive officer of OBOOK Holdings Incorporated, trading on the NASDAQ under the ticker OWLS or OWLS. Darren, welcome to the show.
Pleasure, thank you.
Now, Darren, as you just explained to our team on our onboard, you have a very impressive background across Silicon Valley. For investors, could you share a bit about that background and how it's led to your founding of OBOOK Holdings?
I started my career from Silicon Valley. Actually started from Google, and I started to build a Google News in the earliest time, and then I moved to my own startup company in Silicon Valley during the time. Yeah, and then after I moved back to Taiwan, I started to build this company by embedded Bitcoin as checkout. I met the earliest founder for Ethereum, Vitalik, and then our earliest founder for USDT, the founder for Bitfinex. So that's how I get into the venture by getting the company as one of the most pioneer stablecoin infrastructure company.
You clearly have a very impressive personal history in the industry, Darren. Now let's turn to payments itself. It is a massive global industry, but it's often been described as slow, expensive, outdated, especially for cross-border transactions. Now, how is Owlting addressing this problem?
Yeah, so the reason I entered the blockchain is I started to understand the power for blockchain technology, and by the invention of stablecoin, I realized stablecoin plus blockchain will be the ultimate solution for the fintech in the future. Unlike the traditional payment industry, all the settlement, whether they are the traditional payment company or the new fintech, they're building on the card network to settle the money. So which means the economy the money is still settled by the traditional large players. The blockchain open a new possibility by shifting the new money, which is stablecoin, over different blockchain like Ethereum, Solana, Stellar. So I think that's really the motivation for entrepreneur like me to bring the new technology to the traditional banking system, the payment app, or the payment service provider to use the stablecoin infrastructure.
Now, your company is obviously growing. Your payment volume grew more than 60% year over year. What is driving your growth, and why should investors believe that this is more than a one-year spike?
Yeah, so the philosophy we build the company, particularly using stablecoin as infrastructure, is we want to be the app store in the smartphone, which means we open up our license globally to the fintech company, whoever want to use the stablecoin, or they are building the real world asset like tokenization for stock, real estate, whatever they need. They can use stablecoin as the checkout method to open up all their business to the global customer. So that's why really make me very excited that by providing the most difficult solution to every fintech company builders, they can forget about the problem for of applying for the license, getting the bank account from 10 to 12 months to within 1 week, and then they can use our anti-money laundering or KYC standard to quickly onboard their customer, enter the business. So that's why we decided to build a company as the infrastructure builder, not just one single fintech companies. So we solve all the different problems for the industry by providing the latest technology, licensing framework, regulations.
Now, Darren, stable coins are often grouped with crypto speculation, but Owlting positions them as payment infrastructure. Why are stable coins useful for businesses, even if someone like me never trades crypto?
Exactly. So I think stablecoin is just like the traditional money we use. For example, you used to use the cash to check out in the Starbucks, right? Right now, you can use stablecoin within your wallet app to do the checkout. But for merchant, like small coffee shop, they can save tons of money by comparing to the traditional card processing fees, which is about 3 to 4%. But using stablecoin, the cost is almost 10 times fewer than the traditional card network settlement. Yeah. So I think by providing the new settlement layer, and you can help small business owners to save more money, get more money, and then rebate to their customers.
Now, your hospitality software and e-commerce platforms feed customers into that payments business. Why is that ecosystem important, and how does it help Outing grow more efficiently than its competitors?
Yeah. So we entered the hospitality business by understand, online travel agencies, they are moving tens of billions of dollars every month, but they are still using the traditional banking system. By providing the stablecoin solution to them, they can send the money within seconds, and then the BNB owner, they can receive more money by using the stablecoin as the new currencies. And then the most beautiful part of it is everyone makes more money. The platform makes more money by receiving stablecoin. And then the merchant, the BNB owner, they receive more money by using the wallet to receive the stablecoin. I think that's the beauty for the business by providing the latest stablecoin infrastructure for every merchant in the world.
Darren, it's a new year, 2026. In 2026, what are the most important milestones investors should be watching, whether that's new markets, new partners, or product launches?
Yeah. So today, this year, we have a goal that providing access for stablecoin for everyone in the world. So we're gonna open up the debit card access, so you can use your traditional banking debit card to get a stable coin. And after you get a stable coin, you can use it as the daily payout or cross-border payment using stable coin. So I think that's the most important goal for the company this year, is by providing access for stable coin for everyone using their debit card or credit card.
Darren, final question. What is the essential value proposition? Why should investors take an interest in Owlting right now?
Yeah, so we are more like a stable coin for App Store. The first one is we are providing our licensing anti-money laundering KYC for all the fintech builders. Second one is we are shorten the onboarding time for bank account from 10 to 12 months to 1 week. And third one is we are providing access for stablecoin for everyone. They can use their debit card or credit card to buy stablecoin and then send stablecoin cross-border with the fee almost $0. And then we want to become the Visa for the stablecoin era in the future.
How exciting, Darren. The Visa for the stablecoin era. That's very emphatic and memorable. Thank you for being with us today.
Thank you.
Our next company on today's RedChip Fintech and Digital Asset Treasury Virtual Investor Webinar is Oren Hershkovitz. He is the CEO of Enlivex, ticker ENLV on the NASDAQ. Oren will begin his brief presentation in a moment, and then we'll open this event again to your questions. I'm going to keep everyone's lines muted throughout this presentation. To submit a question, please use the Q&A button at the bottom of your Zoom window. As always, before we begin, please allow me to read the brief safe harbor statement. This segment may contain forward-looking statements within the meaning of the Private Securities Litigation Reform Act of 1995. All statements pertaining to future financial and/or operating results, along with other statements about the future expectations, beliefs, goals, plans, or prospects expressed by management constitute forward-looking statements. Any statements that are not historical fact should also be considered forward-looking statements. Of course, forward-looking statements involve risks and uncertainties. Oren, thanks for being here. Please go ahead.
Thank you very much. Pleasure to be here. So let me start with doing the technical stuff of sharing the deck. Let's see that we overcome that. And then I can go ahead. Okay, so hi everyone. First of all, I'm genuinely excited to be here. This is a fascinating event, very innovative companies, and we're happy to be part of this. So for those of you who are not familiar with me, my name is Oren Hershkovitz. Again, I'm the CEO of Enlivex. I've been the CEO of Enlivex for the past more than 6 years now. over time, I must say that I've seen doing drug development for so many years. I've seen really how hard is it to build a value, and how challenging it is. And sometimes you really need to think out of the box. And what we're doing at Enlivex, I think what I'll show you today is exactly that. How we did think out of the box in order to combine, deep scientific drug development research along with new financial data-driven instruments. So, just to know that there's a little, this is our forward-looking statement. So have a second look at our safe harbor. Okay, so maybe just again, from the context perspective, Enlivex is listed on the NASDAQ, as mentioned here. Our ticker is ENLV.
Okay.
Our ticker is ENLV.
Yeah, I appreciate it, man. Thank you, brother. I'll talk to you, man.
What's going on with
it will be nice if you could mute the participant. Thank you very much. So I want to start this presentation, with giving a high-level overview of what makes Enlivex so unique and different, and what really defines us today, right? So actually, our strategy is built on two main pillars, or actually three fundamental legs. The first one is actually the exposure or the upside participation of Enlivex in prediction markets growth. And this is also rely on our built-in impact engine that we'll talk about today. And the third leg is actually our very unique embedded high-yield option that we'll elaborate as we move along. I think together all of those three legs essentially generate a potential long-term value to our shareholders. And I'll try to elaborate on this presentation, what I mean by that. So we said prediction markets, right? So let's kind of take a deeper dive into what prediction markets are and why we're so excited to be part of what we call prediction markets. So prediction markets are basically markets that are currently using collective intelligence in order to predict the outcomes of events, right? And we'll go deeper into exactly what that means, but what we all know is that it's a sector that is exponentially grow in a way that it's currently maturing and becoming a potentially highly profitable differentiating sector. Now, as of today, Enlivex is the first and only stock that currently provides investors with the upside participation in prediction markets growth, and in a way that has a built-in impact engine. Now, we see this, we actually participate or see the upside of that through our accumulation of what is called a RAIN token, and which is a decentralized protocol relying sit on a blockchain, and eventually is decentralized prediction market protocol, and we'll talk about it again. Part of the strategy is directing some of the gains from the treasury itself, from the RAIN asset treasury, into the development of really breakthrough therapies, which is what we have been doing for several years. And we're designing those therapies, our platform, etc. I know to treat patients with suboptimal, that currently have suboptimal treatment options as of today in billion-dollar market, and eventually generating, potentially better global health. The last point here is really about a very unique option that we have, and I'll take a deeper dive in that in a second. So going back again to a more detailed explanation of what prediction market is and why it is so exciting. So it's essentially, this is a platform that facilitate contracts that value probability of outcomes of future events. And the idea behind it is that participant can buy and sell shares tied to different possibilities, different results that could allow allowing the market as a whole to estimate how likely is that a certain outcome will become for a specific event, will materialize eventually for a specific event. It could be any market, any event that we're talking about. Could be sports or politics. And as you can see on the right-hand side of the slide, the prediction market actually was the one that foresee that Donald Trump will win the election. There is substantial academic research data suggesting that prediction markets as an aggregate information from a variety of sources, so collective intelligence, as we say, could potentially be more accurate than a single source, whether it's an expert or our traditional forecasting models. So this make this markets really a real-time and data-informed forecast about probable outcomes, right? And it is becoming a part of the present and definitely part of the future. So now that we understood the concept of prediction markets, let's pause for a second. And when I'm talking about this, you may think, for those who are less familiar, that this is still a kind of exploratory sector. But what we've been seeing in the last few months is backup and validation of the prediction market sector by institutional investments and top-tier funds. So the two major players in prediction markets are currently what we call centralized prediction market companies, which is Polymarket and Kalshi, worth today billions, as you can see here. Now, as I said, institutional backing of prediction market has occurred in the last 6 months and so, validating that this is no longer an experimental, markets or something like that, validating them as markets that will grow and become substantial part of our present and future. So Polymarket, for instance, there was a $2 billion investment by the Intercontinental Exchange, the parent company of the New York Stock Exchange, in Polymarket, $2 billion fundraising in a valuation of $8 billion, and Kalshi had $300,000 financing at a $5 billion valuation, led by top-tier funds like Sequoia. Actually, in December, there was an additional round of $1 billion and an $11 billion valuation. So clearly, this signals the market that prediction markets become stable markets that you really need to take care into account. Now, so we talked about prediction market. So what is RAIN, right? So, and maybe in order to explain what RAIN is, I'll use an analogy. And the analogy is Netflix and TikTok, right? So all of you are familiar with Netflix. And that Netflix is actually creating its own content, right? It's a content creator that in a centralized way, and Netflix is investing a lot of money, estimated around $2 to $3 billion a year, to generate a relatively limited amount of content. And we all subscribe and we can see the content and we are very happy. And this is one model, right? The other model is the TikTok model, where really the TikTok itself is not generating not the content and not the liquidity, but actually the global users, hundreds of millions of global users, are using TikTok and actually generating the content themselves, right? It could be a 12-year-old girl from Hungary or whatever, generating some kind of content, and people are watching it. So that generates the liquidity. As a consequence, actually, TikTok is not investing money in generating the content, but substantial lower amount of money just to maintain the network, right? And both of them are great. I mean, TikTok are actually for the long tail users, more focused for the long-term users. And essentially Rain is the TikTok of the prediction market, because Rain protocol is permissionless protocol, allowing anyone to create a market and trade over that market. It could be anyone from anywhere in the world, in any language, for any market whatsoever, right? So essentially similar to what we know from TikTok model. Now, the market's eventually outcomes are AI resolved, and the platform is, as I said, governed by the Rain token. And the Rain token is actually even more interesting than that, in the sense that it has a built-in deflationary buy and back burn mechanism, and we'll talk about it because this is a really essential piece. So what does that mean? Okay, so the protocol itself applies, a 5% fee over the total volume of each market. So half of it is allocated to the market creator and the liquidity provider and so on, but half of it is also used in order to buy back the tokens from the open market and permanently burn them, or in other words, to permanently remove them from the market. So as time goes by, eventually the supply and the value of the volume and value of the Rain goes up, there's less and less supply. So you have this scarcity occurs, and eventually to the fact that there is appreciation of that in the token or the coin price. For those of you who are familiar with Binance, this is more or less the same deflationary model as we see as happens there. Now, this applies that a company like us, so Enlivex, which will, as you know, within time, we expect eventually our holding of the Rain token will become relatively larger and larger and more valuable. So to compare again, Rain token to calcium polymarket, again, in Rain, you can use any language. It can occur anywhere from any place in the world, in any language. Anyone can create a market in a simple way. We talked about the liquidity, and it's global. It's not restricted to specific countries. It's not US only in English and so on. It's really, really global. Now, polymarket and calci are great. What we think is that eventually, clearly, prediction market seems to continue and grow in an exponential way. And Rain will live alongside calci and polymarket, just as TikTok lives alongside with Netflix. I think that by this time, hopefully by this time, I was able to convince you that, or at least clarify why we got so excited about taking the upside and exposing our investors into the Rain and the prediction market in generally. And what we're aiming to do is really to drive what we call a dual engine shareholder value. So this will be done by becoming the largest corporate holding Rain and activating it for yield, while continue to develop our breakthrough therapies. And I will say a few words about that as well at the end of this presentation. We're aiming to accelerate institutional adoption of Rain as it becomes the center of global prediction markets. So I mentioned before that we have a really unique differentiating value proposition, and as part of our strategic partnership with Rain, we actually obtained an exclusive option to acquire up to more than $900 million of Rain. This will expire by the end of November this year, but the pricing was at the average of last November, which was 0.0033. This is already at the current, compared to the current market price of the Rain token, is suggesting that there is a substantial increased value of that option And we believe that, we can potentially raise additional money and purchase additional RAIN tokens and this substantially reduced price, generating additional yield and value. So as part of this transaction, we also retained few advisors that help us with the crypto sides, and most importantly, Mr. Matteo Renzi joined our board. For those of you probably familiar with Matteo Renzi, Mr. Renzi was a former prime minister of Italy and is currently an active member of the parliament, and he definitely brings us value in terms of leadership moving forward. So a few words about the clinical development. So this is our legacy operation. Allocetra is our immunotherapy platform that we develop in order to treat the untreatable, in the sense that we're focused on inflammatory indications, either acute or chronic indications, such as osteoarthritis. For those of you who are less familiar, osteoarthritis is a condition where you have cartilage degradation. It's a low-grade inflammatory disease that usually manifestate in the knee or in other joints. And you all know people that eventually go through knee replacement surgery and such. This is usually because of osteoarthritis. Currently, osteoarthritis has no effective treatment. And we have developed our drug Allocetra to treat those patients. We have several clinical studies, with the leading one that we just announced the 3 months and 6 months top line data in this study, clinically meaningful data, statistically significant data, showing relief in pain and improved function of those patients. And alongside with that, additional data demonstrating the mechanism of action of the drug. This is just it's a big slide with a lot of data, but eventually what it implies that we saw from a pain perspective and functionality perspective improvement, which is clinically meaningful, statistically significant, in what we call primary age-related osteoarthritis patient. Very, very excited about this data, and we announced that we continue now into a randomized controlled phase 2b study. And this study eventually will support our pivotal phase 3 studies. Just to kind of summarize this, really, we demonstrate already in 25 clinically meaningful data. We're moving into a phase 3 study now for osteoarthritis. Again, it's a growing market, estimated to currently for a $7 billion market, expected to substantially grow to $15 billion in 2030. And so those two pillars are together generating our shareholder value. And I'll pause here and thank you very much.
Oren, thank you very much for that exciting presentation. We are now going to take questions from the audience. Press that Q&A button at the bottom of your screen and type in your question. If you have we cannot take your spoken questions today, so just use the Q&A button, and we do invite your questions. Oren, we've already received a few. Here's the first one. How should investors most accurately think about your company today? Is it a digital asset treasury company, or is it a biotech company, or some combination in between?
Well, that's a great question. Yeah, I appreciate the confusion. Clearly, this is kind of out of the box, very innovative move. What I can say is that we're entering 2026 with two powerful, I guess, mutually reinforcing pillars, right? The first one is the late-stage clinical development program that we have with Allocetra that I mentioned. Really exciting, compelling, meaningful, durable data. And the other one is the treasury strategy that seeks to harness the potential of prediction markets and the digital assets, anchored in RAIN. And I think you should look at investors should look at Enlivex from both pillars, right?
Oren,
Yeah.
what convinced you that prediction markets represent one of the most compelling next phases of crypto adoption?
Okay, I hope I was able to to convey the what convinced us, but maybe I'll take a step back and say when we evaluated our digital asset treasury strategy, we looked for different assets, different coins, but we wanted to generate something that will really be differentiating and could grow and generate shareholder value. And we definitely chose prediction markets. You can see that it's one of the first crypto, I guess, applications that demonstrate both the structural utility of the concept and strong real-world adoption, which is not speculative anymore. It's really kind of backed up, as I said, by institutionals, and you can already see that there are major, trading volumes, substantial amounts going in prediction markets. And we think that it will continue to grow, and we were totally excited with the added value that the RAIN decentralized protocol provides as complementary to that market. And that was eventually what led us to select prediction markets as part of our upside exposure through the RAIN.
Oren, you have described RAIN as the Uniswap of prediction markets. Could you elaborate on that, please?
Yeah, I didn't have time to go through the presentation, but we did. We are talking about it clearly. For those of you who are familiar with Uniswap, what Uniswap is doing is playing. It turned tokens, I guess, into liquid, more tradable markets, and mainly serves the long tail. And I think RAIN does the same. It plays the same infrastructural role for prediction markets, right? So as much as Uniswap coexists with the centralized exchanges, we believe that RAIN will coexist with the centralized prediction markets. So that's why it's a very, I think it's a very good analogy to Uniswap.
Oren, RAIN's built-in buyback and burn mechanism, it's a central part of your thesis. How should investors think about the relationship between protocol usage and long-term token supply dynamics?
Yeah, so first of all, maybe before I explain that, I did try to explain it through the presentation, but again, you think about this, that the buyback and burn mechanism is, directly linked to the protocol usage, right? And generate token scarcity. And as activity continues to grow, eventually what that means is that you have higher volumes, you have more fees, you have more RAIN tokens being purchased and removed from the market permanently, right? And this creates what we call usage-driven deflationary dynamics, right? So you have growth in real economics activity, which reduces long-term token supply, right? Rather than diluting it, right? Again, for those of you who are familiar with Binance, that's exactly the case there. So the buyback ties the protocol to supply reduction, but this makes us, Enlivex, as a long-term holder, the natural beneficiaries of that strategy.
Many investors are familiar with companies that simply hold digital assets, or how is Enlivex's active treasury strategy designed to outperform simply holding RAIN tokens passively?
Okay. Well, again, we just as a reminder, we have this option, right? That I've talked about, that per our agreement with the RAIN Foundation can eventually could be exercised currently compared to the current price, reflecting a substantial discount to the market. But I think, and this is very unique to DAT companies. I think that there are various ways that we are familiar with to generate value from holding the RAIN token, and as it grows, if we're talking about staking and restaking, loaning them, and so on. So there are various ways to generate yield from holding the asset itself. It's a good question.
About the biotech aspect of your company, Oren. What do you expect from that phase 2B study and the implications on that pivotal phase 3 study?
Okay, so I wish we had more time to take a deeper dive in that. I think we had really exciting results. It's not just we did, we're working with key opinion leaders in the field of osteoarthritis that supports our development, are also excited about that, representing the data in conferences and so on. So the data we generated from the phase 2A study was substantial. It was really clinically meaningful at endpoints, which are what we call the phase 3 pivotal endpoints, right? And now moving into a phase 2B study in this underserved new osteoarthritis patients, I think we're really excited, and we believe that if we just replicate similar data generated now from the phase 2A study, that will support discussions with the FDA, with EMA and other regulatory agencies, and pave the way eventually to pivotal phase 3 studies and ultimately making them accessible globally.
Thank you very much, Oren. If you could just sneak in a quick, maybe 20-second answer to this final question. You highlighted that exclusive option to acquire RAIN at a fixed price through this year, 2026. How should investors think about that embedded option when evaluating your company versus direct exposure to crypto?
Well, I think that's the upside. That's part of the upside that we were talking about. I think I mentioned that already. So clearly we can do additional funding and purchase as part of that option, additional tokens and substantial discount. So it's kind of you can look at that as a implied warrant-like, and I think it has value, substantial value that investors should take into account. Definitely.
Perfect answer in the perfect time frame, Oren. Thank you for taking those questions. We now move on to BNB Plus. Thanks again, Oren. We'll see you next time.
Thank you very much.
Thank you. Moving now to BNB Plus. The presenters will be Patrick Horsman and Josh Kruger. If you're there, gentlemen, let's do a quick sound check. Patrick, we can't hear you yet.
Hello.
Can't hear you.
I'm here. Can you hear me?
Okay, good. And Josh, let's hear from you, Josh.
I'm here.
Excellent. All right, as we promised, BNB Plus. And this is, by the way, RedChip's Fintech and Digital Asset Treasury Investor Conference. We've been going since 9:30 a.m. U.S. Eastern. We're going to go all the way to 4 p.m. today. We're now with BNB Plus, ticker BNBX on the NASDAQ. Presenting today, already here, Patrick Horsman, who is the Chief Investment Officer of BNB Plus, and Josh Kruger, Chairman of the Board of BNB Plus. We're going to begin with their brief presentation in just a moment, then we're going to open up the event to your questions. Everyone's lines will remain muted throughout this presentation, but to submit a question, and we'd love to hear from you, please click the Q&A button at the bottom of your Zoom window and type in your question. As we always must do before the presentation, let's do the safe harbor statement. This segment may contain forward-looking statements within the meaning of the Private Securities Litigation Reform Act of 1995. All statements pertaining to future financial and or operating results, along with other statements about the future expectations, beliefs, goals, plans, or prospects expressed by management constitute forward-looking statements. Any statements that are not historical facts should also be considered forward-looking statements. Of course, forward-looking statements can involve risks and uncertainties. Gentlemen, please go ahead.
Thanks for having us. We're excited to be here. I'm Patrick Horsman. I'll start with a quick bio on myself. Josh will do the same, and then we'll jump into the strategies. I've been a hedge fund manager for 24 years, been involved in crypto asset management since 2018. Josh and I had a prior hedge fund business together that we sold the general partnership of at the end of 24. Started exploring the DAT market, both as direct investors and then as founders. And we started working on this BNB opportunity in June of 2025. We did a PIPE with a company called Applied DNA Sciences in September of 25 and have been running the public company since then.
Joshua Kruger. I'm the chair of the board. I got a computer science background, early in Ethereum, kind of mining when I was in college. Started a hedge fund that did some delta neutral trading back when things were a little different in 2016. And then I've kind of been in the industry since. Did firmware development, and distributed compute. And then again, in 2020, did DeFi funds, which I eventually met Patrick. And the seeds of this strategy here were kind of born in 2020 when DeFi came out. We've since refined them through running subsequent funds and eventually selling them to a larger fund here in 24 at the end. And now we've started BNBX with kind of those core strategies run on in-kind assets, in this case BNB, in an institutional public vehicle.
So I'll start with just a quick overview of the DAT space. And there's kind of two types of DATs. They originally started with Bitcoin. Our view is that Bitcoin doesn't make a lot of sense for a digital asset treasury because it's not a productive asset. You can't generate any yield from it. There's better ways to own Bitcoin, either owning it directly through owning tokens or buying a low-cost ETF, which there's many good options. We think there's a contrast in other ecosystems like BNB, Ethereum, and Solana, where these are productive assets, where high-quality teams like ours can generate yield from those. And basically over time, investors will end up with more tokens than if they bought the token directly through the yield and through the compounding. I'll touch briefly on Binance and BNB and why we chose this ecosystem. For those not familiar, Binance is the largest company in the crypto space. They have over 300 million users. And that's ex-US, so they don't currently have any US customers. But the rest of the globe, 300 million active users, 145 trillion has been traded on Binance since inception in 2017. 34 trillion was traded in 2025. They offer 490 coins available to trade on spot and 584 tokens on futures. One of the most important pieces for us on the yield front is something called Binance Launch Pool. This is something that US investors can't access directly because they can't get a Binance account, at least without a lot of offshore structuring and an offshore trading team. The launch pool basically is Binance's gift back to its BNB holders, where each time Binance lists a new token on the exchange, they take a listing fee. And rather than putting that listing fee in their pocket, they airdrop that to the holders of BNB through the launch pool. Last year, they airdropped 782 million in free tokens. And BNBX has that as part of its yield strategy to capture those airdrops, sell them, and turn them back into more BNB. We had done, prior to launching the business, a 3-year look back on the launch pool airdrops, and it was like a 9 to 14% annualized return from selling them and turning them back to BNB. They also have 20 million merchants on Binance Pay. So the big difference of what makes us different from other DATs, even some that are active in Ethereum and Solana, is that we are a group of DeFi hedge fund managers. We've been running active liquidity management strategies on liquid tokens, some of us for our entire careers. We've run large hedge funds that have done this successfully, and we've designed 4 different yield strategies that are all non-directional in nature. And that's an important component because we're not trying to add risk to the strategy. You're already taking risk by being long BNB. But these yield strategies are non-directional, so they're additive from a yield standpoint, but not additive from a risk standpoint. And we think the 4 strategies combined can generate between 9 and 12% annualized. That will be in-kind and BNB. And over time, as I'd mentioned, investors will end up owning more BNB tokens through BNBX than they would if they just held the tokens directly. I'll turn it over to Josh to run through these 4 different yield strategies.
Yeah. So the BNB chain is Binance Smart Chain, started as a kind of a fork of Ethereum and has since evolved. Can you guys hear me all right, Patrick?
Yep.
Okay. the audio is not blipping. And so the first and kind of underlying base level yield and base layer of yield is staking, native staking at BNB. That hovers around 2%. That's simply staking to secure the network and validate the network and make sure security's there. That's not an extremely high yield, but generally can be stacked with other sources of yield. So it's kind of like the base rate of the ecosystem. And the second core strategy, which is the highest yielding, as what Patrick mentioned, is the function of launch pool, which is distributing tokens to BNB holders. Projects and teams around the ecosystem really want access to that because it just gives them access to the BNB user base, which is 300 million users active, and potentially more that are inactive or periodically active, plus the users that are on the decentralized exchange and the decentralized ecosystem in Binance Smart Chain. So it is kind of like the single largest user base in crypto that's kind of all coagulated around a single thing. And if you were to, if you on a couple year look, a 2 year look back, if you were staked BNB and you had received all those Binance launch pool airdrops, it annualized and sold them like almost immediately. We call it the first hour. That's about a 9 to 14% annualized. In the last 2 years have been realized, and we're projecting it to continue forward. So that strategy is very lucrative and relatively risk-free for LPs and holders, because you're not putting anything at risk outside of just the beta of BNB. You're simply airdropped these tokens and you're given them. So that's the second core strategy. The third is providing liquidity in somewhat of an automated market maker fashion between two like-kind assets. In this case, it'd be BNB and some staked variant of BNB that also receives some of the other benefits earlier. So that is about a 7 to 9% annualized rate that's been verified looking back. And you're not taking any additional exposure because you're in just two BNB assets, and you're earning trading fees when the market swaps between them. And that'd be on the Binance Smart Chain. And then the last is collateralizing BNB, and we borrow stablecoins against it and run kind of typical delta neutral yield strategies, a la what we've done kind of in the past with our crypto hedge funds. That, depending on the borrow rates and the yield opportunities, is somewhat opportunistic, and you do that only when you really do have an opportunity to make outsized return that way. But it is possible, and it does present itself frequently enough to be, one of the core strategies and something we're highly competent at. Let's see. Okay, I guess the last one of the other pieces here is, actually I'll let Patrick run down Binance and the BNB on earnings.
Sure. So in addition to direct exposure to the BNB token and these attractive yield strategies that we are targeting at 9 to 12%, we also believe this is a tracking stock for Binance. Binance is not public. It's very closely held. Chapeng Zhao, the founder, is really the sole owner at this point. He's the 24th richest person in the world. He has no need for liquidity. I believe he'd have a hard time placing the liquidity if he did take Binance public and other good investments. So we think it's very unlikely that Binance gets to the point where public investors have the opportunity to invest. We believe that through BNB, this is kind of the tokenization of Binance equity and is the best direct exposure that you can get. And BNBX and BNB Plus offer the best way to get that exposure and an easy to own NASDAQ equity. And I'm going to walk through a couple of the ways that BNB has claims on Binance's actual earnings. The first is through the tokenomics of BNB. Unlike Bitcoin, Ethereum, Solana, most other coins, which are all inflationary, Bitcoin has a set supply, but most other tokens are inflationary. New tokens are created over time, and the number goes up, share count goes up. BNB started with 202 million tokens, and they've steadily decreased that through a burn mechanism, which means they're permanently deleting from the supply tokens. So they do what's called a quarterly burn. Over the last 12 months, that's been over $1 billion of tokens each quarter. And those are tokens that are essentially being paid for from the earnings of Binance. So by being a BNB holder over time, you now have a larger claim on the total network and the BNB supply because the supply keeps shrinking. The second claim on Binance's earnings, we went through a little bit with the launch pool. Those staking fees are significant, $782 million in fees last year. They didn't take any of those fees for the company. They passed all those through to the holders of BNB. So through these two direct claims on Binance's earnings, the burning of the token and decrease in token supply, and the listing fees, we think this is the closest exposure you can get to having exposure to Binance's broader business. We believe that Binance is likely to enter the US market. We can't predict exactly when, but it's the last very large market that they don't have operations in. They historically did, but the Biden administration kind of ran them out. And we think that'll be a big boon for the business as well. And this is kind of a way to own exposure in Binance and get ahead of that theme, which will likely be very positive for their business overall. Just in comparison, Binance does 40% of global liquid trading every day on centralized exchanges. Coinbase does 6%. So this is a business that's 7 times larger than Coinbase. You can do the math on that and what this company should be worth. And we think it's literally the best business in crypto, and it's the best ecosystem to be associated with. BNB is the 4th largest token in the world after Bitcoin, Ethereum, and Tether. So this is a top 5 token, the best business in the space, market leader, most users, most volume. And this stock that we have, BNB Plus on BNBX on NASDAQ, offers you a way to get that exposure. When we took the company over and implemented this digital asset treasury strategy, they had an existing DNA business. I'd like to touch briefly on that because for a lot of DATs, their legacy operations are a real hindrance and an issue. Our team and the existing team, Beth and Clay, our CFO and CEO, we've done a fantastic job working together to right-size that DNA business. We made a major headcount reduction. And we've taken it to where it's had its first couple profitable months since October of this year in the company's history. And we've gotten some of the largest orders in the company's history, and we've done that with a massively reduced cost structure, massively reduced headcount. We're exploring some strategic alternatives for that business. We may raise some more capital. We may spin it out. We haven't made any final decisions. But we've right-sized that business. It's no longer a drain on the operations of the broader company. And just wanted to put that message out there so shareholders can understand that the operating business is in a good place now and is actually either break even or slightly profitable is our projection. In summary, we think this is a misunderstood, undervalued opportunity with kind of the recent sell-off in crypto. This is a great entry point for investors to come in and get some exposure to Binance and BNB. And we're one of the few DATs offering you direct BNB and Binance exposure, and would love to open it up to questions.
Thank you very much, Patrick and Josh. Yes, we are now opening this webinar up to your questions. Press the Q&A button and type in your question. As we can only take your written in questions today, we ask that you not use the raise hand button, but we certainly do invite your written in questions. And sure enough, gentlemen, we've already received some. First one here. You've emphasized non-directional yield strategies rather than simply betting on price appreciation. How should investors think about the balance between yield generation and long-term BNB exposure?
Sure. So just for clarity, we are always 1x long BNB. So you are getting long BNB exposure. But in addition to that, because BNB is a productive ecosystem and there are opportunities to generate yield, in addition to whatever the token performance is, we can generate that 9 to 12% target yield on top of whatever the BNB token performance is. So you're getting both the 1x long exposure plus whatever the yield strategies are. That yield gets recycled into more BNB, and over time that yield compounds.
That's part of what kind of makes this vehicle asymmetric for investors, is they're getting the underlying beta appreciation plus the yield into the future as if it were to be kind of managed in a hedge fund manner.
Thank you, gentlemen. What does success look like as the Treasury scales? More assets, higher yield, or greater efficiency per unit of capital?
We'd like to hit these metrics that we've laid out, the 9 to 12% annualized yield. That will ebb and flow a little bit. A big component of the yield, as we mentioned, is the launch pool. So we're dependent on kind of new listings on Binance in a kind of market where there's less new listings, the yield will be a little bit lower. When there's more new listings, the yield could be even higher. So we think hitting that yield target is kind of the best way to measure us. And then we would like to grow the balance sheet more significantly into the hundreds of millions over time of BNB holdings and continue to compound this for investors.
Gentlemen, how do you decide when to accumulate BNB versus when to prioritize liquidity and flexibility?
So the nice thing about all of the DATs is even when they're invested in tokens, they're essentially sitting on a very liquid asset. So BNB itself trades about $2 billion a day. So there's zero issue if we need liquidity or we need to liquidate some BNB to cover an expense. That's always an option. So we try to stay as fully invested in BNB as possible. When we were deploying the treasury, we tried to do that through some creative acquisition strategies. And we generally don't sit in cash. We try to buy BNB and get the exposure. But I guess if we thought there was a moment where things were undervalued or we viewed an event coming that could push the market down, maybe we would wait a little bit to deploy. But in general, we're trying to be as fully deployed into BNB as possible, which is our mandate.
Talked about integrating Binance native and DeFi yield opportunities directly into the Treasury framework. What types of opportunities are most attractive today, and how do you manage risk around them?
Sure. So it's the 4 strategies that Josh ran through. I'll run through them just high level again. The first is native staking. That's where you stake your BNB to a validator and help secure the network. That's about 2% annualized. The second is the launch pool. You need a Binance account to do that. We've set up an offshore structure for the company in British Virgin Islands because Binance doesn't accept direct U.S. investment. They will allow a public company like us to be the ultimate beneficial owner, but it has to be through an offshore vehicle. And then we've got an offshore asset management team that trades with Binance because Binance, again, doesn't allow U.S. Investment professionals to trade on Binance. They have to be fully offshore. So over the last quarter, we've implemented that entire structure, and we're in a good position now to execute on the strategy. So the launch pool is the second leg of that stool, and we're looking at kind of 8 to 14% annualized from the launch pool. The third is liquidity providing on decentralized exchanges in the BNB ecosystem, and that's a funny name called PancakeSwap, but it's actually now one of the biggest decentralized exchanges in the world. Does more volume than Uniswap. And there we can provide liquidity through 2 different tokens that both give you long BNB exposure. And we think that's kind of 8 to 9% annualized yield from swap and staking fees. And then the final one is opportunistically when the market makes it available, we can collateralize the BNB, borrow stablecoins, and do very low risk DeFi activities with stablecoins, which inherently are non-directional because they're always worth $1. Josh, anything to add there?
I think that was well said.
Gentlemen, digital asset markets, as you well know, are cyclical. What elements of your strategy are designed to protect shareholder value during periods of volatility or market stress like we're seeing right now?
So the nice thing about having a productive asset like BNB is even in a down market where token prices decrease, we're still generating yield. So where all the Bitcoin guys are just kind of licking their wounds and really don't have any tools in their tool chest to implement, we're still running the yield strategies. We're still compounding your BNB, and we're not selling BNB when it dips. We're not levered. So we're just holding the same amount of tokens. And over a cycle, the token price, we believe, will come back and hopefully will go up. And we're compounding the number of BNB along the way that we're getting and continuing to generate yield and compound the number of tokens per share for investors.
Yeah, and in addition to that, with the exception of native staking, which is actually a return in kind, the other 3 types are actually return in cash and then repurchase of BNB. And so as the BNB price decreases, presumably you're buying actually more BNB tokens, which adds to the asymmetry on the upside when the market kind of returns.
Thank you, gentlemen. Next question. DeFi strategies can vary widely in risk. What guardrails do you have in place to ensure yield generation doesn't introduce hidden balance sheet or counterparty risk?
Sure. As I mentioned, these are all non-directional yield strategies, but I'll turn it over to Josh to run through our risk management framework.
Yeah, I mean, I think largely of the 4 strategies, they're quite simple. There's nothing exotic here that could be done in DeFi and that we have done in the previous hedge fund structures. All these have been chosen because of the simplicity, the tier one status of the underlying smart contracts, and just understanding, they've been running for 4+ years, many audits, backed by Binance directly, etc. And they don't introduce any kind of like odd exogenous proxy contract risks from teams that are unknown, etc. So it's really in the selection of the strategies that most of the risk is managed here, in that there isn't that much risk being taken. There's a lot more stuff you can do in DeFi, which introduces risk looping, and I'm sure you guys are aware of a lot of those things. But broadly, we don't want to introduce that kind of tail risk into this product, as we see. It's really about holding BNB long term and really accumulating long term, and it's more worth it to have more BNB over time than it is to potentially ratchet up the returns, take on some tail risk, and risk losing BNB over time.
Do you internally benchmark your treasury performance against simply holding BNB or against other yield strategies? And how transparent do you plan to be about that comparison over time?
Internally, we're benchmarked against the price of BNB, I suppose, and we're fully transparent. I mean, on our website, BNBX.io, there's a dashboard that describes all of our purchases, the prices, the cap table, and everything about the company that an investor and a DApp should know. So we're trying to be kind of on the front end of being absolutely transparent on there. In the future, there will be more advanced analytics on the yield itself, and what that means directly for token per share, etc. But currently, as Patrick mentioned, we're still setting up some of the offshore things in order to get that fully working.
And gentlemen, final question. What is the essential value proposition? Tell us. Why should anyone be interested in BNB Plus right now?
So we believe it's the exposure to Binance and the Binance ecosystem. This is one of the best companies in the entire space, 7 times larger than Coinbase. You have no direct way, either through public or private markets, to access stock in this company. And essentially, we believe that BNB is the tokenized equity of the Binance ecosystem. And as we ran through earlier, there's several claims on Binance earnings from holding BNB tokens. It's a productive asset where over time we can compound, we believe, at a target of 9 to 12%. And we think it's a very exciting company that's going to continue to grow. And we think it's likely that they enter the US market, and that's going to be significant growth for them. So this is a way to get ahead of, which is one of the best companies in the world in the crypto markets and blockchain space that hasn't even entered the US market yet. And you can own it through an easy to own NASDAQ equity, BNBX.
Gentlemen, thank you very much for that enlightening presentation. For more information on BNB Plus, reach us at 1-800-RedChip or email us at bnbx@redchip.com. Thanks again, Josh and Patrick. We'll see you next time.
Thanks for having us. Bye-bye.
Quite welcome. Thank you. Now our next presenter will be Andrew Cavaghan of Blue Gold. He'll begin speaking in about 4 minutes at the top of the hour. But in the meantime, what we'll do is we'll show you some videos, some informational videos about RedChip products and services. Welcome once again to RedChip's Fintech and Digital Asset Treasury Virtual Investor Conference. Our next company today is Blue Gold, ticker BGL on the NASDAQ. Presenting today is Andrew Cavaghan, CEO of Blue Gold. We will begin with Andrew's brief presentation in a moment, and then we're going to open this event, of course, to your questions. Your lines will be muted throughout the presentation, but you can always submit a question by pressing the Q&A button at the bottom of your Zoom window. Let's get the formality of the safe harbor statement out of the way. This segment may contain forward-looking statements within the meaning of the Private Securities Litigation Reform Act of 1995. All statements pertaining to future financial and/or operating results, along with other statements about the future expectations, beliefs, goals, plans, or prospects expressed by management constitute forward-looking statements. Any statements that are not historical facts should also be considered forward-looking statements. Of course, forward-looking statements involve risks and uncertainties. Andrew, please go ahead.
Thank you very much. Thanks for having me here and this opportunity to meet with your investors. Thank you, RedChip. My name is Andrew Cavaghan. I'm the CEO of Blue Gold. We recently listed on the NASDAQ about 6 months ago, and we're a vertically integrated gold business. Started off physical gold mining, and then have moved into the tokenization of gold, and trying to make that gold useful to people so that you can use it as a form of money rather than just as a store of wealth. So that's what we're about. The business itself has 3 main different areas. So there's the physical mining and trading of gold, the tokenization of that gold onto the blockchain, and then the fintech platform that enables you to spend that gold using credit card, debit card, as well as making direct settlements for payments that you have. At the center of the offering is the standard gold coin, which we successfully launched with our Genesis mint in January this year. The standard gold coin has been so named because we want to establish it as the standard gold token, gold coin. There is a new area of development, the tokenization of real world assets, and we'll come on to that, and gold in particular. But we think it's a very fast, an area that's got potential for enormous fast growth. And that's the reason we're putting investment into it, and we've launched our own standard gold coin. In terms of where we are as a business, from an investment perspective, we've recently received coverage from Zacks Small Cap, and their report is available on our website, as indeed this presentation is as well. And they've given us a target of $20 a share. That's just on the digital side of the business. With the mine, which I'll come on to later, that would add substantial additional value. So this is their analysis, which I'm repeating there. The things that are coming up that we're excited about. So we've launched the standard gold coin. We are looking to list on a number of exchanges over the coming weeks. And on the mining side, I'm actually down here making the call from West Africa, where our mining asset is and where we're in negotiations with the government to resolve the lease dispute that we have on the mining asset. In addition, we're looking at acquisitions of other mines, both in West Africa and in Latin America, all focused on precious metal, gold and silver. And then finally, on the trading side, so where we're buying and selling gold from third-party sources, identifying sources of gold with good provenance that we can buy at a discount to spot, and that generates another opportunity for profit. So in terms of, I think what makes us interesting and special, we're the only company that I'm aware of that is operating in the vertical gold space from mine all the way through to wallet. So by participating, by investing with us and being part of our journey, you are able to participate in the mining, the trading, the tokenization, and ultimately the fintech wallet. We think this presents a very interesting opportunity, a very attractive opportunity for investors that isn't currently out there in the market. We're going very long on gold. We're very bullish on the role it will have to play within both with as a store of value, but also as a useful currency in the future. And that's clearly the thing that we're promoting. A critical thing to be aware of with the tokenized gold is that all of the tokens that we issue are one-to-one backed by physical gold. So it's allocated gold. So for those of you familiar with the physical gold market, there's a big difference between paper gold, which is a theoretical entitlement to a homogeneous amount of gold, and then allocated physical gold. And in our case, it's the latter. So your token has the actual bar number of gold, of the gold bar that you have a share of. If you've got one token, it's 1 gram, and these are kilo bars, either 999% or 999.5, both of which are certified good delivery bars, and those are the bars that we are and will be backing each token with. So the focus over the last 6 months has been very much on launching this new product and the fintech that goes with it. Alongside that, there's been the continued engagement with the government of Ghana and the development of an acquisition pipeline. Both of those offer substantial upside potential beyond what we have in the priced into the stock at the minute. In order to deliver the gold, given that we're not producing ourselves at the minute, we've secured 1 million ounces of gold from a dedicated trading partner based in the UAE, so that we can meet what we forecast to be the immediate demand for this token. The other benefit of setting the business model up to have this vertical integration is it creates a diversified revenue stream, not just the physical mining, but also the trading income. And then there's the economics associated with the sale and the on-ramping of the tokens. And then every time they change hands, there's a very, very small fee that's earned. And then, of course, the fintech revenue that comes from providing or enabling financial services to be provided to the holders of the standard gold coin. And that's where we see long-term probably one of the greatest sources of value for shareholders because of the way that fintechs are valued compared to physical mining companies. My own backgrounds, I've been working in sub-Saharan Africa within the large projects and energy and mining space for over 15 years. Prior to that, I worked in private equity, trained as a lawyer in London. But over this last 15 years, I've raised and invested over $150 million into projects in sub-Saharan Africa. We also have recently hired, as part of this extension into digital, a very experienced chief technology officer who's built and sold 3 businesses successfully in the past, including being the CTO of Barstool Sports. I'll come on to the rest of the team later, but just in terms of the highlights. So the macro problem, I think our macro view, the dollar, the pound, the yen, the euro, all of these currencies decline as inflation erodes value. We're all reliant on governments not printing too much of it. If we put our store of wealth into a fiat currency, we run the risk of it declining. In fact, that is what's happened. So many people have shifted their wealth into other forms of inflation-proof investments, gold being one of them, been very popular as a hedge recently, given the run that everyone's seen on gold. The challenge with gold is if you've actually got physical gold, you've got to store it somewhere, you've got to insure it, very difficult to transport. And there's a trust factor around, is this gold really, what you're saying it is, and so there's the actual usefulness of gold is a challenge, but there's an enormous amount of it above ground. So there's an estimated $12 trillion worth of gold, but way less than 1% of that has actually been tokenized. The tokenization opportunity, obviously, this is one of the themes that I'm sure you've been hearing from other presenters, and we'll hear from additional presenters today. Particularly around stable coins and real world assets, is forecast to grow massively over the next 5 years. You can see the charts there that we've got. The stable coins themselves, of course, rely, in the kind of strict definition of the word, rely on being pegged to a fiat currency. So what we're talking about here is actually a slight misstatement of stablecoin, because it's linked to a commodity, but unlike other commodities, is treated as a proxy for money, or has been over the millennia, and that represents a very small proportion of what is currently tokenized. So a massive growth opportunity is forecast. In terms of tokenized assets, $10 trillion up from $118 billion in 2024. And what we're doing with gold, and we're not the only people, I'll talk about the competition, we think is a very exciting segment for growth within that overall market growth. So in terms of applications of this, as it says here, buy it on your phone, much easier, but very difficult to buy physical gold at the moment. We'll make that easy, because you buy the token that is like a Coke ticket for the gold bar that you've got sitting in a third-party vault. You can spend that token, so obviously very easy to exchange tokens on the blockchain. You can spend that by exchanging with someone else, by spending it through a card connected to your wallet, whether that's a wallet you already have that's got card capacity, or one that you get from us. So that point of sale where you're buying something in a shop, your gold is sold and converted into fiat, and you can buy something. So it means that if you want to keep your day-to-day money in gold, you can do that and access it through a credit or debit card. Alternatively, you can pick up your gold bar at a number of different outlets. So we're starting off with just vaulting in the UAE, but we intend to expand with our vaulting partner. We're in partnership working with Brinks, one of the most reputable and certainly one with the biggest footprint. 120 countries globally have a Brinks outlet where we can store gold. So you can go to Brinks and collect your bar. You'll have your tokens and you can redeem it there and then. You can get physical, you can spend it on a credit card by turning it back into fiat, and you can easily buy it. So just to drill down a little bit more on the standard gold coin. So it's 1-to-1, 1 token to 1 gram. We think that's a much more useful structure than being 1 token equals 1 ounce. So it's about 160. It was up as high as 175, I think, dollars, and that's a manageable unit for someone to use. And obviously, you can exchange decimal places of a token, but that's the basic token. Those tokens are actually being issued by a Wyoming digital asset statutory trust, which is a new vehicle set up by Wyoming. Wyoming is broadly recognized to be at the forefront of digital legislation around the establishment of companies, and the US globally at the front of recognizing and protecting digital assets for investors. So we've set it up in the US, set it up in Wyoming in the US, and that is the entity that issues the tokens. The gold itself, as I mentioned, is vaulted in the UAE, which arguably is one of the safest places in the world to have gold. There's a virtually zero prime rate within the Emirates, and as I mentioned, Brinks is one of only 2 or 3 really globally recognized and accredited third-party storage companies. So fantastic brand there. So the Wyoming Trust owns the gold that sits in the UAE. I should just clarify, as well as issuing the token. The rails itself are built on Base, which makes it immediately accessible onto Coinbase as an exchange. And for those who are familiar with the technology, it's a very versatile platform. Also, my CTO tells me it's not an area of historic expertise for me, so it's something I'm learning about. Of course, one of the big benefits of being able to make payments through the blockchain is the costs are much lower. And I think we've probably all experienced the frustration of making payments through the SWIFT system, and payments get delayed, often for many days. There's high costs involved. So this does away with all of that. I've mentioned the reserves and the redemption already, so I won't belabor that. And the points on the right, I think are already covered. So I think a key slide is around the competitive positioning. So standard gold coin issued by Blue Gold is on the first one on the left-hand side. There are 2 others that have got scale in the market. One's Pax Gold, Pax G, and the other's Tether Gold, XAUT. Tether's really been promoting themselves very strongly recently and seemingly getting a lot of traction. I think the key difference there is that first of all, we're issuing as a publicly listed company, which creates an element of a requirement of transparency and regulation. As an officer of the company, I'm obviously regulated, as are the other officers and directors. So the transparency and reporting around what we've got, what we're doing, and the auditing of everything that we're doing, I think gives investors confidence. There actually aren't, as far as I'm aware, any or many publicly listed issuers of a blockchain, of an actual crypto asset. So we think that's an important differentiator. Tether has a higher denomination. I mentioned the 1 ounce. They're also offshore. So El Salvador, there's less protections than Wyoming and the US. As far as I'm aware, they're on proof of reserves. I think they actually tokenize on a T+30. You send them the money and they'll buy your gold within 30 days. So we do it instantly, and you get the bar number. And then then the attestations from a third party. We're working with one of the big 4 auditors, come in, verify the gold's there, and compare it to the ledger of the tokenized gold to ensure everything is as it should be. Those attestations made public and give confidence. Also, we make it explicitly easy to redeem. We think redemption is critical to trust in gold. The token is really just a proxy for what you have specifically, and your ability to access that is key. Now, we think once people have done it once or know they can do it, the likelihood of them wanting to do it and be lumbered with a physical bit of metal they've got to put somewhere and pay for and insure and you can't take through an airport, is quite unlikely they'll do that. It's much more useful to be able to walk through an airport with a token on your phone and access the gold bar at the other end, wherever you're going. But that's us compared to Tether. I think that's probably the clearest distinction between the two. PaxG is more of a service provider, a tokenization service provider, but what they do is not that dissimilar from what we're offering in terms of the trust and transparency, but it's really tokenization as a service to institutions, not particularly geared towards the retail market, and certainly not to try and make it a functional token that can be spent. And that's really where we're going with this. And no doubt there are a number of others that are in development and are being looked at and may emerge. And our view is this is really a kind of a rush to scale. So we are working to secure institutional buyers of this standard gold coin and to get the market cap of the coin rapidly up. Not only does that create a higher income base for us on a recurring basis, but it also makes the standard gold coin more relevant, more liquid, and I think more trusted as far as retail investors are concerned. So moving on, conscious I'm at the end of my allotted time. So the Blue Gold One app and card are the fintech end of the product, where at the moment you can access it on the web. The app will be launched shortly, and there's a number of fees associated with operating that. On the physical mining side, I've touched on it, but I haven't really spoken about it. So Bogoso Prestea gold mine, 5.1 million ounce measured and indicated resource, with a 14-year life of mine, 250,000 ounce per year production. Very substantial asset. And as I say, the focus of my time down here in West Africa is to resolve the lease dispute with the government of Ghana. But that mine and the production from it is not priced into our stock, as far as I can tell, and would offer, according to Zach Small Cap, a $32 per share on top of their $20 per share target that they've got for the digital business. The way we generate income is set out here. So standard gold coin, it's an on-ramp, and then there's a per transaction fee. The one for using the credit card, there's a rebate. And on the trading side, which is separate from the mining, discount, buying gold at a discount by sourcing it in country or from licensed aggregators, and then selling it with that small margin. So the milestones that have been achieved, I've covered already. We have got funding capacity, got lines of credit in place, and we've got money escrowed for the restart of the mine, 65 million. This is a slide taken from from Zach's small cap report and can be found on our website. So I've mentioned the $20 target, 32 upside on top of that, so 52 in total. The team I've covered, so it's me and my background, Nate Dione, CTO, and then Lawrence Wendell, CFO and non-exec chairman, with a deep mining background based in West Africa. We also have a strong non-executive board and an advisory board with relevant experience, both in trading and in payments. The share ownership, the cap table is about 35 million shares in issue now. With the exercise of the warrants that would bring in a further 132, so it's not for free. That's another 11.5. Small number of private warrants and an equity line of credit that I've mentioned already would take us to 54. Okay, apologies to RedChip for overrunning by 5 minutes on my 20 minutes allotted, but hopefully there's time for a few questions.
Thank you, Andrew, for that most enlightening presentation. As Andrew said, we would love to hear your questions, actually to take them in written form. Press the Q&A button at the bottom of your Zoom window and type in your question. Please don't use the raise hand button today. We're only going to be taking your written in questions, Andrew, of which we have quite a few already. First one here is a central theme from the presentation is that gold has succeeded as a store of value but failed as a usable currency. What has changed technologically or structurally that makes this the right moment to digitize gold at scale?
Okay, well, I think the technology is obviously the blockchain technology that's been around now for some years, and I think is well tried and tested and trusted. But I think the thing that's really catalyzed this is the shifting attitude within the legislature of the US in particular, that doesn't see this as being a fringe or something that needs to be squashed, but something that should be embraced and actually celebrated. So with the Genius Act, it was a very seminal pivot, and so we see this as something that will be much easier to promote and to be widely adopted, particularly within the US. As I say, it's really the only country in the world currently where you can market and sell digital assets, within the strict confines of the law. So that's I think the thing that's made the biggest difference. And the other thing, and this is more of a macroeconomic thing, is
our apologies to everyone. Andrew seems to have dropped off. We're going to try to bring him back on right away. Please stand by. Thank you very much. We appreciate everyone for standing by. This is the RedChip Fintech and Digital Asset Treasury Strategies Virtual Investor Conference. We'll try our best to bring back Andrew Cavaghan of BNB Plus. Of Blue Gold. My apologies, of Blue Gold. And I'm looking to see. No. Andrew is not back quite yet, and we do apologize for that. We'll give him another 30 seconds or so because we are running up to the 30-minute mark, and we're going to be presenting another one of our great companies today. Just give Andrew another moment here to see whether he can come back with any closing thoughts. Okay, we have just found out that Andrew is experiencing a power outage in Ghana, West Africa, where he is based, so he won't be able to return, and we apologize for that. We are now coming up to our next presentation, and we already have Michael Christoph here. Michael, could you give me a sound check and a video and presentation check, please? Michael from Webull, would you please give us a sound check?
I'm here, guys. Can you can you see my screen? I did share it.
Yes, your screen is visible. Your presentation looks great. Will you be sharing video today?
Nope, just going to run through the slide deck.
Absolutely, that is just fine. And we are at the bottom of the hour exactly. Okay. We are very happy here today to have with us Webull and Michael Christoph, who is head of capital markets at Webull, ticker BULL on the NASDAQ. And once again, this is RedChip's FinTech and Digital Asset Treasury Virtual Investor Webinar. We've been going since 9:30 a.m. U.S. Eastern. We're going all the way to 4 o'clock with some amazing companies in the space. Michael's going to present in a moment. Before he does, let me just give you the brief rules here. We want your questions, so use the Q&A button at the bottom of your Zoom window. Type in any questions you have for Webull or any of our companies. We'll be happy to collect them and use them. don't use the raise hand button because we can't take your spoken out questions today. Otherwise, let me get down to the safe harbor statement briefly, then Michael can present. This segment may contain forward-looking statements within the meaning of the Private Securities Litigation Reform Act of 1995. All statements pertaining to future financial and/or operating results, along with other statements about the future expectations, beliefs, goals, plans, or prospects expressed by management constitute forward-looking statements. Any statements that are not historical fact should also be considered forward-looking statements. And of course, forward-looking statements involve risks and uncertainties. Michael, thanks for being with us. Please go ahead.
All right, that's great. That was some fast reading there, but thanks for the introduction. Good afternoon. Thanks for everybody's time. As introduced, I am Michael Christoph, Director of Capital Markets at Webull. Webull, we're excited to be participating in RedChip's FinTech, Payments, Digital Asset Treasury webinar. We're happy to have the opportunity to support our partners at RedChip and engage with the RedChip community of investors. I appreciate your interest in our company and look to spend the next 20 minutes giving you some insight as to who we are, where we came from, where we are going, and then take some Q&A. But first, here's some disclosure for compliance purposes. I'll leave them up here for a moment or two for everybody to review, and then we can jump right into it. All right, moving on. So, diving right into it. All great companies have a vision statement. I'm sure many of you are familiar with us. Maybe you have downloaded the app. Maybe you have an account. Webull is an app-based broker-dealer platform. We service the most important, dynamic, and growing self-directed retail investors. And very simply, we want to be their platform of choice, delivering an efficient, low-cost, easy-to-use, and very importantly, global investment platform. All right, some specifics and company highlights. As a leading digital trading platform, we have over 25 million registered users globally and over 4.5 million funded broker-dealer accounts. The difference between a registered user and a funded account is that a registered user has only downloaded the app and submitted some basic personal information, but they have access to about 90% of the market data that a funded broker-dealer user has access to. We're the only app-based broker-dealer that offers this much market data not behind a paywall. This is a differentiating part of our platform with many obvious benefits, such as client acquisition by converting registered user accounts to funded broker-dealer client accounts, and data collection, which helps us learn more about our client base to better serve them. We have licensed operating broker-dealer apps in 14 countries globally. An expansion of this number and products within those markets is a big part of our growth plans. We offer a best-in-class suite of product offerings. In general, we service a more sophisticated, active retail trader that wants more data, information, charting, and product offerings than are offered by our competitors. This is evidenced by the fact that on average, we are the third broker-dealer account for most of our clients when they have graduated from the basic offerings of our competitors to our more complete and robust offering to support their investing and trading. The strong industry tailwinds are obvious. The rise of retail trading is the biggest change in equity market structure over the past 5 years and shows no signs of abating. If anything, this trend will continue as it is happening internationally as well, and the rise of global retail trading is only just beginning. The demographics internationally are much more interesting than they are in the US and developed markets, and we have aggressive expansion plans beyond the 14 countries we already operate in. The tailwinds in the US continue to be an increasingly accommodating regulatory environment and risk-on market. Paired with this global vision is an understanding of the need for local execution. Each of our 14 international broker-dealers has their own local seasoned management team that understand the nuances of their market and can tailor the Webull offering to their specific retail investor needs. So let's jump into some specifics on the company. Let's start with our global reach and our global management team. Our founder and CEO, Anquan Wang, has extensive technology experience and background, most notably as an Alibaba veteran. Our group CFO is HC Wang. HC is also the CEO of our Hong Kong broker-dealer and was previously at Goldman Sachs. Our group president and CEO of Webull Financial, which is our U.S. broker-dealer, is Anthony Denier. Anthony has over 25 years of trading and brokerage experience on Wall Street. Ben James is our global general counsel and came to us from Kirkland & Ellis. We have over 1,300 employees spread across our 14 broker-dealers globally that are all ran by local management teams with extensive market background in their local jurisdictions. We think it is important for the international broker-dealers to be run by locals that know their markets better than anyone else. Who we are. We offer one of the most robust and growing product lineups in the industry. Our recent addition of futures and prediction markets products have been some of the fastest growing products that we have ever launched and are mission aligned with our more active trader clients. Options continue to be heavily traded by our active trader retail client base and a main revenue driver. Given the more accommodating regulatory environment in the US, we recently brought back cryptocurrency to the platform, and we recently expanded into fixed income. We support our active retail trader client base with some of the best educational material and extensive charting and analysis tools. Also, unique to our platform is paper trading and the Webull community. Paper trading allows us to support novice traders to practice trading, test out new strategies, and get used to the Webull platform without any financial commitment. It is a very popular feature and was recently highlighted in a Wall Street Journal article. Also unique to our platform is the Webull community that allows our clients to communicate with each other directly in listing-specific communities or chat rooms. The self-directed retail investors' number one source of market information is social media and their retail trader counterparts. The Webull community allows clients to engage with and learn from each other. As a fintech, we know what functions our clients are spending the most time on, and the Webull community is very highly utilized. Both functions are differentiating offerings from what our competitors offer and are very popular with our retail client investors. We also have a best-in-class AI offering, as AI assistants are only as smart as the size of data set they pull from. As one of the largest app-based broker-dealers, our size is an advantage. We continue to invest and develop our best-in-class AI assistant as a core part of our platform moving forward. And lastly on this slide, while we recognize our retail investor clients are more active and sophisticated traders, and we cater our product offering to them, we continue to grow our product offerings of investable products through a robo-advisor, retirement accounts, and while not on this deck, the new Trump custodial accounts will also be supported when launched. As many of our current clients evolve and look for a full-service financial service platform, we are maturing into a full-service financial service company. With the generational shift in assets coming from the baby boomer generation, we expect to be well-placed to receive more than our fair share of these assets, with a full-service financial offering of products making that possible. A little bit on our impressive growth over the last 9 years from a basic market data provider in 2016 to a full-service US-listed global broker-dealer in 2025. You can see starting in 2021, we began our international expansion. As previously noted, bringing the app-based self-directed US broker-dealer experience and products to our international broker-dealer clients is the next step of our growth plans. We intend to replicate the success we have had with our US broker-dealer in each region we operate in, and more to come, while at the same time expanding and improving our U.S. product offerings. Some basic data and metrics around the growth we have seen, highlighting specifically the growth in funded accounts globally and customer AUMs, and also our quarterly retention rates for funded accounts. DARTs, equity notional volumes, and option contracts continue to be strong. We are proud of the numerous awards and industry recognition we have received over the past few years in comparison to our peers. There were actually too many to fit on this slide, and most recently, Webull was voted Best Investment App for 2026 by Money.com. And probably more importantly, our users have awarded us the highest app rating amongst our peers. So now I'd like to get a little more detail on our products and technology. As you can see here, we offer one of the widest investment product lineups in the business. Many of our competitors focus on one or a few product areas with multiple gaps in their product lineup. Webull clients are offered a one-stop investing and financial services platform. Options continue to be our #1 revenue generator. We continue to expand our already very successful event contracts and futures business and continue to build out our fixed income offering. Cryptocurrencies trading were just recently brought back to the platform, where we offer trading in over 100 coins with staking coming soon. Also likely to come soon are mutual funds and private company investment products as we round out our product offering. As a full-service financial services company, we also offer cash sweep and money market funds as a cash management tool, and a full suite of investing products in terms of a BlackRock ETF-powered robo-advisor and managed IRAs. Most importantly, we intend to build on the success of delivering these U.S. financial products to U.S. retail investors by offering them to international retail investors through our growing number of international broker-dealers. We also continue to optimize the U.S. retail investor experience. While our core client is a more experienced active trader, we do have many of our newer retail investor clients that are novices. They prefer a cleaner user interface and experience. To accommodate them, we launched Webull Lite. Webull Lite offers access to all of our investing products through an easier client navigational experience. With less clutter and distractions, the new investor is able to engage and learn in a less intimidating environment and eventually upgrade to the full Webull offering by easily toggling over directly in the app. While the majority of our clients engage with our platform through the mobile app on their phone, and we are an app-first offering, many of our high net worth retail clients and very active traders also utilize our robust and successful desktop native and web platform offerings. And finally, I'd like to conclude with a few slides on our key business metrics. The third quarter 2025 information on registered users, funded accounts, and quarterly retention have already been covered in this presentation. I'd like to highlight the trends on these two charts regarding registered users and funded accounts and the consistent growth we have been able to achieve in both segments over the years. In just 4 short years, we have doubled the number of registered users, and our funded accounts total is up 40%. Even more dramatic is our growth in AUMs. After rapid growth during COVID, AUMs then drifted down to a post-COVID low of $5.9 billion. We have since seen tremendous growth in AUMs to $21.2 million at the end of the third quarter. Also noting that AUMs also almost doubled over the first 3 quarters of 2025 as new products and international expansion tailwinds have kicked in. We now have 4 regions with AUMs over $1 billion: the US, Hong Kong, Singapore, and Canada. And we are optimistic on growth prospects of others going forward. We spend a lot of time talking about new products and international expansion, but I'd also like to highlight the consistent growth we have seen from our 2 core products, equity trading and options contract volumes. The growth and trends speak for themselves. 71% year-on-year growth in equity notional volumes and 24% year-on-year growth in options contract volumes. And finally, a little dive into operating expenses. As you can see, our expenses have risen in accordance with growth. This is primarily driven by expansion into new markets and products that we ultimately leave us better positioned for further growth. So in conclusion, 2025 has been a big year for us at Webull. We have seen tremendous growth by all metrics. We became a listed company and expanded our US product lineup and continue to grow internationally. But we feel like we are just getting started and look forward to what 2026 has in store. We will be releasing 4th quarter results at the end of February or early March, and further inquiries can be directed to your contact at RedChip, who can put you either in touch with us, or you can always submit a question or comments at our email address, ir@webullcorp.com. So I think with that, we can move into some of the questions.
Thank you, Michael, for that most enlightening presentation. We can now begin with your questions, as Michael said. Type in your question after clicking the Q&A button at the bottom of your Zoom window. As we can only take your written-in questions today, we ask that you not use the raise hand button, but we certainly want your written-in questions. We already have many questions for you, Michael. Do you foresee Webull supporting corporate clients or providing infrastructure that enables companies to manage, custody, or deploy digital assets as part of their treasury strategy?
So that's a great question. So yes, we do have a small but growing institutional business. It's mainly focused around transaction, clearing, and custody of our equity lines of business. However, we do think it's scalable and hopefully will allow us to expand to other products, digital assets, and other institution and corporates as well.
As you made so clear in your presentation, Michael, in a very short time, you've expanded into corporate bonds, prediction markets, higher level options, and crypto. And again, all of this since, what was it, 2016?
Yep. At 2016, we started trading in 2019.
Right. Now, which of these products are showing early signs of becoming material revenue contributors versus primarily engagement or retention tools?
That's a great question. Each product provides value in its own way. I would say higher level options are currently the biggest revenue driver out of those products. Crypto has the potential to become a significant revenue driver. We recently just brought it back to the platform. So once full functionality is live by the end of 1st quarter, we look for some tailwinds there. Corporate bonds, generally a high net worth client AUM acquisition product. Obviously, many high net worth individuals have bond holdings. Not being able to support that product would preclude them from opening an account and moving assets to the platform. Prediction markets, definitely revenue being generated, strong growth. But more importantly, we've actually seen this product support client attraction and re-engagement. We have seen many dormant accounts reactivate to engage with the product. Obviously, client acquisition and dormant account reactivation are usually very expensive undertakings. So being able to achieve this with a new product that will actually bring in new revenues while avoiding costs is a major benefit.
Michael, as you made so abundantly clear in your presentation, you've consistently emphasized technology and user experience. How do you ensure that innovation stays closely aligned with what users actually need?
So innovation, one of our top priorities, and that is evidenced by, I would say, how often we update our app. If you look in the App Store, we update our app on almost a weekly basis. That's in comparison to competitors that operate kind of on a monthly, semi-annually, annual upgrade schedule. Again, our app is updated almost every week. So we're continually evolving, continually moving the product forward and making it better. We do use a large amount of feedback from the Webull community, behavioral feedback from interaction with the app. And the new AI offering is starting to provide a lot of feedback that guides our innovation and our upgrades.
As again you made clear in your presentation, Michael, you're now live not just in the United States, but in various new regions, Europe, Latin America, the Asia Pacific. Which of these markets are currently self-funding from an operating standpoint, and which still remain investment heavy?
So we have 14 operating BDs around the world, more coming. As I guess noted here, it takes extensive investment of both time and resources to get them up and running. We look at this as a major advantage in comparison to our competitors in this regard. What I would say in terms of self-funding to investment heavy, we have 4 geographies currently out of those 14 that have AUMs of more than $1 billion. The US, Canada, Hong Kong, and Singapore. So we're optimistic that the rest will all eventually move from investment heavy to self-funding.
Now you're obviously broadening the platform, and as that happens, Michael, how do you decide whether to deepen functionality for active traders or just simplify experiences for the newer or the more global users?
So yes, we heavily lean in to our active trader client base. We provide a lot of products, we provide a lot of information, we provide a lot of data on the app. At the same time, we do recognize the importance of newer investors. And that's why we introduced the Webull Lite version. Webull Lite, it feeds the top of the client funnel. And it's important to note that clients can toggle back and forth between each setting on the app. So as a Webull Lite user becomes more comfortable and they want more, they can easily access it.
As you've been mentioning, Michael, the platform is expanding across asset classes and, of course, geographical regions. What, in your opinion, are investors still underestimating about Webull's long-term earnings power?
100%, they are underestimating our global growth prospects. By introducing the U.S. investor experience internationally, we're going to leverage what we've built here in the U.S. So we're seeing this in live time as we add new products to the regional apps that are successful in the U.S. and they become successful as there as well.
You're expanding. What has surprised you the most among these ex-U.S. users about how they use your platform?
So I think the surprise here is not that they're different in any way. In fact, the surprise is how similarly they engage with the platform with regards to what they find important, whether it's trading products, whether it's functionality. I would say one of the best examples of this is multi-leg options trading in the UK. So about a year ago, our CEO, Global Corp CEO, was talking to the UK CEO about introducing multi-leg options trading in the UK. And the UK CEO was fairly resistant, was talking about them having access to CFDs and didn't really think there would be product take up. So, he was pushed to add the multi-leg options, and it's actually become their biggest revenue generator. The second part of that is participation in the global community. That community, that listing specific community or chat room for every single listing is very highly engaged with in the US, and similarly from our international communities as well.
Michael, with the rollout of Vega, what concrete user behaviors are you trying to change? Would it be trade frequency, holding periods? Would it be product adoption? And how will you measure whether AI is actually driving incremental monetization?
So for the first part of that, we aren't using AI to change behavior. We're using it to help educate, guide, and improve the client's trading and investment experience. As AI becomes more ingrained in the experience, I guess monetization comes from higher feature adoption, improved retention, and deeper platform engagement, and that'll all be a product of AI implementation, and should lead to increased monetization.
Longer term, Michael, do you view AI primarily as a decision support layer or as infrastructure that reshapes how market data, risk controls, and personalization are delivered across the platform?
All the above, I suppose. We view AI as a core infrastructure for the platform in the long run. Undeniably, AI is the future of investing, right? As market participants, regulatory bodies, compliance gets more comfortable with its usage, I guess we expect to serve all of those functionalities and more.
What do you see 3 to 5 years out? What is success going to look like for Webull?
So our number one goal has always been customer satisfaction and success. If our clients succeed, we succeed. Putting the customer first has been a core part of our delivery for the US product. Doing that on a globally scaled platform will make Webull the platform of choice for investors worldwide. And I guess that's how we would evaluate success.
If you could give the value prop 30 seconds or less, what would it be for Webull? Why should I care?
Listen, the value proposition for Webull is we have a product offering that's been highly successful in the US. We continue to build on that product, but at the same time, we're going to export that experience, that US self-directed retail trading experience to the international community. We have economies of scale. We have 800 technologists that support those broker-dealers, including the US broker-dealer. There's economies of scale from the way the corporation is set up, and we have a head start. Like, as I noted in the beginning, setting up international broker-dealers takes time, and we're already there. So now we're just going to build on that.
Perfect encapsulation of your great company, Michael. Great presentation, great answers to those many questions. Thank you to our users for submitting them. If you want more information about Webull, write us at bull@redchip.com. And of course, you can call us at 1-800-RED-CHIP. Michael, thank you very much.
Thank you. Appreciate your time.
All righty. Anytime, Michael. All right. Next, we've got Oxbridge Holdings. We've got Jay Madhu of Oxbridge. He is with us. And if we could do a quick sound check, that'd be great. Hi.
Hey there. Jay Madhu.
Jay, nice to see you. I hear you. Will you be presenting your presentation today?
Yes, I would.
All right.
Thank you.
Let's put that up. Make sure it's working.
I'm sorry. Is that something I need to do, or do you guys have that already?
Oh.
Oh, there we go.
Okay. There we go. We are doing it, I guess. It is up. It looks fabulous. And yeah, we're moving it up to page 1. Excellent. We are ready to go. Jay, if you are ready to go.
Yeah. So,
Okay.
Jay Madhu, CEO, Chairman of Oxbridge.
Jay, I'm so sorry. Before we start, just for legal reasons, we need to read the safe harbor just real
Please.
briefly. I do appreciate it. This segment may contain forward-looking statements within the meaning of the Private Securities Litigation Reform Act of 1995. All statements pertaining to future financial and/or operating results, along with other statements about the future expectations, beliefs, goals, plans, or prospects expressed by management constitute forward-looking statements. Any statements that are not historical facts should also be considered forward-looking statements. And of course, forward-looking statements involve risks and uncertainties. And just before I let you start, Jay, this is Jay Madhu. This is Oxbridge Holdings, ticker OXBR on the NASDAQ. And you have tuned in to today's RedChip Fintech and Digital Asset Treasury Virtual Investor Conference. We've been going since 9:30. We are going to wrap up at 4 p.m. today Eastern Time. Now, Jay, I apologize. Please go right ahead.
Yes, absolutely. So thank you for having me on. So I'm going to do it slightly differently, right? As opposed to going through a number of different slides, which I think sometimes is fabulous, but at times doing what we're doing, it gets a little lost in the shuffle. So I'll just talk about our business and just kind of go through that, and I'll flash a few slides as we go forward. Jay Madhu, CEO, Chairman of Oxbridge. We're a NASDAQ listed company. Ticker symbol is OXBR. My background is capital markets. I've been part of 5 companies that we've taken public, 3 on the New York Stock Exchange, 2 on the NASDAQ. The most notable one is a company called HCI Group. Ticker symbol is HCI. One of the founders of that company. We started that company about 19, 20 years ago. That's an insurance underwriter out of the state of Florida. We started that company with $10 million, took it public with another $10, $11 million capital raise the next year. So what started off as $2.50 today trades at about $160. That company is an insurance underwriter. It brings in over $1 billion in revenue, makes over $100 million in profit, 500 or 600 people that work for that company. That company, through that, we incubated another SaaS type of company, SaaS model company in the insurance business. We incubated that for over 10 years, spun that out at a $2 billion valuation about 60, 90 days ago. That company is called Exio. It's listed on the New York Stock Exchange. So background is capital markets, growth companies, started companies, done well with those. We are now on Oxbridge. Oxbridge is a reinsurance underwriter. We're based out of the Cayman Islands. What we have done over the last few years is we've taken a small twist with the way reinsurance is distributed world over. In our opinion, this is probably what's going to happen as it goes forward, right? We have a little bit of a first move advantage. So reinsurance, what is reinsurance? Reinsurance is basically insurance companies buying policies or buying reinsurance and laying off their risk to large institutions, Lloyd's of London, Berkshire Hathaway, those type of companies. We are one such company, but obviously much smaller. We are in the homeowners insurance / reinsurance business. What we have done over the last few years is we have taken something that has been going on in the world for decades the same way. We have moved it into the blockchain space. So we've democratized opportunity basically. So what we've done is, as opposed to us putting only our capital to work and a select few folks are getting access to this opportunity, we have democratized it by taking other people's capital, putting it to work with ours, and putting that money into reinsurance contracts through our subsidiary called Surance Plus. Surance Plus is also out of the Cayman Islands. We take an outside capital, issue a tokenized security, and that, as we go forward, will be on the Solana blockchain. So bring in capital, issue a tokenized security, and the monies are then downstreamed to write reinsurance contracts. That's basically our business. We have democratized an opportunity that typically would take $10 to $20 million of capital to get a seat at the table. We have democratized it by making it accessible to the general public. So anybody in any part of the world can log into our system, sign up, do their AML and KYC. That's paramount, right? We're publicly traded. You have to make sure AML and KYC is taken care of. Do their AML and KYC in close to 3 minutes, send in their monies, and now they have a seat at the table in a reinsurance contract that probably they would have never had an opportunity to do so. So I'll pause over there. We'll pull up some slides. We have a couple different slides. And the reason I want to pull up the slide is because most of the time people talk about this business is chaotic. It's, you know, they're so used to seeing social media and so on, and they show only the bad. But the reality, a tremendous amount of data exists into. You don't really have category 3s or above all the time. Category 3 is 112-mile-an-hour winds, and 112-mile-an-hour winds is what does damage. So, Drew, if you'd bring up one of the slides, please. The other one. This particular slide talks about hurricane history in the state of Florida. Why Florida? Because Florida has the most occurrences of category 3 or above hurricanes. And a category 3 is what does damage. So in this over here, since 1952, you'll notice we haven't had severe storms or severe hurricanes every single year. A few things have to happen. A, it needs to be a category 3. It needs to make landfall. B, it needs to be 112 miles an hour in category 3, and it needs to, and C, it needs to hit an area that is populated. Florida, you have a lot of population in Florida, but it's concentrated in various different spots. Majority of Florida is swampland. So since 1952, the numbers in orange over here talk about the number of hurricanes that have actually hit the state of Florida. So when you take a look at this particular slide, you've seen a number of years nothing's happened, but then you do see, well, some years you've had multiple hurricanes that have hit the state. So what I want to point out is 2023. So in 2023, we did have a category 3 or above that hit the state of Florida, but we didn't have policies. We didn't have very many policies in that area. So what happened was, while there was devastation, the third rule, which is it needs to be in a populated area, that didn't get taken care of over there, right? So we targeted a 42% token in that particular year. We paid out 49% return. Next slide, please. This particular slide that talks about perception versus reality. Perception versus reality. Every year, the University of Colorado comes up and they talk about the number of storms that are going to hit the state, or the perception, right? And so as an example, last year, they expected 24 storms to hit the state of Florida, with 3 major storms hitting the state. Well, the reality is nothing happened. And that was a fabulous win. Similarly, you see on this slide the number of years that they come up with various amounts of data as to the severity of the situation. But the reality is a category 3 is what we should be looking at, because in our business, that's what does damage. And in this particular case, in the state of Florida, category 3, hurricane reinsurance, if it doesn't make landfall as a category 3, and if it doesn't make landfall as in a populated area, it's an unfortunate situation. There will be some damage, but for our business purposes, it doesn't affect our reinsurance contracts. So we'll take the slides off and I'll just kind of talk through what we're doing now. The opportunity of what we're doing is reinsurance is a $700 billion TAM market. In this business, majority of the folks, they don't know what reinsurance is. And the reason they don't know what reinsurance is because they've never had an opportunity to buy it. Barrier to entry is significantly high. You need in excess of $10 million, $20 million to even get a seat at the table, to have access to it. B, individuals don't need to buy it because anything to do with the word insurance, somebody buys it on their behalf. You get car insurance, your car insurance company will buy reinsurance on their entire book. You buy homeowners insurance company buys reinsurance on their entire books. Our business is investing in that elusive product of reinsurance. Over the last 3 years, we've taken a twist into the blockchain space. What does that mean? We've taken our business, which was done over the last several decades by various number of companies, we've taken it into blockchain. We actually democratized it through Assurance Plus. We give access to the general public world over to gain access and get into this investment directly alongside us, alongside a publicly traded company. Square pegs and square holes. And what we do, what does square pegs and square holes mean? We write excess of loss reinsurance, and the reinsurance, and the reinsurance that we write 1-to-1. We don't put any leverage on this. We take actual reinsurance risk. People sending in their monies, put that money, it's a hedge fund model, right? So you put your money alongside ours, we turn around, write reinsurance risk, and at the end of 1 year, the reason 1 year is because reinsurance contracts are all 1 year. At the end of 1 year, we pay out that return based on the experience of the contract. Last year was our first year where we issued 2 tokens, one targeted a 42% return, a second one targeted a 20% return. Both of them worked out really well. Reinsurance season is June 1 to May 31st of the following year. However, reinsurance season is May 1 to November 30th. Well, we're well past that November 30th season, right? What's this timeline? So no hurricanes. It's turned out really well. The 20% is tracking about a 25% return. The 42% is tracking a little north of 42%. So as we go forward, we'll look to grow this opportunity in 2 ways. We look to getting more people involved and bringing in capital and putting it to work and giving them access to this elusive opportunity. And instead of putting in 10, 20 million bucks, someone can put in as little as $5,000. Log in, AML KYC, send in their monies, and they're live, right? That's the premise under what we're doing. This year, we are moving on to the Solana network. The reason we're moving on to the Solana network is because the opportunity to grow that opportunity for us as Assurance Plus is higher because there are several more DATs in the Solana ecosystem. And the thought process is there is an opportunity for Solana DATs or anybody investing in the Solana ecosystem to take a small piece of our opportunity to invest in reinsurance contracts in the RWA of reinsurance that is now going to be done on Solana, on the Solana chain, and they can pick, do they want the 20% track of returns or they're looking for the 42% track, right? It's all about what somebody wants to do in their portfolio. So we're very excited about what's going on. We're rolling this thing out. We actually just rolled it out. We haven't made an announcement, but it's all up there. We'll be making this announcement here soon by the end of the day. So actually, sorry, take it back. We've already done that. We will be rolling this out to anybody that has interest, provided AML and KYC is taken care of. They can now invest in reinsurance contracts, the RWA, through a publicly traded company. And this is all online, AML, KYC on blockchain rails. So I'll pause over there and turn it over for questions from yourself.
Yes, thank you, Jay, and thank you for that great presentation. As Jay said, we aren't taking your questions now. We are taking your questions now. If you have a question, click the Q&A button at the bottom of your Zoom window and type in your question. Many have already done so, Jay. I've got one here for you. Can you summarize Oxbridge's business model in simple terms and how the reinsurance business and Assurance Plus fit together?
Yes, absolutely. So Oxbridge is publicly traded. Oxbridge, through its subsidiary, the reinsurance subsidiary, is in the business of writing and underwriting risk in the reinsurance space. Assurance Plus, the subsidiary of the holdco, takes that risk and makes it available to a diverse group of folks, provided they can AML and KYC is taken care of, and it democratizes it, puts it out over there, makes it available in smaller increments. So while Oxbridge or its reinsurance company is the risk taker, Assurance Plus is what gives folks it allows folks to invest in that conduit.
Jay, what are the top priorities for the next 12 months, and what milestones should investors watch to measure your progress?
We're calling this Insurance Plus 3.0. So Insurance Plus 3.0, we're doing everything that we have continued to do in the past, which is writing reinsurance. All we've done is we have moved it forward in a very elegant way, right? So Insurance Plus, initially, Oxbridge Re was writing reinsurance contracts. We took our capital, we put it to work, and we made a return off of that. We rolled out Insurance Plus. Insurance Plus democratized that opportunity and put it on chain. This year, we're excited about rolling this out on the Solana ecosystem, but in two ways. We're going into year 2 of our tokenized opportunity, which is the 42% return and the 20% return. Very excited about that, because the way we are doing this is we have tied up with a company called Alpha Ledger, phenomenal guys. Solana actually has an investment in Alpha Ledger, so we have a lot of commitment from that Solana ecosystem through them, as well as others.
What are the biggest strengths that differentiate you in the reinsurance market today?
The reinsurance is a $700 billion TAM market, right? It's a huge, huge market. To put that into perspective, the stablecoin business is about $250 billion. What we're doing is we're not trying to reinvent the wheel. We're not trying to reinvent reinsurance. All we're trying to do is change the way this asset as a security is distributed and made available to more folks. So again, I keep coming back to the square pegs and square holes, right? So AML KYC is paramount, clarity is paramount, security is paramount, and the other opportunity is availability. Most folks can't write that $10 million check, but they can write a $5,000 check. They need to make sure wherever they're sending their money, A, it's secure, it's safe, and all the various different square pegs and square holes are taken care of. But B, they need to make sure that if they're writing or if they're investing in reinsurance, these reinsurance contracts that we write are called excess of loss, which means they take direct reinsurance risk in insurance companies, right? So we're not writing parametric risk. We're not doing any derivatives. What we're doing is rifle shots. We're taking rifle shots into reinsurance contracts like the large boys, right? Lloyd's of London, Berkshire Hathaway. That's exactly what they do, and this is exactly what we're doing. We're just changing it and making it available to a broader audience.
This person wants to know, where are you seeing the best opportunities to write attractive risk-adjusted businesses in this renewal cycle?
So, that's actually a really interesting question. It's very complex. It's a very simple question, but it's a very complex answer. And I'm going to try to sum it up. The reinsurance contracts that we write are centered in the southeast, around the southeast region of Florida. Majority of our business is in the state of Florida. The reason we do that is because we understand the state of Florida. We're a small company, right? We're not a massive multi-billion-dollar company. We're a small company. So as a small company, we take a look and we can pick and choose where we want to go, right? Opportunistic. One would say you should probably write business all over the world, because then you'll have dispersion. You'll have stuff, in the Far East. You'll have stuff in Europe. You'll have stuff all over, the U.S. and across all the way to California. There's an argument to be made for that, but the counter argument for that is what we have lived and seen in Britain and gone through it. So in the past, we looked at having massive dispersion all over the world. That particular year, we had tsunamis in Japan. We had winter snowstorms in Europe. We had a hurricane in Florida, and then we had wildfires in California. Absolutely catastrophic. So what we did from there is we said, stick to your knitting. We understand the state of Florida. Florida is the 14th largest economy in the world. We understand that space. We've been in that space for the last 20 years through my background with the other insurance underwriter. And we understand the players, we understand the way things are done, et cetera, et cetera. So we now write only the state of Florida. with majority of our business being the state of Florida and some in the Southeast. In terms of dispersion, we think the opportunity lies in Florida. Why Florida? Because in terms of risk reward, Florida contracts, for more than one reason, are priced at the highest, right? So you have various different reasons as why pricing would go, but that's a really, really long conversation. We won't get into that. We'll just go and say Florida has the highest pricing that's afforded to reinsurance. To put that into perspective, 45 cents out of every dollar an insurance company takes in goes towards paying reinsurance. It's the single largest expense item, and that's the business we're in, right? That 45 cents goes to paying companies such as us. So the opportunity, in my opinion, is Florida hurricane risk or Florida peril risk. Doing it the way we do it, we not only democratize it, but we give folks access to an asset class they've never had an opportunity to get into because A, you can't buy it, you don't need to buy it, the barrier to entry is so high, but through strict compliance and transparency through our company, and again, we don't put leverage on this. This is written one-to-one. Someone has access, their money's come in alongside ours, and we write this. So where's the opportunity? Florida reinsurance.
How does the fully collateralized structure improve risk management and help you compete for business?
So fully collateralized. So fully collateralized means if we take on a contract for $10 million, we need to put up that amount of whatever our exposure is into that contract. We have to put it up in cash. That's a fully collateralized contract. So we write contracts, we put up cash in order to take care of any liabilities that would extend from that. That monies are put into trust accounts. So currently they're put into large US institutions. And I say US institutions because I want to give folks the sleep at night kind of thing. These are large institutions, US institutions that monies go into. So the collateral goes into let's say Truist. Currently we're with Truist. The monies stay in Truist account. They take care, the monies go in over here, and at the end of the year, the experience is paid out. So writing reinsurance as a collateralized reinsurer gives us a seat at the table because there are various different parties that write it on a rating. But with a rating alone and not actual cash backing it up, you have counterparty risk, right? So things could potentially go wrong, and they've gone wrong in the past. I'm not saying it'll always go wrong. Very rarely things go wrong, and when they do go wrong, they go wrong in a bad way. So as a fully collateralized reinsurer, not only do we get a seat at the table, being the size that we are, but we also have an opportunity to write some solid contracts because we have de-risked that reinsurance contract. We are not writing this with a rating. We are actually putting up cash. So being a collateralized reinsurer gives us the opportunity not only to get solid contracts, but also gives us an opportunity to look at things that most people potentially may not have had an opportunity to get at.
Jay, what does a high quality book look like for Oxbridge, and how are you improving the mix over time?
High quality book, would be saying a book of business that we've never had, that we should not ever have to pay out on. That's a high quality book. But unfortunately, that book doesn't exist. And if it did exist, we would not exist because people wouldn't have needed our services. So a high quality book actually exists where the risk is carefully underwritten and thought through. The risk is dispersed. So in the state, what does that mean? I just talked about dispersion. We don't want dispersed. The kind of contracts we're writing is in the state of Florida. So the contracts that we write, we make sure our cedants or the companies we are reinsuring they have a dispersed risk throughout the state, right? They don't have heavy concentrations in certain areas. That in itself is somewhat hard to do because when you take a look at the Florida population, you have pockets in where people are, right? So you have in the south, you have Miami-Dade area, then you have Naples and so on. Then you have then you have various different places above. Then you have above Naples, you have Tampa Bay, and then you go down to the Panhandle and so on. So these are concentrated risks as we see. But even in concentrated risks, you need to make sure that the business that you're writing is well dispersed. So even though a company has risks in all these areas, you want to make sure they don't have heavy concentrations in one certain area. So a good book, it looks like a company that we are reinsuring that has dispersed risk in the state of Florida. B, the type of risk that they're writing, we underwrite that heavily because we take a look at a tremendous number of data points on a book of business, right? And part of that data point also is the construction of the actual rooftop. It's a serious science. So we take a look and make sure that their book meets our strict guidelines. So a good book of business, what does success look like? Dispersion, quality underwriting. We're careful with who we write because we want to make the size of business we have that ability to do that, right? So if you have the ability, make sure you're writing the good stuff. So quality of business, the companies we're writing business under, those are all key criteria for our underwriting.
What are the clearest drivers of book value growth that you are expecting over the next 4 quarters?
Growing Assurance Plus. So Assurance Plus, we have Assurance Plus is a unique area that we're sitting in, right? So we can continue to grow Assurance Plus, and we are moving steadfastly towards doing that. The other opportunity is Assurance Plus is a subsidiary of Oxbridge. Assurance Plus sits under the Holdco. The Holdco is publicly traded. We have Assurance Plus as one of its subsidiaries. So Assurance Plus has 2 years of PCAOB audited financials, and I say this because in order for a company to potentially spin out or go public, you need 2 years of PCAOB audited financials. Assurance Plus has that as a standalone company. So as we grow forward, we look forward to growing Assurance Plus and potentially at some point and hopefully it's a very close point, is to spin Assurance Plus out as its own publicly traded entity, thus decoupling it from our legacy business, because everything that we're doing in the reinsurance space has completely morphed over the last 4 years from what we were doing, how we were doing it, including the type of business that we're underwriting. Very different. And as we go forward, we look forward to doing new and unique and interesting things with Assurance Plus.
And finally, Jay, what near-term announcements or deliverables should we be looking out for in the reasonable future?
Near-term announcements, I can't get into detail until we actually put those out, right? But I've alluded to a few of these over here in the growth of Assurance Plus and the growth of Oxbridge. We've done various different things in Oxbridge to make sure that we can take advantage of opportunities going forward. So we're a DAT type of conversation over here this whole day. We have done various different things to make sure if we ever pursued a DAT strategy, we have everything set up for something like that. If that same DAT strategy was to morph into an AI type of strategy, we could do that too, right? So, and all of what I'm telling you is out there in the public. Everything we've done is out there in the public. So Oxbridge has tremendous number of opportunities. It's as a holding company, as a publicly traded holding company, we've done various things. Assurance Plus, as a subsidiary, also has a number of opportunities, not only in growth, but spin-off, etc. So pivotal time for Oxbridge, very interesting time, and we're excited.
Well said and right within our limit. Jay, thank you very much for showing us Oxbridge. That's Oxbridge Holdings. And if you want more information about Oxbridge, call us at 1-800-REDCHIP or email us at OXBR. Jay, thank you again, and I look forward to working with you again in the near future.
Thank you for having me on. Appreciate it. Bye now.
Our next presenter is Sam Tabar of Bit Digital. He is going to get started as soon as he is ready. Let's do a quick sound, video, and presentation check. Sam, welcome.
Thank you for having me.
quite welcome. Quite happy to have you. If you've got a presentation to share, I'd love to see it. Make sure it's all right.
I think my colleague is sharing it, and I'm ready to go whenever it's up and running.
Okay. All right. We are still waiting for that. Meanwhile, why don't I do this? Again, this is the RedChip Fintech and Digital Asset Treasury Virtual Investor Conference. This is Bit Digital presenting in this half-hour slot. Bit Digital, ticker BTBT on the NASDAQ, and presenting today is Sam Tabar, the CEO. Sam is going to begin his presentation in just a moment. We'll open this event to your questions, and I see now that the deck is on the screen. It looks fabulous. So I'll wrap up with the safe harbor statement here. This segment may contain forward-looking statements within the meaning of the Private Securities Litigation Reform Act of 1995. All statements pertaining to future financial and/or operating results, along with other statements about the future expectations, beliefs, goals, plans, or prospects expressed by management, constitute forward-looking statements. Any statements that are not historical facts should also be considered forward-looking statements. Of course, forward-looking statements involve risks and uncertainties. We are ready to hear your presentation, Sam.
All right, great. Slide 1, if somebody could direct to slide 1, please. Hi, everyone, and thanks for joining us today. I'm Sam Tabar, Chief Executive Officer of Bit Digital. Bit Digital is a NASDAQ-listed company trading under the ticker BTBT. We define Bit Digital as a strategic asset company, which I'll unpack over the course of the presentation. Today, I'll walk through how we think about our strategy, our asset base, and how we allocate capital going forward. Before getting into the strategy, just a quick word about my background. I'm CEO of Bit Digital. I've been with the company since 2021. Before that, I co-founded a blockchain company that was acquired by Consensus, and I've spent most of my career at the intersection of law, crypto, capital markets, and technology. More broadly, we have a full team with experience across crypto, infrastructure, and public company operations. That background matters because our strategy requires operating discipline and not just asset selection. Slide 4, please. We define Bit Digital as a strategic asset company. At a high level, that means we allocate capital across strategic assets at the infrastructure layer, and we operate around those assets rather than just hold them. What that really comes down to is this. We focus on owning infrastructure that is productive, infrastructure that generates yield, usage, and participation. And then we build operating capabilities around those assets so we can compound over time. You can think about our strategy as resting on 2 pillars. On the left is Ethereum economic infrastructure. We operate Ethereum infrastructure through staking and network participation. We treat ETH as a productive economic infrastructure, not passive inventory. On the right is AI and HPC intelligence infrastructure. Our exposure there is through our majority equity ownership in WhiteFiber, which is a public company that owns and develops AI-focused data centers and compute infrastructure. WhiteFiber trades under the ticker Wi-Fi. I'll cover more about WhiteFiber in detail later. These are 2 different markets, but the common thread is the same. We are positioned at the infrastructure layer of systems that coordinate value and produce intelligence. And in both cases, the model favors operators over passive holders. And that's the core idea behind a strategic asset company. Slide 5, please. What is a strategic asset company? A strategic asset company deploys capital into productive infrastructure. We integrate these assets into operating models rather than hold them passively. Our focus is on generating durable, usage-driven value that usually shows up as yield, fees, and participations rather than one-time gains. It's important to be clear about what this is not. We're not a holding company, we're not an ETF, we're not a miner, and we're not a passive treasury. We deploy capital into infrastructure and we operate around what we own. That distinction drives how we think about strategy and capital allocation. Slide 6. Bit Digital did not start as a strategic asset company. We started as a Bitcoin miner in 2020. At that time, mining was an effective way to gain exposure to digital assets and build scale in the ecosystem. Over time, however, it became clear to us that mining is a difficult business to underwrite over long-term horizons. Returns tend to compress as hash rate grows, and then capital requirements rise, and differentiation is limited. So that combination makes it hard to consistently generate attractive risk-adjusted returns. So we began to pivot in a more deliberate way. Around 2021, we started converting a portion of our Bitcoin into Ethereum and building an initial ETH treasury. We scaled that treasury over time and built staking infrastructure so our digital asset exposure could become productive rather than purely directional. In 2024, we launched our cloud services business to gain exposure to AI workloads. We then acquired a data center platform and built an AI infrastructure business, which ultimately became White Fiber. In 2025, we completed the White Fiber IPO, creating a standalone public AI infrastructure company while retaining a controlling 70% ownership. Also in 2025, we converted our remaining Bitcoin into Ethereum, making our treasury 100% ETH. In parallel, we began winding down Bitcoin mining. Today, we define Bit Digital as a strategic asset company, and this evolution reflects a shift away from commodity production and toward owning and operating productive digital infrastructure. Slide 7. The core constraint today is not capital, it is infrastructure. Over the last several years, capital has become abundant. What has not kept pace is the physical and digital infrastructure required to deploy that capital productively. In programmable finance, settlement, and coordination, infrastructure is actually scarce. Block space, validator capacity, and reliable network operations matter more as activity grows. In AI, reliable and scalable compute infrastructure is scarce. Power availability, data center capacity, cooling, interconnection, and build timelines are the real bottlenecks. These constraints are structural, not cyclical. They take years to resolve. They require specialized expertise and involve significant upfront capital. That dynamic tends to favor owners and operators of infrastructure rather than passive holders of assets. Ethereum coordinates value, ownership, and execution. AI infrastructure produces intelligence through compute. Both sit at foundational layers of their respective stacks. And both reward participants who operate infrastructure, not just those who hold exposure. That is where we are positioning the company. Slide 8. Today, our balance sheet is built around two primary assets. First, Ethereum. As of the end of last year, we hold approximately 155,000 ETH. Second, our equity stake in White Fiber, we own approximately 27 million shares, representing just over 70% of the company. When you mark those assets to market, the combined value was nearly 900 million as of the end of last year. Digital asset prices have recently been under pressure, so the current combined value is approximately 650 million. Notably, Wi-Fi, the ticker for white fiber, Wi-Fi stock is up around 10% year to date, which has helped offset some of the weakness in crypto prices. We also provide a simplified MNAV calculator on the Bit Digital website that shows updated market values for these assets and the implied discount to MNAV for Bit Digital in real time. This highlights an important point. Diversification matters. BTBT stock has held up considerably better than pure play ETH peers over the past week, in part because of our diversified asset base. At current share prices, Bit Digital trades below the market value of these underlying assets. We don't manage the company to close a discount in the short term, but we believe long-term compounding at the asset level is ultimately what matters. This is simply an arithmetic observation. Slide 9, please. If you start with our current market capitalization and subtract the market value of our Ethereum holdings, what's left is the implied value the market is assigning to our white fiber stake. That implied value is meaningfully below white fiber's own public market value. No control premium is even assumed. We are not making a valuation claim about where white fiber should trade. We are simply highlighting a major disconnect. Slide 10, please. We view Ethereum as economic infrastructure. It is a primary programmable settlement layer of decentralized finance. It underpins a large portion of stablecoin activity. It supports tokenization, on-chain capital markets, and application-level financial services. In other words, Ethereum is not just a store of value. It is a system that coordinates value, ownership, and execution. Ethereum also generates native yield through staking. That's an important distinction. For us, ETH is not a trading asset. We view it as a productive infrastructure. It has liquidity, it has yield, and it allows us to participate directly in the operation of the network. That combination is what makes Ethereum particularly attractive within a strategic asset company framework. Bitcoin is an important digital asset, but Ethereum gives way to align our balance sheet with network usage, uptime, and activity, rather than relying solely on price appreciation as you would need to do with Bitcoin. As Ethereum matures, value accrual is increasingly driven by participation, fees, and coordination. Our strategy is designed to reflect that reality. Slide 11. Our approach to capital allocation is grounded in owning and operating productive infrastructure over long-term horizons. We deploy capital into infrastructure we intend to operate and monetize, rather than pursuing short-term liquidity or scale for its own sake. Today, that primarily means Ethereum as economic infrastructure and AI infrastructure through white fiber. But the broader mandate is consistent. The specific asset may change over time, but the framework does not. We are building a company designed around operational participation, durable cash flow, and long-term compounding. As we move forward, our focus is on strengthening our ability to self-fund growth, maintain balance sheet flexibility, and selectively deploy capital into opportunities that compound returns independent of broader market movements. Slide 12, please. We already operate institutional-grade Ethereum infrastructure. Our validator stack is live today. We exclusively stake our own Ethereum and we use enterprise-grade custody. We also have multiple years of experience operating at this scale. So this is not a future capability for us. It already exists today. In 2025, many companies saw an opportunity to reinvent themselves as digital asset treasury companies. Some of these companies come from completely unrelated industries and pivoted almost overnight. We've been in this industry for the better part of a decade. We've built through multiple cycles. We have carefully laid the groundwork for a long-term business model, and we deliberately built a durable vehicle designed to compound over time. Slide 13, please. Our exposure to AI is through our majority equity ownership in White Fiber. White Fiber is a pure-play AI infrastructure company that owns and develops high-performance data center and compute infrastructure. White Fiber operates across two complementary business lines. First is cloud, where White Fiber deploys GPUs and provides compute directly to customers. The second is data center colocation, where White Fiber owns and develops facilities and leases power-dense capacity to customers who deploy their own hardware. Over time, we expect colocation to represent a larger portion of the business, given its long-term contracted nature and infrastructure-like characteristics. We do not operate White Fiber. We are strategic shareholders. The reason we like this exposure is simple. AI workloads are extremely compute intensive, and high-quality power-dense infrastructure is scarce. White Fiber is positioned at that infrastructure layer. Slide 14, please. White Fiber today has a growing footprint of Tier 3 data centers and high-performance GPU clusters. Approximately 11 megawatts were online at the end of 2025. That is expected to grow to over 75 megawatts by the year end of 2026. White Fiber has deployed roughly 4,500 GPUs and serves more than 20 customers. White Fiber provides mission-critical infrastructure for AI workloads. We view this as one of the most important long-term secular growth areas in technology. Our interest in White Fiber gives us scaled exposure to AI infrastructure without Bit Digital having to directly operate data centers. Slide 15, please. Bit Digital owns approximately 27 million shares of White Fiber, representing 70% ownership. That stake represents our intelligence infrastructure exposure. We view White Fiber as a long-term strategic holding. We have stated publicly that we do not intend to sell any White Fiber shares in 2026. Over time, we expect to monetize portions of this investment, but only in a way that reflects what we believe is materially higher long-term value. We view this ownership as a core strategic asset within the long-term capital deployment strategy rather than a financial asset to be traded. Slide 16, please. White Fiber's development has been deliberate. We did not start trying to build hyperscale campuses from scratch. We started by launching cloud services and building customer relationships so we could understand real work requirements. And from there, we acquired a data center platform and began expanding sites with the specific goal of owning and developing AI infrastructure. A core part of that strategy has been a retrofit-first development model. Rather than waiting years to entitle and build greenfield facilities, White Fiber focuses on acquiring and upgrading its existing facilities that are well-suited for high-performance compute. That approach materially shortens time to market. And in this environment, speed matters. Demand for AI compute is here today, while power, space, and build capacity remains constrained. Being able to bring capacity online quickly is a real competitive advantage. That progression ultimately led to the White Fiber IPO. And most recently, White Fiber signed an $865 million contract over 10-year terms with Nscale, with an initial deployment expected to be operational in the second quarter. We view this as an important validation of White Fiber's platform and execution capabilities. The agreement also includes a right of first offer on additional capacity expected to come online in 2027, which would approximately double the size of this initial deployment. Slide 17, please. Stepping back into the consolidated balance sheet, as of the end of 2025, we held approximately 155,000 ETH. Approximately 90% of that ETH is actively staked, yielding around 3 to 4%. We own approximately 27 million White Fiber shares. We have no unsecured debt. We issued $150 million of unsecured convertible notes in 2025. The structure allowed us to raise capital at a premium to MNAV. We believe this unsecured convertible note offering was among the first of its kind in the sector. This is important because the ETH is not collateralized, which protects against forced selling in volatile markets like today, and allows us to manage the business with a long-term view. The balance sheet today is built around infrastructure assets. One important distinction versus many treasury-style vehicles is that we have an internal lever to grow ETH per share. Through staking yield and compounding, we can increase ETH density over time without relying solely on external fundraising. Pure play vehicles that only hold onto an asset do not have that same lever. While our current positioning provides exposure to how ETH performs and how White Fiber performs, our strategy is to move beyond pure market beta. We are focused on enabling alpha generation over time through operational excellence, strategic capital deployment, and selective opportunities that compound independently over broader market movements. You should expect this to be an active and evolving strategy as we continue to identify and develop new ways to compound value within our strategic asset company framework. And with that, I'll stop and take questions.
Thank you, Sam. To speak to Sam, to reach Sam, please click the Q&A button on your Zoom window. Don't click your raise hand button because we can't take your spoken questions right now, but we will be happy to field your questions written in after you press the Q&A button. We already have several questions in, Sam. What does strategic asset company really mean in practice?
For us, it allows us to allocate capital into productive infrastructure, not passive assets. So here, in this instance, we focus on owning infrastructure that generates yield, usage, and participation. And then we build operating capabilities around those assets so they can compound over time. So today that shows up primarily as Ethereum economic infrastructure and AI infrastructure through White Fiber. But more broadly, it's a mindset around owning and operating infrastructure at foundational layers of emerging systems.
Could you tell us again why focus on Ethereum instead of Bitcoin?
Well, Bitcoin is simply a store of value. It is not a programmable system. Ethereum is a programmable system. Ethereum settles value, it runs applications, it underpins stablecoins, it generates native yield through staking. That combination makes Ethereum better suited for a strategy centered on productive infrastructure and operating participation. So we do appreciate Bitcoin. We've owned it for years. We started diversifying into ETH in 2021. And at that time, that was very unconventional in our sector. We're not maximalists, we're shareholder maximalists, if anything. We felt that Ethereum has that technology that Bitcoin doesn't, and it seems that others have realized that in due course. So we were early to the market on that.
Sam, why not just hold ETH passively instead of staking it?
Well, because staking turns ETH into from a passive asset into a productive infrastructure. So it's similar to asking why would you sit on cash when you could earn a yield? We earn protocol rewards, and that grows our ETH balance over time and compounds. And also staking directly supports and secures the Ethereum network, which aligns our balance sheet with network health. So we're long ETH, and we're also long the cash flow the network generates.
Sam, how does Bit Digital differ from other crypto treasury companies or single asset vehicles?
Well, most treasury companies primarily hold an asset. We operate, Bit Digital, in contrast, operates infrastructure around the assets we actually own. So we run the staking, we manage the validators, we maintain institutional custody. We also own equity in AI infrastructure through White Fiber. I'm not sure if any other company is positioned in the same manner. We've been doing this for years across multiple cycles, and this is not just a recent pivot. And that gives us non-dilutive levers to increase asset density per share through staking yield and compounding. So we're not just a single asset balance sheet asset, we're an infrastructure focused capital allocator.
This investor wants to know flat out, why buy BTBT? Why not just buy ETH or White Fiber separately?
Well, Bit Digital BTBT provides an integrated exposure. So you get ETH staking yield and equity in White Fiber wrapped inside an active capital allocation framework. We compound inside that vehicle. So buying the pieces separately gives you the assets, but Bit Digital gives you the strategy.
How do you decide when to raise capital versus just wait?
Yeah, we have a very rigorous process for deciding when to raise capital. But in short, at a high level, we raise capital when we see opportunities to increase shareholder value. So MNAV per share is a pretty good anchor for us. If we are trading at a premium to MNAV, it's easier to raise equity and deploy that capital accretively. If we raise capital at a premium, we can purchase ETH and increase ETH per share. We're also very thoughtful about capital structure. So we used unsecured converts so the ETH was not collateralized. We're very careful with leverage. Our goal is not to raise the most money or buy the most ETH. Our goal is to maximize long-term value per share.
Final question. We got about a minute. Where do you want Bit Digital to be in 5 years?
We want to be one of the largest public Ethereum treasuries. We're a trusted large-scale ETH staking operator and a major shareholder in scaled AI infrastructure. In short, a leading public market platform for digital infrastructure exposure.
Thank you very much for that very enlightening presentation, Sam. That again is Bit Digital, and you can get more information by reaching us at 1-800-REDCHIP or emailing us at btbt@redchip.com. Thanks again, Sam. We hope to be working with you again very soon.
Thank you for having me.
Next, we have Lavelle Juan, CEO of the Bragg House, and Marco Margiotta at House of Doge. I believe both of these gentlemen are already on. Gentlemen, hello.
How you doing?
Excellent.
Greg, do you want me to just share my screen?
Yeah, let's
So
do
you
a
got-
screen check. That's great.
Okay.
Presentation, make sure that presentation comes up. Marcus, hello.
Hi, how are you?
Good. Now that I can see and hear you, our tests are over. We are ready to kick this thing off. Looks like you got the deck up there. Lavelle and Marcus, welcome. Again, everyone, this is the RedChip Fintech and Digital Asset Treasury Virtual Investor Conference. We've been going since 9:30 a.m. U.S. Eastern. Today we're going all the way to 4 p.m. This has been a great opportunity to learn about fintech companies. One of them is the Bragg House. And the Bragg House's ticker is TBH on the NASDAQ. Presenting today is Lavelle Juan, CEO of the Bragg House, and Marco Margiotta, CEO of House of Doge. They're going to begin their presentation in just a moment, and then we're going to open up this event, like always, to your questions. I'm going to keep everyone's lines muted throughout the presentation. You can, of course, ask a question by clicking the Q&A button at the bottom of your screen and typing in your question. We can't take your spoken questions today, but we certainly can take your written in questions. We have one little formality to get out of the way, and that's the Safe Harbor Statement. This segment may contain forward-looking statements within the meaning of the Private Securities Litigation Reform Act of 1995. All statements pertaining to future financial and/or operating results, along with other statements about the future expectations, beliefs, goals, plans, or prospects expressed by management, constitute forward-looking statements. Any statements that are not historical fact should also be considered forward-looking statements. And of course, forward-looking statements involve risks and uncertainties. Lavelle, Marco, please go ahead.
Well, thank you, Craig. And good afternoon, everybody there. My name is Lavelle Malloy, CEO of the Bragg House, and joining me is Marco Margiotta, CEO of House of Doge and the incoming COO of our post-merger combined entity. And we're actually very excited to talk to you today about the merger that really will transform Bragg House from a media tech platform in the microcap market to a fintech diversified financial powerhouse in $1 billion market cap. A bit of a background for Bragg House. For years, Bragg House has been a leader in engaging Gen Z through gaming and social competition. But today, as we are very close to completion of the merger, the combination of this engagement engine that we've built with the official corporate arm of the Dogecoin Foundation, House of Doge, will elevate us from an emerging growth company into a category-defining force that's really on the intersection of culture, community, and digital finance.
Oh, thank you, Lavelle. This merger is built on a specific thesis, combining the energy of culture with a strong infrastructure of capital. We aren't just looking at Dogecoin as a meme. We view it as a top 10 asset with a multi-billion-dollar market cap and tens of millions of wallets based globally. Our specific advantage, our moat, is that House of Doge holds the exclusive 20-year commercial partnership with the Dogecoin Foundation. This gives us scale and the sole authority to build the institutional rails, regulated products, and treasury management for one of the world's most recognized digital assets.
And this transaction has been rigorously vetted. It has been validated by an independent fairness opinion, which was conducted by Newbridge Securities. But importantly, in that fairness opinion, we weren't benchmarked or compared against early crypto stage projects. Instead, we were benchmarked against world-leading platforms where the value was really driven by revenue durability and margin structure.
Excellent point. And this is because we're building a multi-vertical model. Number one, in payments, we're building institutional grade rails and debit cards. Two, in asset management, we are leading the tokenization of real-world assets. Three, in brand and licensing, we plan on monetizing our globally recognized brand.
That opportunity is defined into 4 distinct verticals in unison. Marco, I'm sorry.
Yeah, so first with global payments, we're activating Dogecoin's multi-billion-dollar market cap for real-world commerce. Second, RWA tokenization, a sector forecasted to grow to trillions by 2030. Third, brand and licensing, converting community enthusiasm into high-margin revenue. Additionally, digital media and data insights will continue to be the engine that drives adoption, the foundation that Lavelle and his team built at Bragg House.
And that's exactly right. When we built Bragg House, we built a premier media tech platform. And we had partners, still do, with McDonald's, Coca-Cola, NFL, including the Denver Broncos. We currently have a partnership with Learfield, which gives access to over 200,000 universities and athletic programs. And the method we use, which is important, was a gamified method. We're able to capture active data and behavioral insights that you couldn't get anywhere else. Through this, we've created a built-in adoption engine to introduce these financial products to the next generation. So with the merger, Bragg House, we moved Bragg House simply from a digital engagement platform to a digital ownership, and not just for the college community now, but worldwide.
We're going to monetize that engagement by providing the financial rails. As you see in slide 8, execution has already begun. For asset management, we have already launched a European ETP in partnership with 21 Shares. For RWA tokenization, we have recently invested in US Tristina Calcio 1918 and HC Sierra Hockey Club. We are the first crypto company to invest heavily in professional European football and hockey clubs to serve as a proof of concept for payment integration, as well as other exciting endeavors. For payments, we are building rails that bypass traditional friction. My background is in this space. I've previously built Payfair, which restructured how gig workers got paid. We are applying these same principles here, with Fiserv leading the development of our platform. For those that aren't familiar with Payfair, Payfair was recently acquired by Fiserv, one of the world's largest payments company. Payfair had an incredible amount of success. The backbone of it stems from us recognizing back in 2017 that gig workers couldn't sustain driving for gig platforms unless they were paid instantly, because on-demand work requires on-demand pay, especially for those that didn't have much money to begin with. And so we revolutionized how that should work. We partnered with Uber, DoorDash, Lyft, Walmart, the list goes on, and offered those gig workers a chance to get paid instantly after every task for completely free. We generated $240 million in revenue and close to $36 million in EBITDA. And that was, like I said, recently acquired in this past March. So we're excited to have partners or potential partners such as Fiserv to come along for this journey as well. 21 Shares Spot Doge ETF just recently launched, ticker TDOG. Debuted on the NASDAQ on January 22nd, 2026 as the first SEC approved spot Dogecoin ETF. Backed by the Dogecoin Foundation, it allows retail and institutional investors to gain exposure to Dogecoin directly through traditional brokerage accounts.
So what we've tried to show here is our investment thesis. Loyal global community, NASDAQ listed public structure with Dogecoin, and a proven execution team.
Yeah, and the leadership, it's built for scale. So to execute this, we have aligned world-class financial leadership with community builders. I will serve as the CEO of the merged public company, supported by a C-suite with deep technical and financial expertise, including Timothy Stebbing as CTO and Ryan Deslip as CPO. For some context and background, Tim Stebbing is a director at the Dogecoin Foundation. He's our CTO here at the House of Doge. And Ryan Deslip was my fellow co-founder at Payfair of the company I just mentioned that we recently sold to Fiserv. He's joining me here as one of the brightest minds in payments that I've ever met. And he's our chief payment officer here at House of Doge.
For myself and my team, I will continue to be the CEO of Bragg House, which will be an important vertical in the new combined company. My focus remains what Bragg House pretty much done the best, leading our strategy on cultural adoption engine. So I will be able to ensure that we're able to now connect the financial tools that House of Doge is building and adopt it across an entire college ecosystem where the Gen Z community can get a chance to cultivate that.
So to wrap it up, we're presenting a transformative merger. validated by independent financial analysis. Execution is already live with ETPs, ETFs, investments, and partnerships with large-scale payment providers and service providers that can help us build this ecosystem. The market opportunity is multi-trillion dollars across payments and RWA. Our moat is unmatched as the official partner of the Dogecoin Foundation.
And well, we built at Bragg House to give Gen Z a voice in gaming. Now, together with the House of Doge, we're giving them ownership in finance. So we're creating a financial powerhouse, as Marco explained, anchored in payments, asset management, and real-world assets.
Thank you very much for your time.
Happy to answer any questions from everyone.
Yes, and we have plenty of them, Lavelle and Marco. Thank you for that illuminating presentation. Reminder to our users, if you wish to reach the team here, click the Q&A button first and then type in your question. We will then read it aloud. We've got several questions already here, gentlemen. The merger with House of Doge, it marks a major evolution from digital engagement to digital ownership, and congratulations on that, he says. What was the inflection point that made this expansion into financial infrastructure the right move now?
Well, do you want to start, Marco? Because I can tell you what.
Go ahead, Lavelle. I have a lot of thoughts, so I'd rather go after you.
I know. So this evolution, I'll try to be simple because I know there's more questions. It was always something, Bragg House was always a starting point. Looking at fan engagement, ownership, really building that, as you correctly said, whoever asked that question, the evolution was always the plan. When I sat down first with Marco, putting aside his experience, but to see his vision of really building those financial rails to give, again, we are the leader in the Gen Z engagement. There's no one else. That's why we have the largest contract in media rights. To be able to 10x that, engagement, but then offer an entire ecosystem of payments and an entire ecosystem, of so much more. That was always the dream. And this has now made that possible for not just my community, but really being able to take that worldwide to something that I don't believe we have seen yet. Marco?
Yeah, oh, well said. So, given the extensive background I have with payments, and then most recently I mentioned with Payfair, we unraveled a opportunity that was completely created by the friction involved in payments today. And so I won't bore you to death with the history of how it all started, but for me, I saw very quickly what blockchain could do for payments and how many intermediaries that are involved in payments specifically that don't necessarily have to be involved if you're on a blockchain. And when you think about Payfair as an example of that, just by opening up bank accounts for gig workers at the same financial institution that the gig platforms had a pre-funded bank account at, we were able to move money around on the same ledger within a financial institution. Although it doesn't sound earth-shattering, what it does is it avoids other intermediaries that process real-time payment movement, because when you're in the same bank and at the same ledger, you could move money around because it's on the same ledger and there's no third party with their hand out saying, hey, I know you want to move money around in real time. This is the service we provide. And by doing that, and just with a very niche market like gig workers, we uncovered a $240 million revenue run rate in a matter of 5 years, which is incredible. So think about if that's just one niche and one application impacting, we had 10 million downloads, #1 financial services app in the US for 3 years running. If that's the case on one blockchain, one ledger within one bank, imagine how much disruption's out there once you go to a global blockchain. And that's, to me, really what resonated with me on how big blockchain for payments specifically could get.
Thank you, Lavelle and Marcus. Dogecoin has one of the largest communities in crypto, but it hasn't historically had institutional infrastructure. What makes Dogecoin uniquely suited to become a real-world payments and financial asset at scale?
I can take that right off the bat. I can tell you what it is. It's having access to millions of users around the world that are extremely passionate And, the community is something I learned firsthand as soon as I got involved. You ask 10 people involved with it, what's the first thing that comes to your mind when you talk about Dogecoin? The first response you'll get, 10 out of 10 times, is the community. When you have that kind of clout and name, we show up to meetings of traditional TradFi payment processors, as an example. And if we didn't have that Dogecoin brand and name, they probably wouldn't take it. But the second we walk in there and say, hey, we now have institutional grade support, investor support, and people that have come from TradFi spaces and have executed and proven leadership in many of the largest companies in the world that want to get behind it, and here's why. And using the example I just gave and how we disrupted gig worker platforms and how those gig workers got paid, it becomes very evident to everybody in the TradFi payment space how lucrative this could be and how big the opportunity is. And so having this starting point with the community of our size, it's just a matter of focusing efforts to coherently bring everything together. Now that the corporate arm, House of Doge, has been established, that collectiveness and that spearheaded nature of how we want to go about and tackle this stuff could be handled through this corporation, which is why we're so excited. It's the first time that the community actually has a corporate lead to kind of feed off of and kind of build around. So super excited about that all. Lavelle, I don't know if you want to add anything.
Just quickly, you got to look at again what the stepping stones for Braghouse was built on. It was built on community. We took the Gen Z community, a $300 billion community, and now we have access to one of the hardest to reach because we gave them an infrastructure. And now we have one of the largest partnerships. So again, we've taken community and really now we're the gateway for that college Gen Z community. You take that again and you 10x it to, now, hopefully setting the roadmap of community. You come now with these tens of millions of loyal Doge communities, and you're giving them a complete connected financial system backed by some of the biggest partners there are. That's again, we've seen success, but now we've also have a chance to really kind of, again, 10x what that success is. But again, I do want to emphasize, built on the same thing, loyal community.
Thanks, gentlemen. This person wants to know about the exclusive commercial partnership that you've been highlighting with the Dogecoin Foundation. From a competitive standpoint, how important is that exclusivity in building defensible and regulated products?
You got to look at it twofold. So number one, the community is what built this coin and got it to where it is today. So we'll never lose sight of that and the organic nature of how it was created, which is amazing. It's a bunch of people that came together to do only good every day. We will never lose sight of that because we love that ethos. And it's the power of what happens when you bring a bunch of like-minded people together to make something happen, which no one ever thought at the beginning and at its infancy it would reach the multi-billion-dollar market cap status it has today. However, establishing this corporate arm now enables us to get more institutional, put our big boy belt and suspenders on to make sure all the products and everything that we could do in our control can actually suit better suited products like ETFs, like the ETPs we launched in Europe, like decentralizing asset classes we would hope to bring to the market, not just for Dogecoin and the community itself, but everybody. There's asset classes I dreamed of owning, and now thanks to blockchain, those will become a reality. And so the origins of how it all started have never been lost, but having this corporate arm and the ability to use the branding, the licensing, and bring the community along for the ride and the journey is certainly a starting point that most corporations at their infancy would dream of. And that's the power of this partnership. We have access to it. We won't stop others from using it as long as it meets, what we set out to do, which is moving away from a meme in terms of, the negativity around what meme coins might have and any connotations with that. We really want to prove through utility that there's much more to do than most people are thinking. And it's more similar along the lines to what other blockchains are doing and how effective and useful blockchains could be in everyday commerce, as well as decentralization of ownership of a variety of asset classes at its core. So those are kind of two main verticals for us, but obviously by having access to the community and having their input, we obviously have a very big use case around branding and licensing as well.
Gentlemen, a lot of crypto narratives focus on the trading, as you well know. You have emphasized payments, debit cards, and merchant rails. Why do you think that everyday commerce is the most important unlock for long-term value creation?
I could take that. So when you look back at what I mentioned before, and I hate to keep bringing it up, but it's just a real world case about how things in payments have just gotten to where they are. And no one's really begged the question, why is it like that? Back in the day, you would just take cash and the merchant wouldn't have to worry about paying 2-3% for every time they transacted with a consumer. Now that digital payments have taken off and 90+% of transactions in most markets or bigger markets are through debit cards and credit cards, that fee just doesn't go away. With the blockchain technology and having everyone link in on that same ledger, the amount of security around that and reliability of what those transactions represent, avoiding fraud and everything else that we all know that the powers of blockchain can bring, there isn't a need to have those fees to the extent that they're charged today. And so mainly it's around merchants saving on interchange. There is a huge, massive opportunity to bring down the cost significantly. And it stems from not just, credit card processors and networks involved, but even on every aspect of real-time money movement, whether it's even consumer to consumer or peer-to-peer or B2C or even C2C or B2B. It's every aspect of real-time money movement, including global remittance. When you look at the fees charged associated with simply moving money around based on taking risk that's added by not understanding and validating transactions the way that all of us should, those efficiencies ultimately result in significant savings across the board. And coming from TradFi payments and innovating a lot of very cool products in it, there's no innovation in payments like I've seen before that could be as big and sizable as what we have in front of us with blockchain and payments coming together.
And the only thing I'll add is that, coming from my background as being a securities lawyer, utility is everything. And no matter what new products come in there, it's always when you find use for them, they become more valuable over time. And if they can't, then they kind of fizzle out. So what Dogecoin has achieved with the multi-billion-dollar market of just being a meme coin, and then you put utility about that, I think it's kind of really a no-brainer. And, if you look at kind of the payments market, and again, everything's about execution, and Marco and I completely understand that. But if you kind of just look at, just the rough market cap of $1 trillion market, now think of even getting a fraction, a percent of, being able to get into that market. The numbers are astronomical. So then the second question you have to ask yourself is, well, can you do it? And, the merger is even possible because we have probably some of the best, brightest minds in payment processing who have done it. So when you kind of look at those things there, again, I'm being very high level, but when you kind of look at those things starting from there, the conversation makes sense and then you can go bring it down. So that's the reason why we feel very confident in what we're building.
This person writes, Gen Z are here, and you've already built deep engagement with my generation through your media platform and Learfield partnership. How does that cultural reach translate into lower customer acquisition costs for financial products?
Well, first of all, hook 'em horns. So it's good to know we have people who are affiliated with that. So just to kind of reiterate, our vertical, Braghouse, the digital engagement becomes a significant vertical now of the entire holdco. And that mission statement is exactly the same. Fan engagement for Gen Z, which we've, again, done very successful with, and we're just actually starting our Learfield, just executing. We spent this year doing a bunch of beta exams, super successful, and now we're ready to launch full scale, in the next month or so. after the merger goes through. We've added now more resources directly to what we're building. But I think, as you noted yourself, it's a direct correlation because now in our platform, now in our ecosystem that we've built, we can directly, and as these financial products are built, you know, some of the first adoption people of those will be your community, will be Gen Z. So there's a direct correlation, and we couldn't be excited that it actually furthers the mission statement of Braghouse.
Investors hear a lot of big visions in crypto. What gives you confidence that your team can execute across multiple verticals all at once?
Let me actually start with this one, Marco, just because, you have to look at our board of directors and the people that were there in the company. We have the chief marketing officer of ADT. We have, managing directors of some of Saudi Arabia's biggest funds. We have some of the smartest people that are there, and the first thing we looked at and we sat down, again, as I mentioned before, we said, okay, high level, a lot of this makes sense. So then, as I've, always done in Bragg House, it's execution. Who can execute this to make this dream come true? And we looked at Marco, we looked at his team, which he's completely bringing over. We looked at Fiserv, who said, hey, as a potential partner, they're excited to literally be working on this, payment processing thing. If you have the entire team, and then the last step, Marco's already done this. He's done this very, very, very successfully in something that, honestly, just, it was also kind of a first of its kind. So when you have the plan and then you have the team that could execute it, those stack a lot of things in your favor. The next thing we looked at, obviously, once we had those conversations, we had independent, people come in and we, looked at it and they did a fairness opinion. And again, regardless of, the numbers or any of that kind of stuff, we didn't get really caught up in that. Obviously the fairness opinion said it was a fair deal. What we looked at was what they benchmarked. And the companies they benchmark in was things that kind of really stuck out to us. Because again, it showed what we were building and what are the credibility for building it. So having those things from here, from the management side, which we saw our fiduciary duties increasing shareholder value, we felt a lot of confidence. Meeting Marco's team, coming down there, really sitting, speaking to some of the, smartest people that I've spoken to, conversations with former CTOs of Bookings.com who are engaged and, excited to be a part of this project and really figuring out how do we bring that technology. And then again, full confidence in our team. We've done this at the Gen Z scale. So now to have all of these reinforcements with Marco and his team, who have done this, was something that gave us more confidence than we feel we're in a really good position. Marco, do you want to add to that?
Yeah, I mean, it's all about the team, as everyone knows, right? Your visions are great. Everyone's got the crazy pie in the sky view of how things could work in this euphoric state. But at the end of the day, it's all about the team to actually execute. We've been there, done that. So for payments, especially with the advantage of having blockchain underneath it all, we know that our starting point here is way easier than what we had to work with at a previous stint with Payfair, with my other company that I co-founded. So couple that with a well-capitalized balance sheet plus a brand that is already globally recognized as a starting point. This is a dream come true. And now, because of that credibility we have that carries with us, all the partners I previously made in my previous journey are all seeing the same things we saw once we popped the hood and started to understand blockchain and the powers that can come with it. So it's super, super exciting.
You couldn't have phrased it any better than that, Marcus and Lavelle. And we're right out of time. So we're right at the bottom of the hour. Great presentation, gentlemen. Great company. Thank you for answering all those questions. We can't wait to work with you again.
Thank you very much. Thanks, everybody.
Thank you.
Bye.
Okay, our next presenter is going to be Charles Allen of Blockchain Technology Consensus Solutions, or BTCS. He's going to begin speaking as soon as we get him set up. Charles, hi.
Hey, thanks for having me.
Great to see you again. All right, yeah, you're You're working quick. There, you got it. You're ready to go. All right. So this is Charles Allen of Blockchain Technology Consensus Solutions, or BTCS. This is the RedChip Fintech and Digital Asset Treasury Virtual Investor Conference. We will begin with Charles's presentation in just a moment, and then we're going to open up this event to your questions. Your lines will remain muted. However, you can submit your question at any time by pressing the Q&A button at the bottom of your Zoom window and then typing your question into the resulting text box. Let me get the safe harbor statement out of the way, Charles, and then you can launch. This segment may contain forward-looking statements within the meaning of the Private Securities Litigation Reform Act of 1995. All statements pertaining to future financial and/or operating results, along with other statements about the future expectations, beliefs, goals, plans, or prospects expressed by management, constitute forward-looking statements. Any statements that are not historical fact should also be considered forward-looking statements. Of course, forward-looking statements involve risks and uncertainties. Charles, that's it. Please go ahead.
All right, great. Just give me 1 second and I will share my screen so we have the PDF up. And all right, cool. Whoop. Okay, great. So hopefully everybody can see this. So I'll just jump right in. We've got our safe harbor. I guess we don't need to do that. Thank you, RedChip, for doing it. So BTCS, for Blockchain Technology Consensus Solutions, we're the oldest public crypto company in the world, which is really cool. Obviously, some of the data in this deck is a bit dated with the current market pricing, and I'll talk about that a little bit later. But I think some key things to focus on is we're an Ethereum first focused company executing a very unique strategy in the markets. We have high insider ownership. As far as some of the other public companies that are focused on Ethereum, I think we're highly differentiated, and we're showing phenomenal revenue growth over 2025. So obviously Ethereum's been one of the best performing assets since 2016. Clearly, we're in a bit of a pullback, but that's not something we haven't seen in the past. I think there's while there was general consensus that the 4-year cycle is over, we're starting to see maybe that's not the case, as both Bitcoin and Ethereum have pulled back in the recent month or so. So just taking a big step back and looking at the value proposition of Ethereum, I think this is really fundamental to our story. It's much greater than the price of Ethereum. We've been in this space for well over 10 years, and the thing that we've seen in the last year or so is the regulatory environment has dramatically changed, and institutions are willing to build products and solutions in this space that's going to allow for the tokenization of real world assets. And I think that is fundamentally game changing, as much as the internet was for the movement of information. The tokenization of digital assets will allow 24/7 trading and expand markets. And that's something that we're just starting to see build, and the majority of that building is happening on Ethereum. So despite the recent price declines, which we believe are macro driven, the overall value proposition of Ethereum and the institutional interest has not gone away. And I think that's something to really remember as we think about what pullback in the market looks like. So taking a look at kind of ways you can get exposure to Ethereum. 1, you can go buy an ETF. 2, you can do a digital asset treasury. And 3, there's BTCS. And I think where we're fundamentally different is, as opposed to just getting a 1-for-1 ETH exposure or just yield, we have integrated operations, and we have a DeFi and TradFi capital formation strategy that's going to limit dilution. And the integrated operations, I think, is really what we're looking at is to drive a high growth, high revenue, high margin business that is going to perform better than just holding an underlying assets. And that's really what we're building BTCS to be. So how do we do this? Really, it's the DeFi, TradFi, accretion flywheel, and we access capital through strategic capital raises, whether that's on using DeFi or our ATM, or we've done some convertible notes. And then how we deploy that's really interesting. So we have the block building, which has been the biggest revenue driver in 2025. Staking, which is, a relatively boring business in the grand scheme of things, where we actually run up our own nodes, which is great. It increases our yield compared to many of the comparables. But what we're really focused on for 2026 is Imperium, and that's where we believe we can see the same potential revenue growth that we saw in Builder Plus, but with a much higher margin. And so looking at these three businesses, Builder Plus is basically buying block space from validators and filling those with transactions that we can find. And that is, on Ethereum's blockchain, every 12 seconds, a new block is proposed for inclusion, and validators sell the majority of the validators sell their block space in an auction to the highest bidder, and we'll bid for those blocks and then go get the order flow to create those blocks. That's been the main revenue driver in 2025. Node Ops is solo staking, and we also run nodes for Rocket Pool. We do this ourselves, so we're not paying fees to third-party providers, which means we're more efficient than many of the others. And Imperium, and this is where we're really looking to be the focus of 2026, as I noted in our shareholder letter, is participating in on-chain DeFi markets, being a liquidity provider, and we see this as the growth engine for 2026 and something that we've been leaning into, especially given the current market conditions. So what does our kind of snapshot from a financial perspective look like? You can obviously see for the last 3 years, revenue's been growing phenomenally. 2023 is 1.3 million. 2024 we grew to approximately 4 million, and we put out unaudited revenue numbers earlier this year for 2025, and that came in around 16 million. So huge growth. And you can really see the breakdown of what that revenue looks like on a quarterly basis, where we've moved operations or focus away from Node Ops, where we don't see the same scalability, to Builder Plus and now Imperium, really moving in Q3. And we plan, as I've mentioned before, to really lean into that initiative, as we believe it's going to be similar, if successful, similar revenue trajectory that we had in Builder Plus, but substantially, higher margin, which is the goal. Obviously, apart from the last month, our market cap and price have done quite well. We're optimistic we deliver on the operation and executional side of putting out strong numbers. This should recover, especially with a favorable macro environment. I mean, right now we're just kind of suffering from that. So I'm going to touch a little bit on the ways we funded the company. We've used our ATM. We raised in 2025 about 140 million. We've done about over 3 million in stock buybacks out of a 50 million plan. And we've used convertible notes, which are 40% less dilutive than the ATM, assuming full conversion. So that's kind of a snapshot of how we're funding the business. We believe that being strategic in how we access the capital markets to limit dilution, which can be very toxic for many microcap companies, is a key component of our strategy. So just kind of having a quick look at our Ethereum holdings, we've substantially grown. In Q3 of 2025, we raised 80% of all the capital that we have in the last 10 years. So it was really a phenomenal quarter. Up until then, the market was not favorable to us. The liquidity in our stock was not as high as it is today, nor was the price. And so we decided that dilution was not in the best interest of our shareholders, and we're very conservative with how we access the capital markets. And that's resulted in a huge jump in our balance sheet, even with the recent declines. So just looking at how we have compared to our peers, I think we've done even with today's prices, I think we've done pretty well compared to many of the peers that have pivoted into this space. And I think that's primarily driven by the fact that we have an operating business far in excess of our balance sheet size. So just a quick snapshot of the financials here. You can see these are obviously as of Q3 because we haven't put out the Q4 results yet. We did indicate that we did about 16 million in revenue. So that's around 6 million for Q4. Typically, we've seen the first quarter be a weaker quarter in light of the market conditions. That could be expected, but again, we're only 1 month into Q1 2026. So very clean cap structure. We have convertible debt that it totals about 17 million, so not huge in the compared to the size of our assets. Warrants, these have no toxic features. They're cash only exercise. And employee stock options is pretty standard. So very clean capital structure. I note our Series B preferred stock is basically equivalent to common shares, and it was issued to all of our shareholders some years back. So that is it's not sitting in the hands of a toxic fund. And so that's kind of the cap table. As far as the team, I'd say we have an amazing team, both from on the leadership level as well as down on the employee side. I need to give them recognition where it's due. So our DevOps is headed up by Ben Hunter, who's now actually our Chief Technology Officer, and Michael Provoznik, our CFO, and we have a great board as well. So I think with that said, I know I've gone pretty fast through this presentation. I know many of the participants are familiar with the company. We have growing revenue. We're scaling operations. We've doubled the size of our team in 2025. Despite some macro headwinds, we do have very substantial regulatory tailwinds, as I mentioned earlier. And I think the market is really primed for adoption in blockchain technology, and we sit at the infrastructure level, right? We're not making bets as a company that a certain product or service will survive. We're operating at the infrastructure level, and so it's really generating scalable revenue within the Ethereum's ecosystem and economy. So I think with that said, and I know I've gone very quickly, there's probably I want to leave a substantial amount of time for at least half the time for questions, and so I'll open it back up.
Thank you, Charles. What an enlightening presentation. We have many questions already because people have been pressing that Q&A button and typing in their question. That's at the bottom of your Zoom window. Charles, number one, can you talk about BTCS's unique crypto strategy and how it differs from all the other public crypto companies and the traditional DAT approach?
Yeah, so I don't really view BTCS as a DAT. If you look at what happened in the summer of 2025, there was dozens and dozens of companies that said, "Hey, let's just go buy crypto and put it on our balance sheet," and the stock would spike because they were doing a huge pipe into like a sub $10 million market cap company that was basically a zombie shell, despite not technically being a shell. And there really isn't a business of let's just buy crypto and hope it goes up. That's not a business plan. I think that kind of played out in the summer of 2005, and it's not coming back. We've had a plan of we want to be building a scalable business from in a couple key components that we can integrate together, vertically integrate, and build a sustainable business. And we've been doing that since 2020 on the Ethereum side. And so we didn't pivot into the space like many of the others. I think we're much further ahead in terms of building out within the Ethereum ecosystem via Imperium, Builder Plus, and even the staking. We don't use third-party providers. And so I think that's what really sets us apart is we're an operating business as opposed to a Ethereum proxy.
Charles, why ETH? There are many crypto assets, of course, and what separates Ethereum from the other technologies? And of course, why is it foundational to your strategy?
Well, I think, look, we're not, I wouldn't view us as ETH maximalists. We're going to pick the blockchain that we feel has the most potential for success and disruption. And when we initially started in the crypto space, Ethereum didn't even exist, right? It was just Bitcoin. And while I like Bitcoin fundamentally, apart from having a first mover advantage and name brand recognition, the technology is much weaker than what Ethereum does. You can't really do much with it. And so when we look at Ethereum, it's where most of the developers are building. It's where most of the real world assets are getting deployed. And the next technologies, I mean, if you look at Solana, yes, it's faster, but it doesn't have the same record of uptime. And so it's the most established blockchain. It's never gone down in 10 years, and that's where the money is flowing, and that's where people are building. And so it seems that it's the best place to be focused than an up-and-coming new technology that may not get market awareness, may not get market adoption. And if it doesn't get to scale, it doesn't really matter. So I think that's where Ethereum's been a great place to focus for us.
Charles, when you think about BTCS's financial statements, what metric are you primarily optimizing for? Is it revenue, net income, ETH per share, or is it something else? And how does all that guide your capital allocation decisions?
So really, it's revenue and net income, I think, are the key things. Given the size of the company and the scale, we haven't really been focused on net income. There's a lot of non-cash charges. EBITDA is something we look at. And so I think first and foremost, it's been driving scalable revenue. I think if we're able to deliver that, the market should take notice. And further, as we look to pivot more into, or not pivot, but more shift our focus to Ethereum, as we've already built out Builder Plus and Node Ops, trying to increase the margin with the ultimate goal is that we want to get to a point where our operating activities far exceed our operating costs, right? Now, whether that's denominated in Ethereum and we have to convert, I mean, that's the goal. And we've been very conservative in how we approach that. And so those are the metrics we really want to get to. I'd like to get to a point where we don't need to access the capital markets unless we want to. We're very close to that. We don't need to now, but we do have access to multiple, funding sources. So I think really to kind of come back to your question, it's high growth revenue and high margin revenue, and then once we get to a point where we've proven that out, we can kind of focus on net income and some of the other non-cash charge expenses, or really look at EBITDA, adjusted EBITDA.
Charles, as you well know, there have been major industry tailwinds around Ethereum, stablecoins, and Web3 adoption. How do you see the regulatory and institutional developments shaping your go-forward opportunity?
I think it's very positive. Right now, we have the Genius Act that passed last year on stablecoins. I'd love to see the Clarity Act come to fruition. There's been a lot of discussion on whether you need to be whether you can charge or pay interest on stablecoins. That right now that's still moving through Congress. I think that'll be probably one of the biggest catalysts that could snap us out of the recent pullback. But the government just takes time. At least it's on their radar. It's important. There's been a lot of lobbying to move things in the right direction. And so I'd rather see the right regulation come out than the wrong regulation. If that means it takes longer, that's fine. But I think that's a huge tailwind for the industry. And it really is bipartisan at this point. It doesn't help when the government shuts down and these things get delayed. But overall, I think that's a huge industry tailwind that we didn't have for 10 years. So we can talk about this cycle and the pullback in prices. We've never had these tailwinds. The tailwinds we have right now from a regulatory standpoint, for the better part of the last decade, apart from 2025, it was all headwinds. It was 10 years of headwinds with cycles. Now we have a tailwind from the regulatory standpoint, and we just have some macroeconomic and environmental issues that are driving the risk off approach at the moment.
This person wants to know, why shouldn't BTCS be viewed as a DAT? And when you think of the different digital asset treasury models, Bitcoin focused, ETH first, and multi-asset, where do you think the industry ultimately settles over the next 5 years?
Well, I think what's going to happen is if you're going to start a company and your sole purpose is, I'm going to go buy Bitcoin, I'm going to go buy $100 million in Bitcoin, it's really a bad business, because you generate no, especially on the Bitcoin side, you generate no revenue, right? It doesn't have staking, and your cost is got to be competitive with an ETF. Moreover, if you use other tools like leverage or other things that you can do as an operating company versus an ETF, because you structure it as a DAT, your company is going to be a hedging mechanism for smart hedge funds, right? They're going to, if your stock's above NAV, they're going to short your stock and buy the underlying via an ETF, or vice versa, right? So there's not much that you can do to really generate shareholder value, because you're just a hedging tool and you're just a pair trade for a bunch of really smart hedge funds. And so I think to break out of that mix, you need to deliver, and you need to deliver with operations. And so I think that's how we are substantially different than most of the DATs. We didn't pivot into this market. We're years ahead in terms of understanding how these things fit into an accounting framework. We're years ahead in terms of what are the different business models you can go into within the Ethereum ecosystem and economy. We've had our feet wet being public. We're not, I didn't start out as a CEO of a private company and now I'm running a DAT and I don't know anything about the public market. So from that perspective, I think we're really far ahead. And as we lean more into Ethereum and we can, or Imperium, and our operating side, I think that's going to really show in the numbers. And if you look at our revenue for 2025, like 16 million is far in excess of most of the other DATs that are, multiples our size. And so if we can deliver the revenue and then work on improving margin over time, that's a much better narrative than, hey, I bought a bunch of, ETH or Solana or whatever the token is, and I'm hoping it goes up. And that's the only, and hedge funds are going to play with your stock for a pair trade. It's not really a good plan.
You mentioned Imperium, Charles. This person wants to know how Imperium fits into your 2026 plans, and what's your focus for 2026?
I think that's our big focus for 2026. 2025, we really focused on getting the block building going. We still need to improve the margins there. But what we're seeing so far with Imperium is if we can get that same scalable revenue growth and have high margins similar to staking, assuming that we can do that, and obviously I can't provide any assurances or guarantees that we're going to be able to execute on that plan, that's a much more compelling business line, and it could vertically integrate with the block building. There's a lot of ways we can integrate those two businesses, so everything kind of becomes interrelated within the Ethereum ecosystem and economy, and we can start looking at layer twos, and it gets pretty interesting in terms of how we can create value for our shareholders. So I think, to kind of come back to your question, 2026 is going to be the year of focusing on the Imperium business line.
Can you elaborate on your use of Aave for borrowing and how you assess risk, collateralization, and liquidity buffers?
So we obviously borrowed on Aave. We borrowed stable coins, and we've put up as collateral against that loan Ethereum, which actually earns in ETH. And the main way we address risk is in twofold. One, we make sure that when we enter the positions that our loan to value ratio is not is extremely conservative, so that when there is market pullbacks, we're not at terrible risk of getting liquidated. Right now, I think our liquidation price without any changes or rebalancing is in the mid 1400 range for Ethereum, as well as, so that's kind of one. And then two, we've made some shifts, recently to make sure that some of our Ethereum is in higher revenue generating, higher margin businesses like Imperium, and that it's not that we have liquidity. So we do have a lot of Ethereum outside of what we have on Aave. So it's just balancing what exposure do we want to have, and what's the risk tolerance, and making sure we do that in a responsible and conservative way.
What are some upcoming milestones investors should be looking out for, Charles?
So I think the big things we have coming up, and obviously we're going to file our 10K. That's given all the developments in 2025, we don't anticipate getting that out early. So that'll be for probably up against the March deadline. So I think that's something investors will be able to see the full numbers in the balance sheet. Obviously can't talk about those until they're out. And then I think for the rest of 2026, our goal is going to be to deliver on the numbers. Typically Q1 is weaker, but if we're able to be successful in our endeavors with Imperium, it'd be great to show strong revenue and strong margin improvements. I think that's the biggest thing. I mean, we're always looking at integrations and partnerships and other things that we can have announcements on, but when it really comes down to it, what do investors want to see? They want to see growing revenue, and they want to see a strong financial picture. So that's our hope, is that we can deliver that in 2026.
We got about 2.5 minutes left. Charles, final question for you. Why should anyone care about BTCS right now?
Well, right now, I think it's one of the most interesting times, right? If you just look at what's going on in the market, everyone can point to the price of Bitcoin coming down, the price of Ethereum coming down. There's, and obviously, I can't guarantee or sure that this is the bottom, but it feels like we're getting to a low. So it could be a really interesting entry point, based on market prices. So fundamentally, there's not much that's changed with the business. Obviously, if the price of Ethereum comes down, our balance sheets, the value comes down as well. But from what we're doing on an operating side, it's the best place we've been in a very long time. And so it creates an opportunity, I think, right? If you when everybody else is panicking is usually a good time to enter. When everybody else is gleeful at the top of the market, it's usually a time to take some chips off the table.
Thank you very much, Charles, for that enlightening presentation and for answering all the questions. For more information on blockchain technology consensus solutions, you can always call us at 1-800-RedChip. You can email us at btcs@redchip.com. Thank you again, Charles.
Yep, thank you so much.
You got it. Our next presenter will be Justin Stiefel of IP Strategy. We're looking for him right now. I think he's coming up right now. Justin, hello.
Hello, can you hear me?
I hear you. I see you. And if you're
Great.
going to be presenting your company presentation, let's see it right now. Make sure it's all working.
Can you see it on the screen?
Yes.
Great. I'm ready to go if you are.
That is great. Let's just, make sure everything's fine here. We do have 30 seconds before the 3 o'clock hour Eastern for everybody who is sticking to the schedule. Again, it's Justin Stiefel, IP Strategy, and it is trading on the NASDAQ under the ticker IPST. All right, well, here we are at the top of the hour. This is the RedChip Fintech and Digital Asset Treasury Virtual Investor Conference. We've been going since 9:30 a.m. Eastern today. We're going to go one more hour until 4 p.m. Eastern. As we just said, with us today, we've got Justin Stiefel. He is the co-founder, CEO, and chairman of IP Strategy, trading on the NASDAQ under the ticker IPST. Justin is going to present in just a moment. We're also going to open this event to your questions. Your lines are going to remain muted, but you can submit a question at any time by clicking the Q&A button at the bottom of your Zoom window. Before we begin, please allow me to read that safe harbor statement. This segment may contain forward-looking statements within the meaning of the Private Securities Litigation Reform Act of 1995. All statements pertaining to future financial and/or operating results, along with other statements about the future expectations, beliefs, goals, plans, or prospects expressed by management, constitute forward-looking statements. Any statements that are not historical fact should also be considered forward-looking statements, and of course, forward-looking statements involve risks and uncertainties. Justin, please tell us about your great company.
Thank you. Thank you for having me. And thank you for all those who are watching. So I'm Justin Stiefel, CEO and co-founder of IP Strategy. Our team includes our Chief Investment Officer, Phil Blouse, who's been in the trading markets for 2 decades and is helping us to execute on our strategy to increase yield. The vision for the Story Foundation, this layer 1 blockchain that is really the crux of what we're doing here, was created by S.Y. Lee. It's the bottom left there. He's the co-founder and genius behind this entire enterprise. He had an exit of a video game company that he built in South Korea for nearly $500 million. Others on the team include Ben Sternberg, who was a CFO for Radish, and then board nominee joined the board after Q1, David Lee, who was an early leader at Google and sits on a number of other boards and companies as an advisor. What are we doing here? We've got 2 parts of the business. One is our legacy spirits business. We started 14 years ago as a craft distillery. We were the most awarded craft distillery in North America for 10 years in a row. I started to look at what was happening in the marketplace and changes that were happening in demographics, and also the opportunity to take advantage of transitioning into the blockchain. When we were introduced to the Story team, I immediately understood the vision. It's a layer 1 blockchain designed specifically around intellectual property. It is something that the other layer 1 blockchains are not really well designed to do. This is purpose built. And we drive revenue from the validator business we have, in addition to the underlying legacy spirits business. The intellectual property space typically is comprised of 3 things: patents, trademarks, copyrights. We focus on copyrights. The crux of the Story Foundation layer 1 blockchain is really built to support copyrights and to protect creators. The IP market as a whole is an $80 trillion market. And what we see happening right now is the problem is growing in terms of how do creators protect their intellectual property? How do they make sure that people who are using it, or AI engines or LLMs who are scraping the internet, are tracking and fairly compensating and giving credit to the creators? Right now, there's too much rights ambiguity. Training and the fine-tuning of these AI platforms and LLMs, it's just very opaque, and it's a big black box. Very difficult for creators to enforce any kind of licensing rights, even common law licensing rights. Right now, if you were to find something on the internet or a digital file, music, video, movie rights, whatever, and you right now would have to go and hunt down the agent or the manager for the creator, look for some kind of digital paper, physical paperwork, PDFs, negotiate terms, and all that. This layer 1 blockchain has been designed to remove that friction and to allow for that to be done in a near real-time way, and also to provide the ability for the creators to track and seek payments and compensation and acknowledgement for their works. Right now, when people talk about AI and they talk about LLMs, they've been focused on 3 things: real estate, chips and computing power, and then the electrical power to drive it. They have not talked about the 4th leg, and the 4th leg is, what do we do with all of the intellectual property that's being scraped and in many cases illegally ingested to create value for the AI companies and the LLMs? And again, the Story 1 layer blockchain is the only blockchain designed to solve that and creates that 4th missing leg to make the table actually level for all parties. So we think this is a critical part of what has been ignored the last several years. And now, because everything else is essentially becoming commoditized, real estate, chips, and electricity, AI is the missing link that needs to be solved. We tokenize the intellectual property. We allow the creators to register their intellectual property on the Story blockchain. We also are allowing layer 2 and layer 3 projects and programs to be developed that are focused on different features, whether it's music, it's video, fractional ownership of digital assets. User-generated content is a large and growing area. Robotics is a huge, huge open area that this Story layer 1 blockchain has been designed to solve and allow for efficient ingestion of data to allow the robots to work more efficiently. From a static IP to native AI, this is really about building the programmable intellectual property world. And this is, again, about registering, licensing, and monetizing. How does a creator of content register their intellectual property in a digital way online? How do they set the licensing parameters in the smart contracts that are embedded in each of the tokens? And then how do they have visibility to be able to track and make sure that they're getting credit and compensation for the works that they created, including derivative works and derivatives of the derivatives all the way down the field? This Story network has been several years in the making, the Layer 1 Foundation. The funding has been led by A16Z in multiple levels, including the foundation itself, several of the projects. I'm going to talk about 2 of them here in particular. And then also A16Z was part of the PIPE transaction that we concluded last August between the legacy company and bringing the PIPE transaction in for the company as it currently sits today. You can see in the bottom here, we're talking about a number of large investors in the space who are well known, who saw the vision and foresight behind this and jumped in and have been providing the seed funding to get things off the ground. Right now, there have been more than 90 million transactions conducted on Story. Again, when we think about the entirety of all the blockchain, people talk about blockchain in big swaths. Most every one of the other blockchains that we've talked about today are financially based. They're competing for a sliver of attention, or they have a specific financial metric to remove friction in some type of financial part of the industry. This is about bringing the financial part of the industry and removing the friction for intellectual property, which makes all the rest of AI legal and compliant down the road. So having 90 million transactions when the token just was launched as of early Q1 last year. We've already undergone 19 network upgrades, including the most recent one that happened in January. More than 13 million accounts and 5.6 million pieces of individual intellectual IP have already been registered on chain. The IP token and its $IP is what's trading. It is fully tradable and very liquid. Today's market value is roughly about $490 million in terms of active market. The governance is the token tied to the Story ecosystem. It powers all network activity and registration, all licensing, staking, and user fees. The cost to run a transaction is very, very low by design, and that was to encourage mass adoption. Creators, developers, and investors alike can buy, sell, and trade the IP token. There are also a number of ways to trade derivatives and options around it. Every IP registration, license, or derivative mint consumes an IP token, but again, the gas fees are very, very minor. And then as Story scales, as more projects are built on chain, as layer 2 and layer 3 programs and apps, you'll see more adoption and more utilization of the base case for the underlying Story IP token. In terms of the business model for IPST, because the Story Foundation is a separate entity, it runs the protocol. IPST is the public trading company that is the largest single token owner and is the largest validator of the Story network. Because Story is a proof of chain blockchain, it provides rewards and staking. We are earning between 5.8 and 12% yield based on the staking protocols. And why the spread is so large is because we set up our own validator at the end of Q1 last year. In this quarter, we've now moved that to a custodied arrangement at crypto.com. So we now have set up our own validating under custody, crypto.com, which is fully insured. And that allows us to put our tokens in under longer term contracts, and those longer term contracts earn more yield. So we're slowly this quarter transitioning from the lower yield contracts, shorter term contracts on the validator into the longer term. So we're moving from 5.8 to almost 12%. We also are doing a third-party validator for validation work for people who have their own IP tokens. They stake them with us. We'd run the validators. They make 95%. We earn a 5% commission on that. In January alone, we generated 257,000 tokens. We're unlocking a block almost every minute and a half or so, and a block in this instance is 8.5 tokens. Our validator uptime is almost 100%. The third-party validation that we've earned, our commission was almost 14,000 tokens. Since we started this in September, it's been almost $5.3 million in this revenue coming to us just from this validation work. And as we see the token value go up, and as we see our yields increase by moving the tokens from the shorter term contracts to the longer term contracts, then we would expect to see the revenue go up. And we're seeing that revenue is at greater than 95% gross margin. We think this makes us not just another DAT, but really we're a digital asset and intellectual property company. I'm going to explain what I mean by that in just a moment. In terms of the metrics, we own almost 53 million of the IP tokens. Again, we're one of the largest single owners of the IP token. The 6.5% yield was the blended rate so far. We anticipate that's going to go up as we move the bigger chunk of the tokens into long-term contracts under staking. Right now, we're slated to earn about 3 million tokens this year. At today's token price, or yesterday's token price of $1.49, it'd be worth a little less than $5 million a year. And again, the fixed costs are less than $400,000 annualized to run this entire thing. And it's run on third-party validators that we control. We have started to use some yield enhancement. We've entered into covered calls where we're earning the most recent contract we entered into today was at 4% per month. So we're talking about greater than 40% yields on an annual basis. We are allowed to use up to approximately 5% of our total tokens under this covered call strategy. Typically, the calls are written 20 to 50% out of the money. This is flexible for us. We can size it up or down, and we have these rotating weekly on a monthly basis with 30-day contracts. But you can see the ability to generate 4% per yield per month is pretty attractive and upsizes dramatically. We then can take those tokens in the yield. We can sell them into the market to cover operational needs of the company. We can take them and restake them to compound our returns. Or we can eventually bank the capital to maybe go on acquisitions or to do stock buybacks or other financial decisions that the company will make based on needs and market conditions. Why invest in IPST versus an IP ETF? There are a couple IP ETFs, including Grayscale recently moved IP into one of their ETFs. It's the ability to generate income from our validator operations because we collect that income, the ETF does not, can access the capital markets more directly. And in addition to that, we are exploring the idea of physical or real world intellectual property. What do I mean by that? It means, do we go out and start to buy some music collections that have license and royalty rights? Do we start to go out and buy movie rights that are generating revenue from existing royalties and license rights? And then do we take those dollars, because it's cash flow, to reinvest in the company or to build that portfolio? That portfolio would be adding revenue in real time because those royalties exist already by buying existing catalogs, but also the ability to take those intellectual pieces of property and register them on chain and partner with some of the other layer 2 and layer 3 protocols that are focused on different parts of the entire ecosystem. So again, we're not just another DAT. We consider ourselves to be a digital asset and intellectual property company, which is both the validator business, very high yields, and how do we focus on the real world intellectual property? Several of the layer 2 and layer 3 projects have started to make some significant dents in the news and the media, especially in Web3. I'm going to talk quickly about Poseidon and Aria. So Aria is a music IP-based layer 2 on the story layer 1 blockchain. It allows for fractionalized ownership of music libraries. Justin Bieber has some of his music has been acquired and is fractionally owned by Aria investors. Miley Cyrus, Madonna, several of the K-pop bands out of Korea, and so on. So Aria has its own token but the entirety of it is built on the story layer on blockchain. And the tokenization does allow for fractional ownership. There's this debate in the US about how will tokenization and fractional ownership work as a security. Well, folks can invest now through ARIA by buying the ARIA tokens and becoming part owner of some of these catalogs that exist to our right. Royalties are distributed to the rights holders. Again, a real world asset in the intellectual property space, unlike the other blockchains that are designed to run simply financial instruments. Investors and fans can buy, trade, or participate through IP. 12 million was raised when ARIA launched in terms of investors buying in the token. Another 15 million was put in by Polychain, Neoclassic, and other large-scale investor groups. Poseidon is a very exciting project. It's built for the AI data economy. It is registering data sets that prove ownership and origin. Biggest growth they've had since launching a few months ago was in the voice and language conversion, which allows usage and access to be clearly set and protected. The project is tokenizing and tracking the audio data sets that are being collected. As AI models are using the data, every use of that is recorded, and then the creator is compensated for it. So the incentives are aligning to get users to sign up and join and create audio files. The data sets can also be bundled, traded, reused, and otherwise put to use in data markets. In the first month of launch, they had 5.5 million submissions of people recording various audio in various languages, almost 35,000 hours of this collected from 400,000 plus contributors. And again, this is all real world data that's not been tokenized on chain. And what's most impressive is that the library that Poseidon is building of public data sets in language alone is now one of the largest in the world. And when you look here, whether it's Russian, Korean, Portuguese, Chinese, it's the blue spikes are represented by the size of Poseidon's data set. Now, why is this important? Well, as these AI engines and LLMs are trying to learn and are trying to figure out how to convert and how to create agents and do translations, the broadest, biggest, most accurate and validated data set of language will make those agents and bots and other AI things that are consumer facing or for research much more accurate and much more reliable. And with that, I'd love to open it up to any questions you may have.
Thanks, Justin. Please click the Q&A button and type in your question into the text box that will appear if you have any questions for Justin Stiefel, and we do have some already here. How did heritage and story come together, and what drove the pivot into digital assets?
Sure. Well, as I mentioned, the spirits business is undergoing kind of a tectonic change if you watch the news. And as someone who tries to be forward thinking and looking at the data, we were looking at different ways to take the existing public company that we had and leverage it and try to create additional shareholder value. We created a technology and cryptocurrency committee on the board early last year, which I think told people that we were interested in exploring this. We added a board member named Matt Swan, who now chairs that subcommittee, and he was an early participant at Amazon, helping to build their digital payments platform. We just heard from Braghouse here earlier. Matt is one of the lead tech people at Braghouse working with Doge. He's deep into the payments and digital platforms over the last 2+ decades and is a trusted leader and well-known worldwide. I think as people saw we were doing that, we started to receive inbound calls. We had lots of suitors looking for us who were trying to do digital transactions last year. And again, when I saw the story pitch and I understood, as an attorney myself, we've got a lot of trademarks and some patents at the company. I understand the value of intellectual property, especially copyright. Copyright is self-effectuating. If you create musical work, a drawing, a written word under the Copyright Act, it's yours to protect. And as we look at this discussion of real world use case for blockchain, it was pretty obvious to me that the ability to digitize and track intellectual property for the protection of creators and also for visibility for users was lacking. And the story had identified a way to build upon that.
Justin, how does Story's success translate into value for IPST shareholders?
Yeah, so I think watching more projects, programs, and collaborations being built as layer 2 and layer 3 pieces of the ecosystem is important. I mentioned 2 in particular, Aria and Poseidon. Each layer 2 or layer 3 project adds users and data. It validates, if you will, the need and demand to be able to track and protect intellectual property. Seeing that data is being used by AI models and LLMs to compliantly build and refine their models is another key feature to be looking at. I think as you watch, it's really more important to watch how each one of the layer 2 and layer 3 apps are growing their user bases. The Story Foundation itself is not designed to make money as a blockchain. It's designed to just run the protocol. And so really it's looking at the transactional work, the amount of data, and the quality of the data being collected at layer 2 and layer 3.
What key performance indicators should investors be tracking for the validator business and treasury strategy?
Yeah. So first, I'd encourage people to look at the most recent changes in tokenomic improvements that were made at the foundation in January, which are both designed to improve the protocol, the Story protocol. They're designed to encourage more long-term holdings of the IP token and to reduce short-term speculation. This also included an announcement that long-term locked tokens, that the lock contract was being extended for 6 more months, which I think should bring more price stability to the token. Again, I think you look at the number, variety, and creativity of new projects and programs being built as layer 2 and layer 3 parts of the ecosystem. You have to look at the amount of data being registered and add to the ecosystem. As the largest validator in the ecosystem, as long as our uptime stays at 99.9%, it's a fairly predictable amount of tokens that we are unlocking on a daily and monthly basis. And really then it's about tracking the value per token, because that value per token multiplied by the number of tokens that we're unlocking every moment gives you pretty good direction in terms of revenue for the year.
What does the company think about managing digital asset volatility?
Well, we're taking advantage of some of the volatility by putting approximately 5% of the IP tokens we have into things like the covered call transactions. Earning 4% per yield per month is pretty good, I think, in relative terms. I think in the future, being opportunistic about acquiring more IP tokens based on where we think the token should be priced overall in terms of value territory. Reinvesting IP tokens that we're earning from staking into additional staking opportunities for the compounding effect is important. Evaluating the market for traditional IP assets. I talked about, do we go out and acquire music catalogs? Do we go and acquire video catalogs? Do we invest in user-generated content catalogs that are all being scraped or used or have demand, and make sure the royalty payment system is fair and transparent? Do we look at possible DAT acquisitions for consolidation? There's a number of DATs out there that they are not generating enough yield to justify either the valuation they have or the cost structure they have just to run compliance and to remain as public companies. And so do we, because we've got multiple business segments, do we think about doing that, building up the balance sheet? It's really about being opportunistic and adding either operational entities or models that complete the overall strategy.
This person wants to know why the token IP was chosen as the primary reserve asset.
It was really the partnership and the negotiation with the Story Foundation. The Story Foundation is they built the IP as their token. It is the native token of the Story Foundation. So certainly it would not make sense to bring in PIPE investments to support the Story Foundation and then go invest in ETH or Solana. Again, the Story Foundation, the layer 1 protocol, that layer 1 protocol was purpose built to support intellectual property and tracking intellectual property in that $80 trillion space. I don't think the world needs another layer 1 that's just designed to run other financial instruments. And that's what appealed to us. And I think investors who are invested in the PIPE and who've also invested in the Story Foundation and growing the ecosystem have an expectation that our primary treasury asset would be the IP token.
Got plenty of questions around this subject. Conflate them into this, Justin. Key near-term milestones, catalysts. What should we
Sure.
be looking out for? Yeah.
Yeah, first I would say on the X platform, there are lots of announcements, lots of partner announcements who are layer 2, layer 3, and other projects that are making announcements in partnership with Story. Sometimes they make announcements ahead of the foundation's work. The interesting thing about Web3 is, even though we as a public company have certain rules about the type of information we can release and how and when it's material non-public information, a lot of the Web3 space, they're not hindered by those rules. So if you want to see a view to what may be coming down the pipeline, be checking X, because that's where a lot of these projects are being announced ahead of time. I think specific milestones investors should look out for include announcements from existing layer 2 projects like Poseidon. Watch for AI data set owners and LLMs who are recognizing the need to become compliant and who want to be good partners with creators. Look for licensing agreements to be announced from them. I think investors should also look for positive growth starting in the second quarter as the legacy expenses are all behind us and wound down, and free cash is being used to increase participation in token acquisition, possible stock buybacks, validate our high margin growth business, or acquisition of things like IP catalogs, or potentially partner with other DATs.
Final question, Justin, the essential value proposition. Why should anyone invest in your company or even consider it right now?
Sure. First off, we're trading at an MNAV of about 0.28, so we're 70% on sale when you look at the value of the 53 million tokens we own versus the market cap. Secondly, I think you would need to ask the question, do you think people are going to stop creating things? Do you think people are going to stop coming up with content that they want to share, whether it's music, video, the written word, or whatever? And if you think that that will continue, then there's going to be a demand to be able to track and monetize for those creators, and also for the AI companies and the LLMs to be able to defensively be able to say they're doing the right thing with creators and not stealing content. I also think you need to look at the robotic space. The best way that robots are trained is not by programming on a keyboard, it's by robots ingesting millions of minutes of video. And you can't just go scrape the internet for video legally to train these robots. So if you're going to be in the robot building space and programming space, you need a compliant way that you can tell both the investors, the public, and regulators that the video you have used has been licensed to you. And the best way to do that is by licensing through the AI platforms and the projects that are being built, so that those videos and other training tools can be used to train robots and agents.
Thank you very much, Justin. That is Justin Stiefel, who is of IP Strategy, NASDAQ IPST. If you want more information on IP Strategy, you can call us 1-800-REDCHIP, or you can write us at ipst@redchip.com. Justin, great work with your company, great presentation. Thank you for everything.
Thank you very much. Appreciate it.
Thank you. Okay, coming up at 3:30 p.m. Eastern, our final presenter of the day, it's going to be Nick Langton of MMA. Nick, I hear you're already on.
I'm here. Thank you, guys.
Nice to see you again. As soon as you appear, it will be true to say that. Could you turn on your video if you're turning it on today? That's your choice.
Yeah, I've just messaged Rob earlier. I just need the cover slide up first. Got some real problems with video this morning. So
hey, no problem. Perfect. If you're presenting your deck today, then let's see that. Or whoever's presenting the presentation for MMA, let's show it. There we go. I'm seeing it now. Excellent. Nick, if you're ready, we'll just dive right in.
Terrific.
All righty.
Well, look, it's great to be presenting to this audience today regarding fintech and obviously also Web3 and crypto.
Absolutely. And Nick, if you'll just, I'm so sorry. Let me just talk about what we're doing here. I got to read the safe harbor for legal reasons, and then, of course, you get the floor. So let me just launch right into that. Again, it's Nick Langton with MMA Incorporated, MMA on the NYSE American. He is the founder and chief executive officer of this company. Nick's going to talk in just a moment. We'll open this event to questions for you. Everyone's lines do remain muted throughout our presentations, but of course, you can submit a question by clicking the Q&A button at the bottom of your Zoom window. One more thing, Nick, it's that safe harbor statement. Let me say it real quick. This segment may contain forward-looking statements within the meaning of the Private Securities Litigation Reform Act of 1995. Any statement pertaining to future financial and/or operating results, along with other statements about the future expectations, beliefs, goals, plans, or prospects expressed by management constitute forward-looking statements. Any statements that are not historical facts should also be considered forward-looking statements. And of course, forward-looking statements involve risks and uncertainties. Now, Nick, we can jump right in.
Fantastic. Well, it's great to be presenting today, and I know that we set up the session so that we could do it as a detailed Q&A. I know a bunch of questions that have already been asked have been provided to the moderator, so I'm really happy to dive into those. But before I did so, what I thought would be helpful to everybody is to just frame MMA Inc. in simple economic terms and understand what we're building here. So at its core, Mixed Martial Arts Group Limited is really building the operating and payments infrastructure for the global combat sports industry. Combat sports has grown enormously in recent years, I suppose best exemplified by the extraordinary success of the UFC. The sector is now expected to have, in the vicinity of 700 million fans globally, and importantly, huge levels of consumer participation. So in the United States alone, you're looking at, in the order of 50,000, underlying combat sports and martial arts academies. Tens and tens of billions being spent on training in those academies annually, and really participation flourishing off the back of the huge growth in the fan base. So it's a really, really large sector. It's no longer a niche sport, and I think that's probably best exemplified by the UFC's recent deal, broadcast rights deal, moving to Paramount Plus, ending their pay-per-view era, and really earning revenues for broadcast rights that exceed a number of what were previously the biggest sports in the world. Earning broadcast rights bigger than the PGA Tour, broadcast rights larger than the National Hockey League. It's no longer a niche sport. It truly is mass. And so from our perspective, we're monetizing participation in this sector from this huge global fan base across three integrated layers. So first, on the consumer side, we generate recurring subscription revenue by delivering licensed training programs and digital experiences to athletes and members, students across our global gym footprint. These are predictable, repeatable B2C revenues that are really embedded directly into gym participation. Secondly, on the B2B side, we're generating high margin recurring SaaS revenue through our BJJ Link software and platform. This is our gym management and community platform. BJJ Link sits at the center of gym operations for all our customers, our business customers, member management, scheduling, content, engagement. So it makes it an enormously sticky and highly scalable SaaS platform. And third, and this is where the fintech element becomes really powerful, because we sit inside the workflow, we process and monetize transactions that flow through our platform. So subscriptions, program purchases, in-gym, digital commerce, all of this runs through BJJ Link, and it allows us to effectively clip the ticket as volume grows. So as participation scales, transaction revenue also scales materially with that. And then finally, we've made announcements in recent months. We're layering in a Web3 and digital asset framework designed to enhance payments, incentives, and engagement across the whole ecosystem. And so this isn't a speculative layer. This is about aligning incentives, improving participation economics and really tying the entire network together. So when you look at MMA Inc., you're really looking at a vertically integrated fintech-enabled platform. You're looking at recurring SaaS, recurring consumer subscription revenue, the transaction revenue that runs off the back of that, and then finally, a digital layer designed to compound engagement and increase monetization over time. So with that being said, that's kind of the overall positioning of the company. Would love to jump into to some of the questions.
Thank you very much, Nick. Press the Q&A button and type in your question. As we can only take your written in questions today, we ask that you please not use the raise hand button. We already have many questions, Nick. One, for those less familiar with the business, how do you describe where MMA sits today in the global combat sports ecosystem and what has changed most meaningfully over the past year?
Yeah, great question. Look, when I step back and look at where MMA Inc. is today, it's a company that's evolving, from an early platform into real operating infrastructure for a massive global sport. So over the past year, the biggest change hasn't really been vision; it's actually been execution. So we've moved from proving the concept to embedding the software, payments, and engagement tools directly into gym workflows. And also capitalizing on significant fan base growth, which is leading to significantly higher participation in martial arts and combat sports globally, certainly at a sort of a hobbyist and fitness level. And so all these elements matter because infrastructure businesses like ours behave very differently from just content or media plays. Once you're integrated into onboarding, billing, customer retention, ongoing engagement, then switching costs increase and value for us as that infrastructure and payments provider really compound. So we're focused on building systems that can scale with participation and that transition, and that transition is really foundational to everything we're building next.
Nick, combat sports has enormous global participation but remains fragmented. What structural problem is MMA.Inc. now uniquely positioned to solve?
Yeah, this is really the most exciting element. We have seen, as we've seen combat sports, really grow, and again, the incredible success of the UFC, that's really driven a huge amount of participation. So combat sports is massive globally, but economically it's still fragmented and it's really significantly under digitized. So gyms and coaches deliver incredible training experiences. The consumer product that they have inside their academies and on the mats is superb, but they've lacked modern tools for payments, retention, data, and monetization. So MMA Inc. really is providing that missing operational layer, connecting participants, coaches, and gyms through a single ecosystem that really improves lifetime value and more predictability in terms of customer retention. So from a fintech perspective, this is about significantly better unit economics. From a digital engagement perspective, it's about participation and retention. So when you align those, you get a platform that scales efficiently, rather than relying on constant new customer acquisition.
What are the clearest indicators of commercial progress that investors should be watching over the next few quarters?
Yeah, the most important indicators for us are quality and repeatability. So obviously very focused on recurring SaaS revenue from all our B2B gym customers. We know when that software is running your academy, you've got a lot of depth of engagement in that product, and you obviously get enterprise-wide adoption. So those are the kind of important metrics that tell you whether a platform is becoming embedded or it's just sampled. So we're seeing steady progress across all three. We know engagement drives transactions. Transactions drive revenue, and obviously that revenue improves all unit economics. So what matters for investors when they look at a business like ours is that this revenue is fast growing and repeatable. So as more gyms and participants join in, the system improves, and this is really how the operating leverage begins to show up for us commercially.
Nick, as the platform expands globally, how does the UFC partnership translate into repeatable and scalable economics?
Yeah, this was a really big announcement for us last year when we joined our partnership with the UFC gym to provide our training products and also our software to their new UFC gym BJJ franchise model. So the partnership with UFC gyms significantly validates our technology at an enterprise level. When a global operator of their standing chooses your platform, it really does, prove the reliability, scalability, and operational fit across multiple markets. More importantly, it gives us, a repeatable deployment model. Instead of selling location by location, we're rolling out to a really large, vibrant network, backed by the most important brand in combat sport. And then obviously that lowers friction, that shortens sales cycles, improves unit economics by having them as a large customer. So, from an investor standpoint, that kind of distribution materially accelerates our scale.
You got Laura Sanko here and Daniel Cormier on your cover. You've attracted them and other very high-profile strategic shareholders and advisors, Nick. But what does it all mean for the business operationally?
Yeah, that's an important question, and we have built enormous credibility within the sector. By truly understanding the nature of the sector, the nature of the gyms and how they operate and how they monetize, and that's obviously formed a lot of respect with some very high-profile athletes and identities. So we've been very intentional about alignment. Strategic capital is all about credibility and long-term thinking, and so from our perspective, it is enormously exciting to have some very high-profile strategic shareholders and advisors supporting our vision. The relationships we've built, really strengthen that trust, and reinforce our opportunity to execute off what is really a massive opportunity globally. And this credibility, this compounds over time. Obviously, it opens a lot of doors for us. It reduces a lot of sales friction as the business continues to scale. It really is an enormous vote of confidence.
Another name we can focus on, Donald Trump Jr. What about his involvement, and what about that capital markets credibility you were just talking about?
Yeah, Don joined the business originally as an advisor back in September, and then invested additionally in the business in December, which we announced. Obviously, somebody who's enormously passionate about supporting small business and the growth of that. Obviously, he brings a really strong understanding of capital markets, a lot of synergies with Conor and Conor McGregor's investment in our business. Delivers a lot from a brand standpoint, and probably importantly, his involvement is practical, not symbolic. Like, he really understands how institutions evaluate risk, and how durable businesses are built, and that perspective is really valuable as we scale across SaaS, payments, and digital engagement. It really reinforces MMA Inc. is being built with institutional discipline and a long-term mindset to really aggregate this sector at a grassroots participation level globally.
From what I know about combat sports, keeping it real is really everything. If you're inauthentic, forget it. So how do you keep that authenticity, and how does that help you attract gyms, coaches, and of course, even more athletes?
Yeah, that's a great question. And when you think about a moat that protects a business that's got material first mover advantage, as we do in this space, authenticity as an operator, and trust in that sector is foundational. So athletes, participants, coaches will engage only with platforms that they trust, and that trust can't be manufactured, and it can't be just bought and assumed overnight. MMA Inc. is built by people who are deeply embedded in the sport and the sector, and that really shows up in our adoption and engagement. So from an investor perspective, authenticity directly impacts retention, churn, and importantly, customer lifetime value. So, when users feel aligned with a platform, when they know it's real, when they know that the platform truly understands the sector in a very nuanced and intimate way, they stay longer, they transact more frequently, and we're a more trusted player. So, that's a very, very important part of our growth in recent years, has been the recognition that we've built our offerings with an intimate knowledge of what the sector needs.
How does the involvement of Conor McGregor give you an edge?
Well, look, firstly, Conor invested in the business, when we were still a private company way back in sort of early 2021. Conor's coach, John Cavaghan, is my business partner and co-founder. And obviously Conor brings like unmatched global reach and cultural relevance. But really importantly, also alignment with the athlete and fan mindset. So, when you combine the enormous brand power that someone like Conor delivers with the real infrastructure we offer, so software, payments, and monetization for gyms, really turning fandom into participation. Someone like Conor is a really important strategic asset rather than just sort of a marketing pop. And this really accelerates engagement, clearly reinforces credibility within the sport, and creates a flywheel that is incredibly difficult and expensive for competitors to replicate. And Conor has been really important with onboarding a number of additional advisors and key investors in recent years too. So just a very, very important contributor to our business's value.
This person wants to know about the partnership with World Liberty Financial. What excites you the most about it in the next 12 to 24 months?
Yeah, that was an announcement we made, very recently. We've executed an MOU with World Liberty to work with them on our Web3 layer as we continue to aggregate the sector and really provide a very sort of enriched incentives layer to capture on our customer base. And we've got close to 90,000 people paying their gym fees through our platform every month. Millions of dollars of transactions going through the platform every month. And so our approach to digital assets is really disciplined, and the partnership with World Liberty is really about the infrastructure they can provide to support the utility inherent in our system. This is not about sort of a speculative digital asset. This is about utility. So we see the blockchain as an extension of modern payments, clearly, aligning incentives, rewarding participation of our customers and fan base, and deepening engagement. So this really, what we're building in conjunction with World Liberty, sits on top of our SaaS and transaction layers, adds optionality, while obviously maintaining governance and risk discipline expected within a public company. But we know that the MMA fan base globally is significantly predisposed towards digital assets. They've been very early adopters of crypto, and in that regard, building this incentive layer and really aggregating what we're already doing in a more traditional Web2 way through payments. This is a very natural next evolution, and we're really excited to accelerate this partnership.
Final question, Nick. When investors look back a year from today, what do you think will have been the most underappreciated aspect of your company?
Yeah, that's another good question. I think what might be underappreciated is how many scalable levers we've quietly assembled. Software and SaaS subscription revenue, payments and clipping the ticket on transactions inside our platform, opportunities to scale rapidly through enterprise distribution, and obviously having a really rich vein of data that we understand about the sector globally from a fandom and participation standpoint. So we're not dependent on a single revenue stream to win. As participation grows, engagement deepens, and all of these layers reinforce each other and create real operating leverage for us. So our focus, particularly over this calendar year, is on execution with all these building blocks in place, and we're really excited to see. I think in a sector that is people are really aware of now, again because of that extraordinary success of the UFC. You're going to see other companies come and begin to win in areas outside, things just like broadcast rights for professional sport. This is a big payments infrastructure play for participation, and really looking to convert 700 million fans of the sector, into participants over time. There is an enormous opportunity to create a deeply valuable company.
Thanks for that, Nick, and thank you for an excellent presentation. Thanks for joining us today.
Thank you.
You got it. For more information on MMA, write us at mma@redchip.com or call us at 1-800-REDCHIP. That does it for today's RedChip FinTech and Digital Asset Treasury Virtual Investor Conference. For more information on any of the companies featured today, you can call us again at 1-800-REDCHIP or write us at info@redchip.com. Join RedChip's next webinar with Bimergent Energy. That'll be on Tuesday, February 10th at 4:15 p.m. U.S. Eastern. Register for that webinar and for all RedChip webinars at redchip.com/events. Thanks for watching.